Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So in this session, we are going to get started with a brand new chapter called as the cost of capital. Right? So shall we get started? Yes, fine. So now, first of all, our subject, financial management, has how many objectives? Guys, answer, come on. How many objectives? Three objectives. What are they? Financing decisions, investment decisions, and dividend decisions. This is what we saw in the introductory session, and I told you that every chapter in our syllabus, right, goes on to achieve either of these three objectives. Correct? Now, what do you mean by financing decisions? Those decisions which are taken towards the fundraising activity. Yes, guys. And this chapter, cost of capital, squarely fits into the category of your financing decision. Are you clear with this? First that you need to know is which objective are we achieving in this chapter, right? Are you able to understand this, right? So this chapter relates to what? Fundraising activity. Clear with this, guys? Now, let me just give you a background example here. Now, let us say this is the balance sheet of the company, right? The company can raise money from different sources of finance, correct? When I say finance, capital, money, fund, these are all interchangeably usable words. Capital means, don't think it is equity capital. No, capital means money in normal financial language. Clear with this? Now, let us say company is raising. One source of finance is called as equity share capital. There is another source of finance called as preference share capital. There could be your debentures, there could be long-term loans, different sources of finance can be there. Correct? Now, each of these sources of finance, you tell me, guys, will it come free of cost? Will it come free of cost? Absolutely not. For every rupee the company is raising, they will be incurring some cost. Yes, the cost incurred towards equity share capital is called as cost of equity. Are you clear with this? And cost of equity is popularly known as KE, where K stands for cost, E stands for equity. Are you clear with this? How to compute and all that we will be seeing. Don't worry about that. I'm just introducing you to the terminologies used in this chapter. Now, similarly, preference share capital also, company needs to pay dividend and all these things, correct? Overall, preference shares also, this source also has some cost associated with it. The cost associated with your preference share capital is called as KP. Are you clear with this? Similarly, the cost that is incurred towards your debenture as a source of finance is called as KD. Are you clear with this, guy? Right? Now, one thing that you need to remember is in this chapter, whenever I use the word cost is always expressed as a percentage, not in absolute terms. Clear with this? Or one more point extra I'll tell you. This cost is nothing but the discount rate which we saw in our EVM chapter. Clear with this? Sir, how, sir? Simple. We saw an example where I told you IRR calculation. In that context, I told you one thing. Every complete financial transaction has both inflows and outflows associated with it. Correct? Let us say you are going to a bank, right? And you're opening an FD. From your perspective, what will you do? There will be first an outflow, followed by a series of inflow. And when we equate the inflows with the outflows, the rate that equates the two is called as a return. We saw. Just flip the same financial transaction from the perspective of the bank. From the perspective of the bank, there would first be an inflow, followed by a series of outflow. Or, in short, can I say, IRR, when computed from your perspective, was a return for you. The same IRR, when it is computed from the perspective of the company, can I say it is a cost? Guys, correct? Yes, because it's the same transaction, only flipped. There was initial inflow followed by a series of outflow from the perspective of the company. You clear with this? That calculation is only called as your cost of capital expressed as a percentage, and for each and every source of finance, the cash flows will be different. For equity, there will be your equity dividend. Your preference, there will be preference dividend. For debentures, there will be interest. It can be different. So this calculation done for every source of finance is nothing but the discount rate or the IRR for that source of finance, which we are denoting it using KE, KP, KD, etc. Are you clear? Are you able to understand this? Now see how we have transitioned from our core mathematics, that is time value of money chapter, to our financial management using the TVM technique. Clear with this, guys? This is the reason why I said that chapter is like an oxygen. Without that, you can't even enter into the entire subject. Clear with this, guys? Now let us say, for example, the company raises 30 crore rupees from equity route, 20 crore rupees from preference share capital route, and let us say 50 crore rupees from the debt route, debenture route. Totally, the company has raised how much? A total of 100 crores. And let us say you did the IRR computation for equity share capital route, and you have arrived that the cost of equity is, let us say, example, how to compute and all we will see later, 12%. The cost of preference share capital, that is the IRR for this preference, is going to be 11%. And the IRR for debentures is going to be how much? Let us say 9%. So to put it short, can I say this 30 crore, every rupee raised in this 30 crore had a cost of effectively 12%. Correct? The cost of raising this 30 crore was 12%. Clear with this? The cost of raising this 20 crore was how much? 11%. The cost of raising this 50 crore was how much? 9%. Clear? Now they are saying, I don't want all this. Totally company has raised how much? 100 crore. Overall, you tell me, for this 100 crore, what is the net effective cost? Sir, 100 crore, there is no single cost. For 30 crores, cost is 12%. For 20 crores, cost is 11%. For 50 crores, cost is 9%. Overall, this 100 crores, what is the cost? That is called as KO, or popularly known as weighted average cost of capital. It's called as WACC. That is nothing but a weighted average of each different source of finance. How to compute, we will be seeing it later. Right now, I'm still at the introductory level. Are you clear with this? So there is no separate IRR calculation for WACC. It is nothing but source wise you would have done an IRR calculation, right? Weighted average and arrive at the final figure. As simple as that. So for this entire 100 crore, what is the average cost of capital? You average and you tell me, are you clear with this, right? This is the holistic picture of this entire chapter we are going to do. Sir, as simple as this, no sir. Why do we need this entire chapter? It's not like that. There are some technicalities involved in every single source of finance, and there are some detailed and advanced level computation that we will be seeing inside this chapter. And that is the reason why this chapter has a lot of numerical problems along with technicalities and all. One of the most important chapters, every attempt about 8 to 10 marks gets tested in that 50 mark component of financial management. So ideally, the weightage of this chapter is around 16 to 20% of the FM component. 8 to 10 out of 50 means about 16 to 20% as a, if you're looking at it as a percentage. This chapter itself is a percentage chapter only, no? Cost is referred to as percentage, by the way. Guys, clear with this. Always remember, if you give a figure in absolute sense, it doesn't make sense. It should always be expressed as a percentage, only then it is comparable. Clear with this, right? So this is actually something I wanted to tell you all. And the most important thing that you need to have in your mind is, this chapter is, this entire calculations and computations in this chapter is done from the perspective of whom? Is done from the perspective of the company, not from the perspective of the investor. So this chapter is fully done from the perspective of the company. Have that in your mind. We are not computing this from the perspective of the investor. Are you clear with this? Are you clear with this? Right? Right? Now, basically, one thing that I told you earlier was that bank FD example. What is return from the perspective of the investor is, technically speaking, the cost from the perspective of the company. Correct? No. Your return is actually the company's cost, because what they pay is what you receive. Simple. Right? Of course, there are a few adjustments. There are a few exceptions to this rule. Right? What is what? We will be seeing it during the course of this chapter. But general thumb rule is what? Return from the perspective of the investor is cost from the perspective of the company. But there are a few exceptions to this rule. What are those exceptions? You will be understanding as we proceed into this particular chapter. Are you clear with the introduction? This introduction is a launching pad for you to enter into this particular chapter. Without this introduction, that perspective you will not be having and you don't know what you will be doing. That's the reason why I took this time and explained the perspective. Here with this, guys. Perfect. Now, look at this. Take your concept decoder book. Look at this. Cost of capital refers to the return expected by the providers of capital. This word expected is the most important word in this chapter because I will just give you a hint right now and leave it there. When we are doing the sums, I will walk you through this, the spirit behind this word. In financial management, we don't deal with the actual figures. Why? Because this subject is about decision making. This subject is not a post-mortem work. We are not in financial accounts where once the transaction happens, you record it. No, that's not what we do. If the transaction has happened, already happened, where is the question of taking a decision for it? Clear with this? That's the reason why we use the word expected. Means what? We are dealing with the expectation of the providers of finance. So suppose if the company has actually incurred a cost, right? That actual cost is irrelevant. Today, if their investors are expecting something, we deal with these figures. It is based on the model of opportunity cost. Are you clear with this? So we don't deal with the actual figures. We generally deal with the expected figures. And that is the reason why they have used the word return expected by the providers of finance. And remember, return from the perspective of the investor is cost from the viewpoint of the company. Are you clear? This is a general rule subject to a few exceptions. Clear with this, guys? Right. Fine. So it's the return expected by the providers of finance to the business as a compensation for the contribution to the total capital, and it's expected as expressed as a percentage, right? And this is also known as the cutoff rate or the hurdle rate or the minimum rate of return, and it is used as a benchmark for taking capital budgeting decisions. What is the meaning of this? Capital budgeting decisions is basically your investment decisions. What is it? We will see in that chapter. Leave it right now. In short, this is nothing but the discount rate we studied in TVM chapter, right, which is used to discount or compound the cash flows or a stream of flow of cash, right? And in this chapter, the following terms will be used. The following terms will be used for discount rate. Instead of the word discount rate, we use the following terms for the respective source of finance. Equity, we call it as KE. For debt, it's called as KD. For preference, it's called as KP. Even retained earnings will come with a cost. It is called as KR, right? What it is, we will be seeing. Clear with this? And then overall cost of capital is called as WACC. WACC stands for what? Weighted average cost of capital. That is nothing but the weighted average of the previous four sources of finance. Clear with this? And it's referred to as KO. Are you all clear with this? This is nothing but a normal discount rate pertaining to every single source of finance. Are you able to understand the introduction? Done? Perfect. Now on this note, shall we get started, guys? Right. Now, before you enter into, right, the core of cost of capital, there are certain important terms or concepts that you need to understand. So every chapter before we start, I have this segment called as important terms or concepts used in this particular chapter, right? Similarly, we'll be doing for this chapter as well. Shall we get started, guys? Now, sorry. Now, number one, securities, any security, be it equity, preference, your debentures, any security can be issued either at par or at discount or at premium. You guys know this 11th standard math, 11th standard accounts. Basically, any security can be issued at par, premium, discount. You know this. Suppose the face value is going to be 100 rupees. Correct? If they are issuing at 100 rupees to the public, it's called as par. Suppose they are charging less than 100 rupees for a 100 rupee worth of share, it is called as a discount. Example, 90 rupees. Right? Suppose they are charging a premium, that is, the issue price is more than the face value. In that case, you call it as what? A premium. You guys know this, no? Yes? Fine. Then, next one. Similarly, even there are different types of redemption value. Even the redemption can happen either at a par or at a premium or at a discount. Agreed on this? Yes, agreed on this? Fine. In the absence of information, what we assume? We always assume that it is happening at par. Right? Nothing is given. You can assume that both the issue price and the redemption value is at par. Correct? It's a very normal and a standard assumption. Yes, guys. Perfect. Now, here comes the one unique component that you need to know. Concept of flotation cost or issue cost. What do you mean by that? Now, is it visible? The screen visible? Right. Now, look at this. Flotation costs are those costs which are associated with the issue of new securities. Example, brokerage, underwriter commission, etc. Now, let us say, the company is going to the primary market for issue or for raising of funds, IPO, right? Automatically they can go and raise money. No, they have some kind of restrictions. The first thing is, you would have studied in law. Ideally, you should have studied. There is something called as prospectus. The company needs to issue that prospectus, and they need to issue all these things. That a prospectus has a printing cost, right? Creation of prospectus also comes with some kind of cost, and not just that. Once you, once you circulate this prospectus, now these kind of these investors should actually come and they should invest at least 90 percentage or something like that, right? It should be subscribed at least to the extent of 90 percentage. All these things are there. Suppose if the company is not guaranteed of that, what they generally do, they actually hire these underwriters who will charge some underwriting commission and all. These are all some costs which are associated with a fresh issue of shares, correct guys? Yes, right? Now this is a cost. This is definitely a cost. Now in that case, what are we dealing with? I told you in this chapter, any cost from any source of finance is nothing but the IRR calculation. We are going to match the inflows with the outflows, correct? No, right? Inflow from the viewpoint of the company, if you see, let us say every share is issued at 100 rupees. Example, I'm saying 100 rupees. So 100 rupees, the investor will pay to the company, correct? But let us say the company has a flotation cost of 2 rupees for every equity shares issued. So technically, though the investor pays the company 100 rupees, technically they will receive how much? 100 minus 2, 98 rupees only. Guys, correct? So the net cash inflow at T0, that is today, will be what? Your issue price minus flotation cost. Are you clear with this? Because this entire subject of financial management is about matching your cash flows. Are you clear with this? Are you clear with this? So in this case, what happens from the viewpoint of the company, the first net issue price or the net proceeds the company will receive is going to be how much? Your issue price minus your flotation cost. Why do you minus your flotation cost? Basically an outflow from the viewpoint of the company. Are you able to understand this? Are you able to understand this? These cost applies only to new securities and not existing securities. In case it is given in the question, the issue price must be taken after deducting the flotation cost in order to arrive at the net proceeds, since it is an outflow and hence it is being reduced. Are you able to understand this? Right? Now let me add one more point to this. Now it will become interesting. Till now we saw what was a cost from the perspective of what was a return from the perspective of the investor was a cost from the viewpoint of the company. Why? Because the cash flows are the same. But if there is a flotation cost, there will be a change in this rule. Why? Because from your perspective, from an investor perspective, you would have paid a company how much? 100, correct? So initial outflow was 100, correct? From your perspective. But switch and look at it from the perspective of the company. When I am calculating, I am taking my net inflow as only 98 rupees and I do all my calculations. So my cost will be slightly different from your return. To understand. So I told you the general thumb rule is what? Your cost return from the viewpoint of the investor is equal to cost from the viewpoint of company, subject to some exceptions. I told you first exception is when there is a change in any cash flow, right? Because of the presence of something like flotation cost. In that case, my cost calculation will consider the flotation cost. Is the flotation cost borne by the investor? No. So from his viewpoint, he will not consider this, but from my viewpoint, I am considering it. Because of that, my cash flow equation will change. So I'm not using the same cash flows which you use, and hence there will be a slight deviation between your calculation and my calculation. Are you able to understand? But general thumb rule, if flotation cost is not that, then you are right. Your return is my cost. Are you able? Right. Now, generally in this area, there is one huge confusion which students ask me left, right, and center as a doubt. And this is one lacuna which actually in our institute study material also they have mentioned. This is a huge lacuna. That's why I have categorized this as a doubt buster area. So basically this area, many students have this doubt. So I have created that doubt here and I have clearly mentioned what is the solution that you can follow, the remedy for this doubt. Now in the question they are saying, let us say flotation cost is say 1% and they are leaving it there. This percentage can either be applied on the issue price or on the face value in the absence of information. Clear with this? Let us say, guys, the face value of every share is 100 rupees, right? And the issue price was, let us say, 110 rupees, right? The money that I'm receiving from the public is how much? 110, right? Now, let us say they have given that flotation cost is 1%. Will you apply this 1% on the face value, or should you apply this 1% on the issue price? This is one general doubt with which actually arises, right? Now, institute themselves are saying you can take an assumption whether to apply it on the face value or to apply it on the issue price. If in the question they have specifically given your flotation cost is 1% on face value, then you should only apply it on face value. Or they have given 1% on the issue price, then you should apply only on the issue price. Nothing is given. You can take any stand and you do it. But very strictly speaking, logically, I'm saying you, exam perspective, that's all over. Take anyone in the absence of information. But in my perspective, logically, it should be applied on the issue price. Reason, underwriter's commission, he will charge on the issue value, correct? He'll say, pay me 1% on the issue value. He for him, face value is of no use. He'll say, face value, you keep it as 10. If you are actually raising, if for every share you are charging 500 rupees, 400 rupees premium, yes, practically it is possible, right? In that case, what will happen? So will he charge on 100 rupees or 500 rupees? He will obviously charge on the issue price. He will say, look, I am dealing with a total value of so much, you pay me on that. Strictly and logically speaking, my stand is it should be on issue price, but in exam you can take any stand, but write a note and leave it there. Are you able to understand this? Right? On that note, this particular concept is also over. Clear, guys? Done. Shall we move on to the next one? The next most important part of this entire chapter is the concept of tax savings on interest. Shall we get started with this area? Yes. Now, what is this concept of tax saving? Now, payment of interest to debenture holders are allowed as expenses for the purpose of tax, right? And hence, they can save the tax liability of the company. And saving in tax liability in the, for the company is also known as tax shield. Now, what is this, sir? Now, guys, some basic of income tax. Forget income tax. Your profit computation when you have, right? Your income tax when you are paying, a company when it is paying, the income tax is paid on what? On your profit, correct? And for the purpose of this profit computation, there are some expenses which are allowed as a deduction. Your sales or your revenue minus expenses is only a profit. On this profit only you pay tax. And one of those allowed expenses is your interest paid on any debt instrument, interest on debentures or interest on loan. Is it allowed as a deduction for the purpose of income tax? Yes, absolutely it is allowed. In fact, it is covered in a section called section 3613 of your Income Tax Act. All those things are not required, but I'm just telling you that it is an allowable expense for the purpose of tax. What do you mean by this? Now, let me give you one illustration. Let me give you one example. Now, let us say there are two companies, company A and company B. Okay. Both the company has the same total capital employed in both the companies is, say, let us assume it is same. Let us say 1000 crores was invested in this business. Which business? Both company A and company B, right? But the only change was, let us say, example only I'm giving you, equity and debt. Company raised money only through two sources of finance. Okay, let me just put it here. Second. Let us say equity, debt, preference, and total. Company A, what they did, they raised this 100,000 crores. They raised it out of this example only. I'm telling you guys, 700 crores they raised from equity route, 300 crores they raised from debt route. Correct? How about company B? Company B, totally 1000 crores only. 700 crores they raised from equity and 300 crores they raised from preference route. Example I'm saying, right? Now, what happens in this case? Both the companies, total capital employed is what? Same, 1000 crores. Agreeing with me? Agreeing with me? Any problem here? Now, what happened? So, both the companies assume are in the similar risk class, right? So, they are normally operating. Everything is same. both the companies are starting with the same EBIT. EBIT means what? Earnings before interest and tax, or in other words, EBIT is nothing but your operating profit that you calculated under your costing subject. Correct? Earnings before interest and tax. In your costing, you have this marginal costing income statement and all. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. You say no, that profit is only EBIT. Right? Once you arrive this EBIT, from then on FM starts. This is why I generally say FM starts from where costing stops. Are you clear? Are you clear with this? So basically these two are interrelated subjects. That is the reason why we are actually learning it like this. The next chapter, leverages, I'll deal more about the concepts of marginal costing, which is a background for that chapter. But coming back here, both the companies are starting with what? The same amount of EBIT, which is 100 crores. Clear with this, guys? Now what happened? Company A paid an interest of 30 crores. Let us say that is 10%. This debentures is carrying a cost of 10%. This preference shares is also carrying a cost of 10%. Both, that is also same in for both the companies. Correct? So now what happened? Less interest for company A, it is 30 crores. Company B, interest is not there. So it is nil. Clear with this? So your EBT will be how much? 70 and 100. Now tax at the rate of 30% on EBT is how much? For company A, it is going to be 70 into 30%, which is 21. For company B, it is 100 into 30%, it's going to be 30. So earnings after tax will be what? 49 and 70 respectively. Now less preference dividend. Now preference dividend will be reduced. Now for company A, there is no preference dividend. For company B, you have 30 rupees of preference dividend. So finally, the net earnings available to equity shareholders is going to be 49 rupees for company A and 40 rupees for company B. Right? So the format of your income statement will be EBIT minus interest, you call it as EBT, minus tax, you call it as EAT. Now is everything available to equity shareholders? No. First, you need to pay the preference dividend. So minus preference dividend. Now whatever you have is available for the equity shareholders. I popularly call this as EFE for all our classroom discussion. EFE stands for what? Earnings for equity shareholders. Clear with this? This is what? Your earnings after tax minus your preference dividend. Clear with this? What happened? Both the companies are similar in all types. They started with the same starting point. Number one. Number two, both the companies raised the same total amount. And for company A, the only difference was company A raised from debt route, company B raised from preference route. But that also, both the companies were having the same cost of 10%. Still, sir, how is company A earning more profit than company B? Company A is earning 49 rupees. Company B is earning only 40 rupees. Incrementally, company A has earned how much? 9 rupees more, or 9 crores more. Rupees in crores. Clear with this? How is this possible? This is because, if you notice, company A paid a tax of only 21 rupees, whereas company B paid a tax of 30 rupees. Now, actually seeing the difference in tax was company A ended up paying lesser tax to the extent of 9 rupees, lesser the tax amount or lesser the cost, more will be the profit. Here with this. Sir, then why did company A pay lesser tax? Because the base for you to compute the tax is your earnings before tax. Agreeing with me? Now, for the purpose of computing the base to calculate tax, interest alone is allowed as a deduction. Why? Because preference dividend is not an expense, it is an appropriation of your profit. Because to some extent, even preference shareholders are called as shareholders. Correct? No. So which means anything that you pay to a shareholder is not an expense, it is only an appropriation of profit. Yes, though they are legally speaking, they don't have any voting powers and all that, but they are also treated as one shareholder only. So amount paid to them is not an expense. So this 30 rupees was allowed as a deduction, correct? Or to put it in other words, out of 100, only on 70 the tax amount was computed. Or in other words, can I say on this 30 rupees, no tax was paid? Guys, correct? So to put it short, here can I say this 9 rupees whatever company has saved is nothing but your interest amount into tax rate. Correct? Interest amount into tax rate. What is your interest amount? 30 rupees. What is your tax rate? 30 percentage, 30 rupees into 30 percentage, that gives you how much? Is 9. This is the tax saving. Correct, guys? Correct, guys? Yes, are you able to understand this? Yes, are you able to understand this? Or one more step can I go and say, effectively, what is my interest cost? I paid 30 to whom? To the debenture holders, but parallelly I saved 9 rupees because I paid 30 rupees to them. So effectively, can I say my net effective interest cost is going to be rupees 30 minus rupees 9, which is equal to rupees 21. Agreeing with me on this? Agreeing with me on this? Because I paid this 30 rupees, government allowed this tax benefit on the interest component, so I was able to save 9 rupees parallelly. So my net effective interest cost is how much? 21 rupees. Yes, agreeing with me on this? Guys, are you all able to follow? Because this 30 rupees is what I paid, this 9 rupees is what I saved. So net effective interest cost is going to be 21 rupees. Agreeing with me on this? I call this as the post-tax interest cost. The post-tax interest cost, this 9 rupees is called as the tax saving on interest, also called as tax shield on interest. We just saw that. Are you able to? Is this facility available on preference dividend? It's there only on interest. Correct? So one more point can I just say? How did we compute this figure? How did we compute this figure? Can we say that this 30 rupees is nothing but interest amount, right? And this 9 rupees is nothing but minus of interest amount into tax rate. Correct? This 9 rupees is what? Interest amount into tax rate. Just now we calculated, no? Interest amount into tax rate. Yes, yes. Now, can I just say, take this interest amount outside. Can I just say, this is nothing but interest amount, the whole into 1 minus tax rate. Correct? No? Correct? No? Or in other words, can I say, the effective interest cost for me is I into 1 minus T. Because 1, how much is T? 30 percentage. Correct? So technically speaking, if I pay them 100 rupees, example I'm saying, if I pay them 100 rupees, effectively speaking, 70 rupees I'm parallelly able to save. So net effect, only 70% of whatever pays my effective cost. Correct? Because every rupee I pay, parallelly 0.3 rupees I'm able to save. Or every 100 rupees I pay, parallelly that's a saving of 30 rupees. Effective cost is only 70 rupees of whatever interest I pay. Are you able to understand this? A very, very, very critical understanding. Spend more time here. You will thank yourself for a lifetime, because throughout this is what we are going to see, right? This is one very, very important and a core fundamental understanding here. So when we are computing the cash flows for debenture route, so when you are framing the cash flow equation, every year you are going to pay interest, but parallelly you will be saving some tax. So the net effective cash flow every year will not be interest, it will be interest into 1 minus T. This is how your cash flow equation will be framed, because whenever I'm paying 100 rupees, parallelly I will be saving 30 rupees. Example, illustration I'm saying. The net effective cost will be 70. Or in other words, in the numerator every year when you are saying the company is paying interest, parallelly there is a tax saving. So the post-tax interest cost will be what? I into 1 minus T. This will be appearing in your cash flow equation, because at the end of the day, what are we calculating? We are matching the inflows with outflows, and we are calculating the IRR for every source of finance. So you should first know what should be the cash flow every year. And in case of interest is being paid, parallelly there is a tax saving. The post-tax interest cost is going to be interest into 1 minus T. Are you able to understand this? Yes, you're all able to understand. The relevant cash flow for debentures is going to be what? Interest into 1 minus tax rate. Are you able to understand this? Exactly what I've put here. It can be clearly seen from the above example that despite having the same EBIT, the net earnings for company A is more as compared to that of company B, since interest amount is tax deductible expense, whereas dividend is not allowed as a tax deduction. Are you able to understand this? Right? So the post-tax cost of interest is what? I into 1 minus T. Every year when I pay interest amount, whatever this is, interest amount is paid, parallelly there's a tax saving. So net off, if you see, only this 21 rupee will be considered as a cash outflow from the viewpoint of the company. Correct? Because only because I'm paying the interest, I'm able to save this 9 rupees. So net off, every year I will say I into 1 minus T is going to be my cash outflow. Clear with this? So I will not consider 30 rupees in my cash flow equation. I will consider 21 rupees in my cash flow equation. Are you able to understand? Core important fundamental concept. Done, guys. Done, right? Now, on this note, we can get started with this chapter properly, right? So now let's take the first source of finance. What is the first source of finance? Debentures, right? Debentures or any kind of debt instrument. Cost of debentures. This is what we are going to see right now. Shall we get started, guys? Shall we get started? So debentures as an instrument, you know, the nature of debentures is what? So generally, there is a contractual obligation. It is basically a type of loan, but bundled as a security, correct? It also has the characteristics like face value, your redemption value, and all of that. The only thing here is that you pay a fixed amount of interest, as we just saw, correct? And this interest is what? Tax deductible in nature. So there is a tax saving on that also. So based on the redemption or repayment of principal on maturity, debts or debentures can be classified into two: irredeemable debentures and redeemable debentures. Yeah, we saw in the time value of money concepts, right? We saw some numerical problems. Some debentures were irredeemable, some debentures were redeemable. We solved some sums, you know, based on some instruments and all. We saw for equity, preference, and debt. Now, debentures can be irredeemable in nature. Debentures can also be redeemable in nature. By the way, in India, can a company issue irredeemable debenture? Can a company issue irredeemable debenture? The answer is yes, it is allowed. You need to take some special permissions, but then it is allowed. Clear? So irredeemable debentures are also allowed. Now, sir, then the same next question. Sir, if you only told no, sir, so which means the investor will put his money and he will never get it back, only interest. So then how will it be possible? You have a parallel market even for debentures, that's called as a debt market. You can't find that in your equity market. There is a parallel debt market where you can buyers and sellers meet. There is a secondary market for debt. It's called as debt market. In the debt market, the transactions can happen. That debt market is present in order to provide liquidity to debentures. Are you able to understand? But it is not as volatile as your cash market. Cash market is basically equity market, right? In markets, we have multiple segments like cash segment, F&O, and other things. But all those things are not required. But right now, understand that this is also possible. Okay, so fine. Coming back here, that was a practical insight. That's about it. Now, in case of irredeemable debenture, first let us take no mugging up, guys. No mugging up. Now, bring in that concepts of time value of money, left, right, and center. That is what we are going to see in this chapter. Fine. Shall we get started? Now, in case of irredeemable debenture. Now, guys, now you tell me irredeemable debentures. Okay. Now, what happens in case of irredeemable debentures? So, the same equal amount of cash flow will be paid up to perpetuity. Correct? No? Correct? No? So, can I say the present value of the debenture? Correct? The present value. How will you calculate the present value of an infinite equal cash flow? What is the formula for that? Infinite equal cash flow. What is the formula for that? Annual cash flow. Very good. Divided by discount rate. Correct? Correct? Now, in this case, the present value of debenture, can I call it as net proceeds? Because that is the amount that I get today from the investors, adjusting for any flotation cost. So technically, from the viewpoint of the company, that is the amount it receives. Can I say this is equal to what is going to be the annual cash flow in case of debenture? Every year, the company needs to pay interest. But wait, parallelly, there's a tax saving. So the net annual cash flow is going to be I into 1 minus T. Correct, guys? Divided by discount rate. What is the discount rate? In case of debenture, the discount rate is called as KD. Correct? So can I say this is nothing but divided by KD? Guys, correct? Or cross multiply this. Can I say KD is equal to I into 1 minus T divided by net proceeds? That is the formula that they clear with this. Very logical. Very, very logical. It's a crime to mug it up. That's what I keep telling you. It's all logical here, loaded with concepts. Clear? Where KD stands for cost of debt after tax. How are you saying it after tax? Because we are adjusting for the tax shield here, right? I is the annual interest payment here. It's not the rate of interest. It's the actual interest amount, right? It is in rupees. Then NP stands for the net proceeds of debenture or the current market price. I will come to that, right? And T stands for the tax rate. When to take the current market price, when to take the net proceeds, I have a separate in the doubt buster session. I've in that segment I've kept it. Don't worry about that. But as of now, you just understand. Net proceeds stands for what? Issue price adjusting for flotation cost. That is the same concept everywhere. Here with this net amount the company receives today. Are you able to understand this? Any problem here? Any problem here? No. Now on that note, shall we get started and shall we do one numerical problem here? right? But before that, guys, once again, so what is the formula for KD? KD is equal to, in case of irredeemable debenture, I into 1 minus T divided by net proceeds, correct? The logic for this is all the time value of money concepts I told you are simply, sir, I didn't know time value of money, sir. Is there another way I can remember? Very simple. Look at this from the viewpoint of the company. What I pay divided by what I receive. From the viewpoint of the company, what it pays, interest into 1 minus C. So net of the cost is post-tax only, divided by what it receives, net proceeds. Simple logic. Clear with this, guys? As simple as that. Clear with this, right? Learn it conceptually. That's about it. Fine, guys. So on that note, shall we go and do the first question? Yes, please take your solved question bank. Let's do the first question here. It's on page number 5. Please take the first question. Shall we, guys? Yes. Now, the first question here. A Limited issued 30,000 15% debenture of rupees 100 each. The cost of the issue was 30,000. Cost of issue means what? It is going to be flotation cost. Cost of the issue was 30,000 rupees. Determine the cost of debenture capital if they were issued at scenario 1 par, scenario 2 premium, and scenario 3 a discount. Clear with this? Now, first, guys, now this is a clear-cut case of irredeemable debentures. How do you know? Because they have given debentures. Have they given the life or the period has been given? Guys, no. When the period is not given, you can definitely assume it to be irredeemable in nature. Clear with this? Now, what do we do here? What do we do here? So now, what is the formula? Simple. What I pay upon what I receive. I into 1 minus T divided by net proceeds. Guys, correct? Now, in case it has been issued at a par. Now, guys, one thing. Please, attention here. 1 second. Yes, 1 second here. Now, you can do the calculations of all the KD and all these things, calculations. It can be done on a per debenture wise or per share wise. Or you can do the calculation for the entire value also. You can take the total and you can do it, or per share wise or per debenture wise also the calculation will be, you can do it. The answer will be the same. Not a problem. Now, in this case, we are doing it on a total basis because flotation cost is not given on a per debenture level. It is given in total. Correct? So what we can do is, now in this case, you tell me what is the total annual interest payout by the company. They have issued 30,000 debentures. Correct? It is carrying a coupon rate of 15% and the face value of every debenture is 100. So can I say the total interest payout every year is going to be 30,000 debentures into 100 rupees. On that 15% is being paid. Every year the company is paying an interest of how much, guys? Every year the company is paying an interest of how much? 4,50,000. Correct? Now suppose the company is issuing it at par. What happens to the net proceeds? How much will the company actually receive? 30,000 shares, or 30,000 debentures into 100 they will receive. Correct? 30,000 into 100. But minus, you have a flotation cost of 30,000. So the net proceeds will be how much? 29,70,000. Guys, correct? Correct? So now, so you just apply the formula. Interest 4,50,000 into 1 minus tax rate. In this question, the tax rate is not given. Clear? So assume it to be 0. If that is not given, then it's 0. That's all. Right? So interest into 1 minus tax rate divided by net proceeds. So in this case, my cost is going to be how much? 15.15%. Are you clear with this? Are you able to understand this? Take your calculators out and do this. Quickly, I'll give you some 10 seconds time. Quickly do this. Quickly do this. Digest the facts. We'll move on to the next step. Done? Done? Now, guys, all the calculations are exactly the same. But in case the company issues the debentures at a premium of 10%, what will happen? Only the denominator, net proceeds will be different. Correct? Every share is now issued at 110 rupees. So 30,000 into 110 minus 30,000, net proceeds will become 32,70,000. That alone you put it in the denominator. Everything else will be the same. So now the cost becomes what? 13.76% is going to be your KD. Are you able to understand this? Right? Suppose the company issues this at a discount. What happens in that case? Once again, here, the only difference is going to be what? The denominator calculation. So here, what is going to be your net proceeds? 30,000 into 90, right? Minus 30,000. So that's going to be 26,70,000. This alone will change. So the net cost is going to be how much? 16.85%. Are you clear with this? This is going to be your KD calculation. Are you able to understand this, guys? Any problem, any difficulties here? No? Right? And that's about the sum, and that's about this concept. Clear with this, guys? Right. Now, now you have your notebook, right? You have your notebook, right? Perfect. Now go to the last page of this notebook and give it a title. This is something that I only tell you one time, right? And after every sum, you need to do this. Give that page a title called Library of Adjustments. Library of Adjustments. Guys, quick. Don't waste time. Do it quickly. Okay. Now on the top have 4 columns: chapter number, question number, page number, small columns. Adjustment alone, you have a big column for the entire length of the page. Only one time I will tell you this. After every question, you need to give all the numbering. Adjustment alone I will dictate. Okay, right? Now, what is this, sir? Every question we discuss in the class. For time value of money, I didn't do it. That's why I mentioned it on the top of question, because that is not a part of your syllabus actually. But I introduced the chapter in order for you to understand or give you a perfect launching pattern into the subject. That's all. Now, now, for example, what is this chapter? Cost of capital. As per our book, this is chapter number 2. Question number 1. It's on page number 5. Give me the solved workbook, solved question bank page number 5. Page number 5. Now, adjustment, I will dictate, write down. Cost of irredeemable debenture hyphen direct. Cost of irredeemable debenture hyphen direct. Guys, quick, very quick. Cost of irredeemable debenture hyphen direct. Now, what happens? You have written it. Every sum we actually do in the classroom, I will be asking you guys to update. These 3 columns you need to update. This alone I will dictate and I will move on. Now, by the time we finish the batch, once you have a look at it, please don't write this on top of the question, or please don't, in the book and all, you don't write this, right? Please don't write it in your book. It defeats the purpose. Don't write it in the book, or don't write it at the back of the book. No, have it in your separate notebook, that too in the last page. So I asked you guys to maintain one 400 pages long sized ruled notebook for you to go home and solve all the sums independently, right? You guys are having it, no? Yes. Very good. So in that book, you take the last page and you do it. From the reverse you come, it's okay. So from the back you come, it's okay, not a problem. You need not leave any spaces. Last page you take and you come from the reverse, it's absolutely fine. Why am I doing this? Imagine the day before your exam. Let us say you want to just revise on one particular topic. Let us say KD related sums. You need not take the pain in referring and turning pages. Open this book. You will have a ready reference of everything. This adjustment is also there. Which sum you want? Oh, this sum. Okay, this was the unique adjustment we saw. This alone, somehow I'm not confident. You open that page number, revise that sum, and you're done. So this way, the entire subject can be revised 3 to 4 times a day before your exam, provided you have worked on it during the course of watching the lectures. If you watch the lectures like watching a web series, rather I would say you don't watch it at all, right? I've seen people binge watching, like lying like this on popcorn. Also, you will ask, don't do all that. Be sincere. If you are not watching the lectures sincerely, then it's of no use. So why am I telling you this is all your effort. By the time once the batch gets over and you'll have a look at this, you yourself will see the power of whatever consistent efforts that you've put. It would have snowballed into such a huge amount of effort, wherein then you will realize we covered so many sums in the classroom. This is the power of dedication and consistency. Please gift yourself that. That's all I'm asking for, right? And if you write it on top of the question then and there, it will not work out, because tomorrow the objective of this is all the questions discussed in the classroom should be in one place. If you write it on the top, once again you need to turn pages. What is the point then? This, please do it properly. Clear with this, guys. Everything else I've given it. This alone I wanted you guys to do it. That's the reason why I'm taking the time right now and explaining what is what, right? And that's about the library of adjustment. Now henceforth I will only dictate the adjustment. I will ask you to update, right? And guys attending here, in case I miss out on a question, if I go to the next question without dictating it, please stop me and ask me to do it. Okay, fine guys. Shall we move on to the next question? Now, I'll just go to the next question, which is question number 1A, right? I am doing this question for a reason. Now look at this. 1A, as I told you, the color coding, this background of this color, the background color of this question is different. And I'm also giving it a unique numbering called 1A. Reason is, it is very similar to question number 1, except for one minor change, right? This minor change alone, tomorrow when you're revising, if you look at it, you were sorted for the sum. You need not go through the entire sum once again. What is that? I will tell you right now. 5 years ago, Sona Limited issued 12% irredeemable debentures at rupees 103. That is at a premium of 3 rupees. 100 plus 3, 103. 3 rupees premium to the par value of 100. Fine. The current market price of these debentures is rupees 94. If the company pays a corporate tax the rate of 35%, calculate its current cost of debenture. Now guys, don't look at the solution. Don't look at the solution. Whenever I'm handling a particular sum, you read the question, your eye should not enter into the solution, because if it goes, you are actually killing that thinking power. You are killing your own thinking ability. Don't do that. It's okay to make a mistake here and rectify it, right? Then you take a red ink and you can write down something. But if you look at the solution, it means that it will immediately go off. That's all. It will not stay. That's the reason why I'm saying. Now, you tell me, the formula for KD is what? What I pay upon what I receive. That is I into 1 minus T divided by net proceeds. In this case, what is your I? Every year the company pays 12% on 100, 12 rupees. Correct? Into 1 minus T, 1 minus 0.35 divided by what is going to be the net proceeds in this case? Can you tell me? Quick guys, quick. What is going to be the net proceeds in this case? Now they have given this figure. The company issued, right, 5 years ago, the company Sona Limited issued the shares at how much? Debentures at how much? 103 rupees, right? This was the actual issue price. So many of you might think that it has to be 103. It is not 103. It is going to be 94. Now, why? Recall the very first line of this chapter in our concept decoder that I gave. Guys, all this is not there in the material, even which I have given. Please write it down somewhere. Very important understanding. 1 second. It's loading. What did I say? Cost of capital is a return expected by the providers of capital. Now, in this case, what happens here is, 5 years ago, the company issued this debenture, right? Now, we are not doing a post-mortem work of recording what was the cost that I already incurred, that everyone knows. Clear? The intention of this chapter is, today, if I'm going to the public with this issue, what will be my cost? Are you able to understand this? I repeat, today, if I'm going to the public for issuing this debenture, what will be my cost? And hence, in this case, past data is irrelevant. If I'm going today, how much will I receive? Only 94, because prevalent in the market, the current market price is only 94. Current market price for debenture house, sir, just now I told you there's a debt market available. Guys, are you able to follow this? A very important and a critical understanding that you need to have. Able to follow this? Yes, write it down somewhere. Write it down somewhere in a way in which you understand. But remember this, past data is irrelevant, and we are not in a subject to record the actual cost. We are in a subject that takes a decision which is futuristic in nature. So even though this is an existing debenture, a past debenture issued, the intention of calculating KD is to know what will be the cost of debenture in case I go to the market today for raising this money. Are you able to understand? Many students are actually struggling in this area because they don't know. The first thing they struggle in this chapter is from whose perspective you are computing. The second struggle is, having said that, sir, why the actual thing is not given? Because I always tell, if nothing is mentioned, first preference for net proceeds, you should always take the issue price. If issue price is not available, then you should take the current market price. But in this case, it was a past data. It is not a current issue price. It was a past issue price. The share was issued some years back. We are not here to record the actual cost. We are in a subject that takes a decision which is futuristic in nature. Are you able? This is a very, very critical understanding. This explanations and all is not there in the study material, institute study material also, but they have done it like this. The doubt here is why the background concept is what. This is the value addition that you get in the lectures. This is not there in the book. Clear with this? Write it down somewhere. Fine, guys. Done. That's about this particular question. Go update your library of adjustment. Give the reference 1A, page number and all. I'm just telling you this. Write down cost of irredeemable debenture hyphen use CMP as NP. Use CMP as NP. Use CMP as NP. CMP means what? Hello. Current market price. As NP. NP means what? Net proceeds. Put a semicolon. Semicolon is like this. Semicolon. And write down ignore old issue price. Ignore old issue price. Now just imagine the day before your exam, one look at this library of adjustment, you will know what was the discussion that happened in the class. You will be able to relive the classroom moment. Correct, guys? That is the reason why I'm asking you to prepare all this library of adjustment. Done? Move on to the next question. Move on to the next concept. Done? Yes? Perfect. Right. See, I have handpicked certain sums. Those sums I'm doing. If you are doing these lineup of questions, any other question you will be able to handle. That's how I have lined up the question for the fast track course. Right? Fine. Let's go on to the next one. So I told you debentures are of two types. One is your irredeemable debenture. The other one is called as redeemable debenture. Right? Okay. Now let's move on to the next one, which is called as redeemable debentures. Now, redeemable debenture means what? Debentures that have a finite life, which means what? I am issuing this debenture with a life of, let us say, 10 years, right? Which means what? Today I receive the money from you. You means what? An investor, right? For the next 10 years, I will be paying you interest. At the end of 10th year, I will also repay back whatever amount I took it from you. Correct, guys? But remember, the issue can be at par premium discount. Even the redemption can happen at par premium discount. Are you able to understand? But I will repay at the end of the period agreed. This is the meaning of redeemable debentures, which means it has a finite life. You can frame a cash flow equation here. Guys, correct? Now, for calculating the KD of redeemable debentures, there are two ways in which you can do. The first way is what? The correct way. IRR calculation. Frame the cash flow equation, arrive at the IRR and get your KD value. KD is nothing but the discount rate applicable for your debentures. That is called as your IRR. Nothing but that is your IRR. Clear? The second method is called as a shortcut method, also known as a formula method, also known as approximation method. One straight away formula you apply. If you apply this formula, you will get the final answer. This is your KD, right? But that is not the exact KD. That is an approximate KD value. Are you able to understand? First, we will do the IRR method. It is popularly known as YTM method. YTM stands for yield to maturity. Write down somewhere, yield to maturity. YIELD, yield to maturity. Right? Yield to maturity. Always remember, guys, whenever they use the word yield, it stands for IRR. You need to use the method of IRR. There is one more yield to maturity model in equity KE calculation. So remember, yield stands for IRR generally. Clear with this? Now, how do we do this? I will take an example and I will show it to you. Now, guys, just focus. I just want your participation. That's all. All these notes will be given to you. Now, let us assume the period of debenture is going to be 10 years. Okay. Then the coupon rate. Coupon means what? Coupon rate means interest rate. This is not your IRR. It is an interest rate. This is not discount rate. It is an interest rate, 10%. Okay. And let us assume that the issue price, in this case, I'm also calling it as the net proceeds. Assume no flotation cost and all. Issue price is, let us say, rupees 900. Right? The face value of the debenture is going to be rupees 1000. And I am saying that this is redeemable at par. Redeemed at par. Okay. This is the scenario that I am giving. I am asking you to calculate KD. What will be the KD? Guys, clear with this? Please participate. That's all. It is more than sufficient. Right. Now, first thing, in this case, it is a case of debenture, right? And you have a finite life, means what? It is redeemable at par. Now, I need to calculate the rate of return. Basically, IRR, I need to compute. First thing, frame the cash flow equation. It is the most important thing. Frame the cash flow equation. We are doing this calculation from the viewpoint of company. So, can I say the present value of inflow should be equal to the sum total of the present value of outflows? Or in other words, can I say 900 should be equal to what is going to be every year's interest rate? Interest 10% on 1000. How much is it? 100. So can I say it is rupees 100 ideally into 1 minus t, but in this case I'm ignoring taxes for the convenience of calculation. Okay, right? But ideally if tax rate is given, that also needs to be computed. Okay, 100 divided by 1 plus kd to the power 1. Why am I using kd? R is nothing but kd. In this case, your discount rate is called as, discount rate for debentures is called as kd. Correct? Plus rupees 100 divided by 1 plus kd to the power 2 plus so on it goes. And in the last year, you will be having what? 100 divided by 1 plus kd to the power 10 plus the entire repayment. The principal also gets repaid. So plus 1000 divided by 1 plus kd to the power 10. Are you able to understand? This is how my cash flow equation will look like. This is how my cash flow equation will look like. Guys, correct? Guys, correct? Now, how do you compute the KD? Is there a formula to compute this? Do you have a formula to compute IRR? Do you have a formula to compute IRR? You don't have a formula to compute IRR. So what do? Trial and error. So one trial, take your KD to be equal to 10% or something, right? The trials will be given generally in the question. Calculate the NPV. Pray God that you should get equal to 0, right? Or in other words, can I say 0 is equal to, so the same thing, present value annuity factor of, okay, I'm just putting this as a single equation, rupees 100 into present value annuity factor of KD percentage for 10 years, correct? Plus rupees 1000 into present value interest factor of KD percentage for 10 years, the whole minus rupees 900. Agreeing on this. This is the cash flow equation. This is the sum total of outflows that I pay. Correct? That is from the perspective of the company. I'm netting off the two, inflow minus outflow I'm doing. So this sum total can be rewritten as follows. 100 rupees annually for the next 10 years. 100 into present value annuity factor for KD percentage. I need to calculate that for 10 years. That gives you this sum total. Plus 1000 happens only once. So 1000 into present value interest factor of KD percentage for 10 years, right? Minus 900 is equal to 1000. Or in other words, I need to calculate that KD percentage that makes my NPV equal to 0. That is called as IRR, no? Guys, yes. Are you able to understand this? Are you able to understand this? So how do you do it? Trial and error method. That's the only way to do it. Having gotten the two values of NPV, you use interpolation and find out the answer. Now quickly let me do it. Let KD is equal to 10% I'm taking, right? Now what you do, you apply this factor. I am just arriving at the NPV values. So I know that it is rupees 100 into, so present value annuity factor of 10% for 10 years, annuity table, you can actually calculate it in your calculator also. 1 divided by 1.1 is equal to, you put 1 m plus 2, 3, 4, 5, 6, 7, 8, 9, 10. You get 6.144. So is equal to m plus, is equal to m plus, is equal to m plus, like that 10 times if you do, and finally you do MRC, you will get the final value, present value annuity factor comes out to how much? 6.144. Are you getting it? Are you getting it? Yesterday I taught you the same thing, no? How to use m plus MRC in your calculator. Directly you can do, but don't worry, all these calculations will be given in the question, right? But I'm just teaching you how to do it once again, right? I'm revising that, that's all. Plus rupees 1000 into present value interest factor of 10% for 10 years. Again, 1 divided by 1.1 is equal to, is equal to, is equal to, is equal to, like that. If you put 10 times, you'll get into 0.322, right? The whole minus 900. If you do the calculation, I think finally you will get a positive 100 rupees. This will be your NPV. Guys, clear with this? This is computation driven. Don't worry about it, right? You do the calculations if you want once again, but this is the final answer you will get. Now, can we say KD is equal to 10%? No. Why? Had KD been equal to 10%, had the 10% been your IRR, that is KD, then you would have got a final answer of 0. But what is the answer you got? 100. So you want your final answer to reduce. How will you reduce it? By increasing your discount rate. This is what we saw in the trial and error method, right? So now what we do? Now take the next trial. Let KD be equal to 11%. Sir, how do I know 10 and 11? Generally, it will be given in the question. These tables will also be given in the question. 6.144, 0.322. But I am asking you to be self-reliant. Don't be dependent on anyone in life for that matter, right? So now, in that case, the KD calculation, in this case, I'm just cutting it short, guys. You get an NPV value of minus 13 here, right? At 11%, if you do the NPV calculation, right? So you will get the value of minus 13. Similar calculation, 100 into present value annuity factor of 11% for 10 years plus 1000 into your present value interest factor for 11% 10 years. If you do all this minus 900, final answer comes out to how much? It comes out to minus 13. Guys, clear with this? Are you able to understand? I'm teaching you the concept here. That's all. Clear with this, guys? Yes. Now, in this case, what happens? I know that KD is lying clearly between the IRR. Basically, the KD is clearly lying between 10% and 11%. Guys, correct? Yes, correct. Or in other words, can I say R and NPV? If I increase my R, I'm sorry guys, this was 12%. The second trial they took was 12%. This will be given in the question. If you are taking KD, the second trial that I took was 12%. Okay, not 11. I took 12%. If you take 12% as the second trial, you get a negative NPV of minus 13. Are you clear with this? Right? What happened? Okay, well. 100 into 6.144. I'm sorry. This is not 0.32. This is 0.385 actually. Sorry, this is 0.385. I'm sorry, I stand corrected. So, see, I was not focused more on the calculation here. I wanted to drive home the logic here. But yes, this is 0.385. If you do the calculation, you get a positive 100 here. Right? You're right. Fine. Coming back here, right? So, see, this IRR, that's why I dealt with it in detail in the previous chapter itself. That is in your time value of money chapter itself. Right now, I'm focusing more on how to compute. Once again, we are just revising the concept of IRR in this KD model. That's all. Guys, clear with this? So now basically what has happened, if I keep my KD as 10%, I'm getting a positive 100. Guys, please focus here. Right? If I'm having a KD of 10%, the NPV value is a positive 100. If I keep my KD as 12%, I'm getting a negative 13. Or in other words, if I increase my KD by 2%, right, what happens here is my NPV falls from positive 100 to negative 13. It falls by 113. Correct? But I want my NPV to fall only by 100 to make it equal to 0. Correct? So for a fall of 100, by how much should my KE be increased from 10%? So it is the same calculation that we saw. So KD will be equal to 10% plus, right? If it is 2 for 113, how much is it going to be for my 100? So can I say it is nothing but 2% divided by 113 into 100. Correct, guys? Right? If it's going to be 2% for 113, how much is it going to be for 100? You do the calculation, tell me. 2 divided by 113 into 100, that gives you 1.7699 something. So basically here it is 10% plus 1.7699. You can just round it off here. It's overall, it's going to be 11.76% approximate. Are you able to understand this? Normal IRR calculation is what we have done here. Okay, you guys are able to follow this. Don't worry, I'll be giving you all this running notes. You need not have to worry about it. Just focus on whatever I'm taking here. That's more than enough. Are you able to understand? Yes, guys. So in case of a redeemable debenture, what you can do is frame the cash flow equation, take 2 trials, arrive at the IRR. Whatever IRR you get is called as the KD, because we are using the cash flows pertaining to what? Pertaining to debentures. Are you able to understand? Right? That's what they have given here. It is done by calculating your IRR. What is that IRR concept is what I have explained here. But remember, every year cash flow, what you need to consider? I into 1 minus T. Get with this. because it's not just interest, it is interest adjusted for tax rate, because that's my net cash outflow. Are you able to understand this? Right? And then I've just given you this. Clear, guys? Clear? Now there is a second formula. It's called as the shortcut method or a formula method, popularly known as approximation method. What does this formula say? What does this formula say? It says KD is equal to I into 1 minus T plus RV minus NP by N, the whole by RV plus NP by 2. Right? Easy formula, huh? So you can mug it up. I will shift to the next one, that's all. Okay, guys, very simple and logical once again. Very simple and logical once again. So how is it? Please focus here, boss, please focus here. Now, KD is equal to, as per this formula method, first one, let me tell you one thing. It ignores the concept of time value of money. It ignores. Then, so why are we calculating? For convenience sake. For convenience sake. Suppose in the question they have asked you to calculate KD and given all the facts. IRR calculation takes a lot of time. Nothing is mentioned. You can use even shortcut method and close it off. The shortcut method, sir, I need to mug up this formula. No mugging up. Very logical. I will tell you what is what. Now, what has happened? What has happened here? I just told you KD calculation, cost calculation is what? Numerator from the viewpoint of the company, what I pay. Denominator computation, what I receive. Correct? No? Logically, you think. Now, let us say we are talking about a debenture which has a life of 10 years. Okay? Right? It is issued at 10%. Okay? The face value is 100. That is what? Issue price is 100. Redemption value is going to be 110, redeemed at a premium. Okay? Done? Now, every year the company pays an interest of how much? 10 rupees, 10% on 100, 10 rupees. Correct? Just focus, that's all. Enough. Right? So, in the numerator, obviously, this interest amount will come. 10 rupees. But wait, there is apparently a tax saving. Let's say tax rate is 30%. 10 into 1 minus T. Technically speaking, 70% of 10 rupees is only your cost, because parallelly when I pay 10 rupees, there is a 3 rupees of tax saving. So this component you understood, it is the net interest cash outflow from the viewpoint of the company. Guys, correct? This is one cost. So hence it lies in the numerator. Agreeing with me on this. Next. Now, is that the only cost the company is incurring because of this? No. When I received money from this guy, from the investor, from the debenture holder, I received only how much? 100. Issue price was 100. But when I am redeeming it at how much? 110 rupees. Which means this extra 10 rupees is also my cost because I raised the money from the debenture channel. So RV minus NP. RV is what? RV is going to be 110. NP is what? It's going to be 100. Right? This extra cost of 10 rupees is also my cost. Yes. But wait, that cost is not a cost incurred every year. It is a cost incurred during the life of this entire debenture. So divided by the life of the debenture 10. If you amortize it net annually, I can say that representatively 1 rupee is the amortized cost of this difference between my redemption value and my net proceeds. Here with this. Hence, the numerator has the total annual cost that I am incurring towards my debentures. Logical, guys. Denominator is what? Your debenture capital. One more confusion. Sir, which one I need to take, sir? Because opening capital, that is my issue value, or should I take my end redemption value? No confusion. Take a simple average of the two. Yes? Yes? Now, tell me the formula for KD. Logically think, guys. That's all it takes. I into 1 minus T plus RV minus NP, but that's the total cost across the life, divided by N, whole divided by RV plus NP by 2. Now you only said the formula, right? That's all it is. That's all it is. Are you able to understand? Yes, sir. Are you able to understand? Done? Now, one more incremental. This is the formula we'll be using regularly, guys. One more incremental thing. Now there is one argument. Some people say, look, this RV minus NP is there, no? 10 rupees amortized cost that you are saying divided by 10 and all. So representatively every year you are saying 1 rupee. That is also a cost, no? Then that should also be eligible for a tax deduction. If that is also a cost for you, that should also be eligible for your tax benefit, no? If you are assuming that is also a part of your tax benefit, then you put this one, into 1 minus t. This tax shield should also be applied on this. Or in other words, you take this 1 minus t common outside, and this formula will relook as follows. I, just the interest, plus RV minus NP by N. Everything is the same. But if you are assuming this tax benefit is applicable on both your interest as well as on this amortized component of the difference between your RV and NP, then take this 1 minus t common outside and say it is applicable on both. Are you able to understand this? That's what I'm saying. Yes. If you feel, if they are saying in the question, there is not a single question like this, but this formula is there in your study material, hence I've included. But this is only for theoretical purpose. In case we don't know, institute, we don't know, suddenly they might ask and all. If they ask, if they are saying that, if both the interest payment is anyways a tax deductible expense, even this is also an expense only, from the viewpoint of the company, right? There is a section in your, section in your income tax act that says discount on issue or premium on redemption, that is also a cost. It is allowed over a period of so many years and all. It is there in your section. So if ideally that is also a cost, on that also tax shield needs to be computed. So not only on this should you apply 1 minus t, even on this value you apply 1 minus t. So that's why they have taken it common and they have put it clear with this, guys. But for that, nothing more you need. Clear with this? Should you mug this up? Should you mug this up? So simple, no? So simple. If you directly enter into it and if you just break your head, it will only break. Are you clear with this, guys? It's so easy. Fine. One last time, can you just tell me the formula? What is the formula here? First formula only. Second formula, you just ignore it. Right? First formula. What is the formula here? So KD is equal to I into 1 minus T plus RV minus NP divided by N, the whole divided by simple average RV plus NP by N. Here with this. Here with this. Shall we do sums with respect to this particular thing? Right? One sum, you will just do it here. Take the next question. To work. Call the question back. See how simple it is, provided you understand it in a graded manner. That's all it takes, guys. Always believe in conceptual learning. If you mug up, it will not work out. And that too, institute is asking questions like anything. And trust me, I'm the first person to love the way institute is being, they are testing, because, sincerely, you guys are studying the concepts. Someone is mugging up and going and they are also getting the same thing. Actually, that's not a CA exam then. Right? You should know. Tomorrow you're sitting for an interview, right? And if someone is asking you the logic of why you are calculating KD, why KD has this formula, now you will be able to tell them, right? Right? And one more thing, guys, one more thing I want to tell you. One more thing that I want to tell you. Is this formula method correct? Is this the correct approach? Is the formula method I told you, whatever I taught you, is this correct? As in, it is not the very right approach. The correct way of calculating KD is only your IRR, yield to maturity method. But we are doing this for convenience sake. I will prove to you why. Because you tell me this formula is actually not at all correct. Reason is RV, redemption value. When does it happen? At the end of 10th year. NP, net proceeds. When do you get it? Today. Now, can you directly subtract a cash flow arising at the end of the life with a cash flow arising today? Put it short, this logic defies the concept of time value of money. That's why it's called as approximation. It's not an exact value. That's the reason. Okay, now let's go and do the sum, guys. Quickly. Now it's going to be very simple. It's a cakewalk for you. A company issues, question number 2, guys. A company issues 10 lakh rupees worth of 12% debenture of rupees 100 each. Right, which means how many debentures have been issued? 10 lakh divided by 100. 10 lakh divided by 100 is going to be 10,000 debentures. Right, the debentures are redeemable after the expiry of a fixed period of 7 years and the company is in a 35% tax bracket. Required number 1, calculate the cost of debt after tax. Always remember, when they use the word KD, it is post-tax only. Why? Because tax shield is considered in calculation, no? Interest, I into 1 minus T only we calculate. If the debentures are issued at A, par, B, 10% discount, and C, 10% premium. Right? And the second part of the question says, if a brokerage of 2% is paid, what will be the cost of debentures if the issue is made at par? Now, forget the second part. Let's focus on the first part. Guys, hello, come on. Now, you leave the calculation to me. Just participate here. One last time, tell me the formula for calculating KD. Formula approach. In this question, have they asked you for an approach? Use IRR or YTM model. Did they say? No, which means what will you use? In exam, happily use your formula. Don't say, no sir, it is approximation. I will only want the get correct answer and all. Then you will have to wait for 4 more months. So don't do all that. In exam, you need to properly sit and make the best use of it. Play it smart in the exam. Do it only in formula method if nothing is asked. Clear? So what is the formula? Come on, tell me. I into 1 minus t plus RV minus NP by N, the whole divided by RV plus NP by 2, right? Clear with this? NP stands for net proceeds. Net proceeds means what? Issue price adjusted for flotation cost. From the viewpoint of company, we are calculating net amount, what I get today. Are you clear with this? Right. So now, the same formula is what is mentioned here. Now, what have they given? I'm listing out. Guys, just follow whatever I'm saying. That's more than enough, right? In this case, what they are saying, redemption value is how much? Nothing is mentioned, or have they mentioned it's redeemed at par? Nothing is mentioned. You assume it to be at par. Clear? Redemption happens at par. What is the net proceeds? They have given the first part of the question is at par. So it's going to be 100, right? Tax rate is 35%. So interest rate is going to be 12%. So in the first year, so I mean for the first part of the question, so what is going to be the KD? 12 into 1 minus tax rate, the whole into redemption value 100 and net proceeds 100. Now, is there any cost? Is there a difference between my RV and NP? No. In that case, there is no cost associated with this. That's all. Clear with this? The only cost is interest cost. Clear with this? The whole divided by RV plus NP by 2. Are you clear with this, guys? Right? Getting it? Getting it? Fine. So technically, what you get is 7.8 upon 100. This is going to be 7.8%. Guys, are you clear with this? Or in other words, can I come to a conclusion? This is just one observation. When you are issuing at par and also redeeming it at par, can I directly say for KD, the only cost is interest cost? Correct? There is no difference between the two, no? Are you understanding this? When I'm issuing and redeeming it at par, the only cost associated is what? Interest cost, right? Directly can I say KD is going to be your interest rate into 1 minus t, right? In this case, 12 into 0.7, what is this? Tax rate is 35%. 12 into 0.65, how much is it coming out to? 7.8%. That is what we got now. It is a small observation, right? Just, extra knowledge I'm giving you. As simple as that. Clear with this, guys? Now, suppose in the same question, they are issuing it at 10% discount. What happens? Very simple. All the calculations are same. The only difference is what? Net proceeds will be 100 minus 10% on 100. That is going to be 100 minus 10, which is 90. And just to substitute that alone in your calculation. Now, guys, what happens here? It is being redeemed at par. 100 rupees, but issued at a discount. Correct? No. It was redeemed at par. That is, today I'm getting money of 90 rupees issued at discount. Correct? No. I'm getting 90 today, but I'm repaying 100. Similarly, the 10 rupees of extra cost is also there here. Correct? No. Are you able to understand this? That gets captured here, and overall your KD is going to be 9.715%. Are you understanding this? Are you able to understand this? Yes? What happened? Yes? Right? The next one. Okay, so here we have done it on a per debenture level. If you want, you multiply. What will happen in that case? So how many debentures were issued? You multiply the 10,000 in the numerator. You will once again multiply the same 10,000 in the denominator. It gets anyways knocked off, right? If you want, you can do it on a whole level also. That's why I said per debenture wise or total wise, answer is going to be the same. No problem. Clear? Fine. Next, interesting part. Suppose the debentures are issued at a premium. Now what happens, guys? I am redeeming it at par only. When I redeem, I will redeem it at 100. When I received money from the public, how much I got? 110 rupees. Now, if you look at this calculation, I into 1 minus t, this is my cost. Correct? One cost. Interest cost is there. Post tax. RV minus NP. That is, what happens? I am receiving 110, but I am repaying how much? Only 100. Here, actually I am gaining. Are you able to understand? Are you able to understand? See, I am getting 110 today, but when I'm repaying, I will repay only 100. Which means Here overall, there is actually something the money earns out of this that goes on to reduce your interest cost. So here the net amount will be minus. Are you able to understand this? Are you able to understand this? So net effectively what will happen? Your overall cost will reduce to 6.067%. Are you able to understand this? Don't think here minus is some typo error. It is actually correct only. No, I received 100, but I'm repaying. So I received 110, but I'm repaying only 100. In this case, the company stands to gain. So whatever the net gain is there, that goes on to overall reduce my interest cost also. The final post-tax cost of debt is actually very, very less. It's only 6.06. Are you able to understand this, guy? Are you able to understand? See how interesting this is. A very, very interesting point. Done? Yes. Shall we move on to the next one? Yes. Now, the next part of the question says, assume that the company is paying a brokerage of 2%. Okay. And what will be the cost of debentures if the issue is at par? If the issue is at par. Now let's say we are recomputing, assuming the issue is at par, right? But the only difference is what? You have given a flotation cost, brokerage, which means for net proceeds, what will you do? Issue price of 100 minus flotation cost of 2%. Are you clear with this? Nothing is mentioned in the question. This 2% can be applied either as a percentage on your issue price or on as a percentage of your face value. I told you, no, flotation cost, you have two options. In this case, there is no problem because the issue itself is at face value only. So both will be the same. But remember, if nothing is mentioned, write a note saying any logical assumption you take and you can do it. Strictly speaking, it should be a percentage on issue price only. But I told you for examination purpose, institute is allowing both. Randomly in one question, they are taking it as a percentage of issue price. Randomly in the next question, they are taking it as a percentage of your face value. Any logic, no logic is there for that, but they are just taking it like that. Clear with this? Now, the computation, guys, what happens here? Brokerage is 2%. So the issue price is 100 minus brokerage cost is 2% on that 100. It's going to be what? 100 minus 2, 98. Now what you do here is, for all your computation purpose, you take this 98 as your net proceeds. So I into 1 minus t, correct? Plus RV 100 minus NP is 98 divided by 7, the whole by RV plus NP by 2. You get an effective cost of 8.168. Are you able to follow this? Are you able to follow this? Every single step I'm walking you through, as simple as that. Clear with this, guys? Done? Just go and update your library for adjustments. Write on. Write on. Quick. Question number 2, give all the page number referencing and write down. Cost of redeemable debenture. Cost of redeemable debenture within bracket, formula method. Within bracket, formula method hyphen. Within bracket, formula method hyphen. Par stroke premium stroke discount. Par stroke premium stroke discount. Par stroke premium stroke discount. Are we done here? Are we done here? No. Now let's go to some common doubts that students have in this area. One second, I'm just erasing all these things. Okay. Now the common doubts that students have in this area. Now, suppose they have given the question, calculate KD. Sir, should I use IRR method or should I use formula method? You can take any method in the absence of information. Preferably use a formula method to save time. Clear? That is about the first doubt buster. Next. The approximation method gives only approximate value of KD, whereas YTM method gives the accurate value of KD. Clear with this? Next. Under the approximation method, even in approximation method, in the absence of any specific information, students may use any of the two formulas to calculate KD with logical assumption. What was the two formula? One formula we assumed that only interest is a tax deductible expense. The second formula we said even the spread between my RV and NP, right? That is also tax deductible. We took that outside. Generally, we don't use the second formula. It is generally not used in any of the questions. We only use the first formula. Are you clear with this? Right? Whatever, in all the sums that we did, we only use this formula. No? Did we assume that the difference between the two is also tax deductible? Did we assume that? No, we didn't assume that. We assumed only this is tax deductible. Are you following this, guys? Yes. The next one. Now, net proceeds stands for issue price less flotation cost. What the company actually receives. Net cash inflow. Suppose in the question issue price is not given. For the purpose of computing net proceeds, first preference should be given to issue price. If the issue price is given in the question, take it. Not past issue price. Current, if they have given issue price, that you take. We saw in one question of past issue price, that is irrelevant. Past data is irrelevant for our subject. Clear with this? Suppose issue price is not given, but they have given in the question the current market price is so and so. You can take the current market price, that takes the second priority. Why? Current market price means what? Today if I go to the market, that will be the rate prevalent in the market. So suppose even if the company wants to make a fresh issue, it can only be around that price, no? Are you clear with this? That's why. Suppose current market price is also not available, then you assume that the issue was made at the face value. Are you under? A very logical and a graded assumption. Preference number 1, issue price. Preference number 2, current market price. And preference number 3 goes on to face value. These assumptions are applicable for even your equity and preference. Clear with this? That is the reason I'm spending a lot of time here, right? So if the issue price is not given, then students can assume it as equal to CMP, current market price. If that is also not given, only then you can take it as equal to face value. Suppose the flotation cost is not given, simply assume it to be 0. If tax rate is not given, take it as 0. Don't break your head with all the assumptions. Here with this. Are we done here? Are we done here? Perfect. With that, we have completed this concept of cost of debentures KD. There are some other issues which I will be dealing at the relevant point of time. It's not required at the moment. Clear with this? There is a way in which I take the subject, so I will go there, but I will do it in that way. But when you are revising, so all the KD related concepts, I've clubbed it in a single place. So you can go in this order itself. That is not a problem. But right now, for a logical flow of understanding, I will just move on to the next concept. So with this, KD is done. Done. KP is also over. KP is also over. KP is cost of preference. Exactly the same as KD, except for the fact that in KD, the cash flows will be I into 1 minus T. Here all the cash flows will just be preference dividend without adjusting taxes. That's all. The entire KP is also over. I will walk you through that. We will also do some here. Clear with this, guys? This is why I spent a lot of time in teaching you the KD concepts. KP is automatically taken care of. Done. Done. A very, very smart approach in which you can learn the subject. Done, guys. Now we will discuss KP. Don't worry, I will not directly omit. Even these areas I will not omitting. I will come back. Okay. By the way, this first topic is already done. Amortization of debenture or bond. Last question of time value of money chapter, we did know every year over the span of 8 years, it gets repaid. In that case, how will you arrive at the present value of the bond? You need to prepare that cash flow statement every year, 125 rupees. You remember 1000 divided by 8 and all we did. That is what they have mentioned in the study material by way of formula. We did one sum at the time value of money level itself. So ideally, this is also over, right? I just gave it as one. See, till now, whatever we've seen here, it is a single shot payment. Issue and redemption happens only at the end of the life, correct? Whereas there can also be cases where the debentures can be amortized over the life and all, right? If that scenario happens, right, what should you do? Here I've just given a reference. Maybe you can write down here. Just pull an arrow and write down. Refer TVM chapter, question number 9, I think so. Last question, huh? You write it in your book. Please write it in your book, right? Refer this TVM chapter, question number 9. You can just write it there, okay? For a practical illustration on. So interest will be computed only on the opening balance. WDV method and all we did know. Guys, amortization table. Yes. Yes. Fine, guys. Done. Shall we move on to the next one? Shall we move on to the next one? Perfect. Let's go on to the next one. It's called as preference. Done. Now, preference shares. This is another source of finance for the company. Agree? So a company can choose to raise money even from the debenture, the preference route. Now, preference shares, I call this as an hybrid animal. It is an hybrid animal. Why? It takes one character from equity. It takes one character from debt. It is like cat on the wall. It doesn't have any decision. It doesn't have a separate, nature by itself. It takes one nature from one guy, another nature from another guy, and it calls itself one zombie. That's all, right? Basically, what is that nature, sir? preference share capital, it takes the nature of a fixed dividend payout. You need to pay a fixed dividend. It needs to be paid generally, correct? Right? That way it is similar to your debt, correct? But it is not just that. It has some features like participating, preference shares. Suppose in certain case, preference shares can also come with some limited voting rights or something like that. There are some features bundled along with it. To that extent, it is similar to equity. That is the reason why the amount that is getting paid to the equity preference shareholders are called as dividend and not interest. And on top of it, what happens here is this amount is also not tax deductible. It is not tax deductible, no. Strictly speaking, preference shareholders are also outsiders. For namesake, you call them as shareholders, right? Always, general thumb rule, generally, these fixed preference shareholders are also having some equal, they also get some same, fixed amount of dividend gets paid. Even debentures also get paid fixed amount. So why should we have this instrument called as preference? Doubt is there or not? Always remember, the cheapest source of finance is only debt. KD is always the cheapest source of finance. KD will always be lesser than KP and KE also, right? Then why do we have this? Tell you, some companies, when a company is going for bank loans or when they are going for projections, when they are even approaching public and all, there are some parameters like debt equity ratio, right? For those parameters, this preference gets classified under the equity component. So some money, somehow if the company wants to maintain those parameters, for that purpose, they don't mind paying this extra money, but they just want this amount to be parked under the preference route. That's the reason why it is one residuary source of finance which generally companies fit into. That's all it is. Ideally speaking, it's not required. This is actually the core of finance. This is the reason why the top CFOs, the top bosses, they do a trade-off between, I am incurring some extra cost, but that's okay. Only if I do this, I know all my parameters are getting fitted. I can go for a bank loan, or I can raise money from public, or some investors will be attracted towards my company. For that purpose, they use it. This is a logical and a practical application of corporate finance in your real life. Maybe if you're sitting for an interview tomorrow and someone asks you this, you can give them, they will be shocked if you know all these things, right? Fine. That is the reason. Else, what is the purpose? Always the cost is more, no tax deduction. Why should I go for preference? I will go for debt itself, no? Clear with this. One more reason is that anti-dilutive effect. These guys don't have a control in the company. So if I issue this amount as equity, you can say, sir, you are not issuing it as debt because the company wants to maintain debt equity ratio. Then issue it as equity, no? If I issue it as equity, then they will sit in all the decisions of the company. I don't want them. I want them to remain as outsiders and still fulfill all my parameters of debt equity ratio and all those other things. Hence, I call them as preference shareholders for namesake, and I keep it. Are you clear? So if I am assessing one company, in my opinion, based on what decision I want, I will classify preference only as debt component. If I am looking at a debt equity ratio, that's what I will personally do, I'm saying, right? Or depending on the nature of decision that I want to draw on the company, I will categorize it either as equity or as debt as per my choice. I am telling you personally, when I do all these kind of analysis, that's how I do it. Depending on the objective you want to achieve, I will give the result accordingly. That's how I do it. But for all your examination purposes, right, this is how things are, and I'm just explaining you why preference as a source of finance is there. Clear with this? All these are actually only for namesake. This is actually kept as a saving clause for many top bosses, top finance bosses of companies, right? They do all these things only for the purpose of fulfilling or attracting the external investors. I have personally prepared prospectus for companies like projections and all that. Nothing will be there in the company, right? That's all it is there. So now no figures are there, but basically I've sat in the groups where they actually prepare this prospectus and all, but it is all based on the potential. That's how you actually evaluate a company, not purely based on the past data. So they give all these things, and they also mentioned this. In that case, the banks and all will look for this debt equity ratio and other analytics. For that purpose, as a saving clause, they keep. But anyways, guys, coming back here. So this is all it is. So are you all able to understand that this concept of preference is basically a hybrid annual? It takes one character from equity and one character from debt, right? They pay dividend at a specified rate, and the payment of dividend are not charged as an expense, but they are appropriation of profit after tax. We saw all those explanation before, right? And hence dividend paid to preference shareholder does not reduce the tax liability. Now, exactly like how debentures are, even preference can be of two types: irredeemable and redeemable. Correct? No, right? Redeemable preferences, irredeemable preferences. Now, in case of irredeemable preference, what will be the formula? Now you tell me from the viewpoint of the company. Every year the company is paying what? Preference dividend. Correct? Right? So now basically the same formula, what I pay divided by what I receive. Correct? What do I pay them? Preference dividend. Into 1 minus T will come? No. Why? Because this is not a tax deductible expense. The entire amount I pay these guys is actually my cost. Correct? Divided by what I receive. This P0 is nothing but the value of the preference shares today, or you can also call it as net proceeds. You can use the word NP or you can use it as P0, not a problem at all. Are you clear with this? Even similarly, the net proceeds of your debentures, it is popularly called as B0. People call it as B0. B0 means what? The value of bond and debentures are ideally the same. So this net proceeds, whatever is there, for bonds or debentures, they call it as B0. Some people call it as B0. B0 means what? Value of bond as at year 0, as at present. Are you able to understand this? Right? B0, P0 and all, these are some terminologies that are associated with the net proceeds of the respective instruments. Are you able to understand this? Right? So that's about this area. So the formula application, are you getting it, guys? So irredeemable preference shares. So the formula is going to be what? Preference dividend, what I pay upon what I receive. Preference dividend divided by net proceeds. Annual preference dividend, this is in rupees, right? Divided by net profits, this is also in rupees. Rupees in the numerator, rupees in the denominator. So it is expressed as a percentage. You can also write into 100 if you want. Clear with this, guys? Done? Done? Suppose we're talking about a redeemable preference share. How will you compute the KP for redeemable preference shares? Again, two methods of doing it. The correct method is what? IRR. IRR method. Finite cash flows. Correct? You can frame the cash flow equation. Only difference is what? Every year, instead of I into 1 minus T, you will just be having preference dividend. Correct? No? Right? So initial inflow is equal to sum total of all the initial outflow. I just showed you the IRR computation. Take two trials, interpolation, arrive at the IRR. Correct, guys? Right? Or an alternative method is what? Formula, approximation, shortcut method. Now, you guys tell me what will be the formula for your preference dividend. KP formula, what will it be there? Exactly on the same line. Whatever we saw there, it is exactly the same. Whatever we saw for KD, it is exactly the same for KP also, with the only difference that instead of interest, you will be having what? Preference dividend. So what will be the formula here? Come on. Preference dividend plus same RV minus NP, but this is the cost for the entire life divided by life of it, N, the whole divided by RV plus NP by 2. As simple as that, and that's what they're saying here. Yeah, with this, very, very logical. Now here you don't have an alternative thing, assuming this is tax deductible and all, that is not there here, because nothing is tax deductible. Here with this, guys. Here with this, guys. So here it is preference dividend plus RV minus NP by N, the whole divided by RV plus NP by 2. With that, KP itself is over. Right? And this is what I've given here in this particular area. In the absence of any specific information, use either YTM approach or approximation method. An approximation, it gives only approximate value. Net proceeds means issue price less flotation cost. If issue price is not given, then you go for current market price. If that is also not given, only then you should go for face value. As simple as that. And suppose flotation cost is not given, ignore it. Suppose flotation cost is given as 1% or 2% and they have stopped it there, either applied on whatever issue price you have considered or applied as a percentage of face value. Done. That's about this area. Clear with this, guys? Shall we go to the sums and do this? Right? Let's go and quickly do this. Guys, if you learn it conceptually, I'm telling you, you guys will thank yourself for a lifetime. That's all it is. Done and dusted. Right? So it's going to be question number 3. Yes. Quick. R Energy Limited is using preferred stock. Preferred stock means what? Preference shares. Okay, this is all some American English. They use this preferred stock and all that, right? At 100 rupees per share, with a stated dividend of rupees 12 and a flotation cost of 3%, what is going to be the cost of preference? Now, first, what is the life of preference shares here? Come on, guys, don't jump into the calculation. First, read the question. What is the life of the preference? Not given. Then it is what? It is irredeemable. In that case, which one? First thing you need to do is read the question. Don't jump into the question first. Read it. Classify which category of instrument it is. Irredeemable, redeemable. This is irredeemable. In that case, simple formula, annual cash flow divided by discount rate is the present value. Or in other words, if you cross multiply, you'll get that. Annual cash flow divided by your net proceeds. Or in other words, what you pay by what you receive. Preference dividend divided by what? Your net proceeds. Or in other words, you can call it as P0. What is the preference dividend? 12 rupees. What is P0? They have said 3% flotation cost. Issue price is 100. 100 minus 3, 97. Answer is 12.37. And that's about this question. Go update your library of adjustment. That's all. Write down. Give all the cross-referencing. Question number 3, page number and all that. Write down. Cost of irredeemable preference shares hyphen direct. Sorry. Cost of irredeemable preference shares hyphen direct. Done. Shall we move on to the next question, guys? Quick. We don't have time to waste. Done. Let's move on to the next one. Take the next question, number 4. Preferential Limited issued 30,000 15% preference shares of rupees 100 each, redeemable at a premium of 10% after 20 years. Now, do we have a finite life here? Is it redeemable? Yes, right? Guys, first you collect the facts, then you can do the calculation. Read the question. See, even in, you guys follow cricket, right? Fine. In cricket, if you see, the way the success rate of a batsman shot depends on the way he reads the ball. When it gets released, the way he releases it, whether the shining side is on the top or it is on the bottom, the way he releases it, depending on that, the batsman will know how the ball is going to swing or how the ball is going to spin, and accordingly he will decide on the shot. It should happen in a millisecond. But always, if you see batsmen, they focus more on actually how the ball gets released. That's why, there's a West Indies bowler called Sunil Narine. He will cover the ball so the batsman does not know, right? Or some people put it in the back. So that is applicable in real life. The way you approach your question depends on the way you read it. Spend time in reading. Don't take your calculator and immediately jump to it. Collect the facts. That's why I keep telling you this. So if you give me 6 hours to chop down a tree, I'll spend the first 4 sharpening the axe. Remember that. Don't jump to the execution. Most of the times you will not be successful in it. Spend time in reading it. The more time you spend on the question, lesser will be the time you spend in the solution. So don't jump to the solution right away. Read, collate the facts, and then you jump into it. It will just be in a jiffy. Now we spent all this time, in learning the concept. In questions, how much time are you spending? Just like that, we are able to do it. It's a smart way of actually approaching anything in academics, right? Do that. Fine. So now they've said they've issued 30,000 shares, 15% the dividend rate, and the shares are each valued at 100 rupees, redeemable at a 10% premium after 20 years. The issue management expenses were how much? 30,000 rupees. And what do you mean by this? It's a flotation cost and it is given in total value. So which means in this sum, we will do the calculations for total, right? Fine. Find out the cost of preference share capital if they are issued at a par, premium and discount. Now, what is the formula for KP calculation? Come on, tell me guys. Once again, don't look at this. KP is equal to formula. Preference dividend plus RV minus NP by N, the whole by RV plus NP by 2. Right? Now, in this case, in all the 3 cases, redemption value is going to be 110. Correct? They have given it, redeemable at 10% premium. 3 scenarios is only for the issue price. Correct? This is why I said spend time here, not there. Most of the problem happens only if you don't read the question. Right? Don't jump to the solution. That's why I'm telling you. Please understand this. Okay. So now what happens here? Case 1, it is issued at par. Guys, what happens? Preference dividend 15 rupees into 30,000, 4,50,000. This will not change in any of the 3 methods. Correct? Redemption value 110 into 30,000, 33 lakhs is going to be the total redemption value. Will this change? No. All the three cases, it is redeemed only at a premium. NP alone will change. Net proceeds, if I'm issuing at par, what will be the net proceeds? 100 rupees into 30,000 minus this 30,000 is nothing but what? This is going to be your flotation cost. Correct? No, it's an outflow. The net amount that I'm going to receive today is going to be 29,70,000. Guys, correct? You just need to apply the formulas here. So your dividend plus RV 33 lakhs minus NP 29.7 lakhs divided by the life 20 years, the whole divided by RV plus NP by 2. If you do this calculation, you will get 14.88%. As simple as that, right? So first, know the formula logically. You can write it here. Second, read the question properly and collate each of the ingredients of the formula. And third, substitute the formulas with this particular ingredients that you've calculated. How can you make a mistake? The problem is, if you jump to the solution directly without spending the time in your answer, entire thing goes for a toss. Trust me, guys, 4 months is no joke. 4 months is no joke. And don't blame that CA course is a tough course. No. It's, 80 to 90% of things are here. We know that they are all avoidable mistakes, but still we do it. Simple. If you are doing it, try to avoid it in future. As simple as that. We all make mistakes. Let's learn from it. Clear with this? Fine. Now let's go to the other one. Suppose in case I'm issuing it at a premium of 10%, preference dividend will be the same. Redemption value will be the same. The only change is on the net proceeds. Instead of 100, it's going to be 110 into 30,000 minus this rupees 30,000. So as a whole, it's going to be how much? 32,70,000 rupees is going to be your net proceeds. Substituted here, preference dividend plus RV minus NP. NP becomes 32.7 lakhs by N, the whole by RV plus NP by 2. Clear with this, guys? You get how much? 13.744%. And similarly, if it's going to be at a discount of 10%, preference dividend redemption value, no change. Only in the net proceeds you get a change. What is it? 19 to 30,000. Right? Minus the 30,000 of flotation cost, you get 26.7 lakhs. So it's 4 lakh 50 plus 33 minus 26.7 lakhs, the whole by 20, the whole by 33 plus 26.7 by 2. So you get a figure of 16.131%. Everything is same. The only difference here is with respect to calculating the net proceeds, because they have said here the issue is at par premium discount, right? Please mark that you've made a mistake, means mark it somewhere there. You've made a mistake here. Know that this should not be repeated. That's why I'm saying don't jump to the solution. Clear with this, guys? Any problem here? Any problem here? Very simple. Suppose in this question they have asked us to do this using IRR method, then what you need to do IRR method, frame the cash flow equation, step number 1. Step number 2, what you need to do is you need to take 2 trials, right? Generally, the tables for these 2 trials will be given in the question. With that, you take the 2 trials. Once you take those trials, you'll get one positive NPV, one negative NPV, interpolation, you arrive at the final. Here with this. Since in this question they have not given any specific instruction method to be used, you can follow any of the methods. Clear with this, guys? Done? Just go and update your library of adjustments. Write down. Previous question you noted down now. Write down. Cost of redeemable preference shares within bracket formula method hyphen par premium and discount. Par premium discount. Par stroke premium stroke discount. Done? Perfect. Okay. Fine. So with that, I am concluding this session because I want to start KE in the next session. KE is the most important aspect of the entire chapter. So I will start KE and on a fresh note in the next session. So on this note, I am concluding this session. Please revise till whatever we have covered till now, and I will see you all in the next one. Thank you all so much. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now let's continue our discussion in this beautiful chapter, cost of capital. So till now, we saw the reason why we are studying this chapter, the fact that this chapter fits into the objective of financing decision, that is decision relating to the fundraising activity. And as of now, we've seen the following sources of finance. Number one, we saw KD, that is the cost of debentures, right? And then we also saw KP, that is your cost of preference, right? So now let's move on to the most important source of finance, which is actually your cost of equity share capital, which is popularly known as KE, right? Now, basically, who are the equity shareholders in a company? They are the owners. They are the owners of the company. Now, to the owners of the company, what is actually the cost? Of course, these are the people who have taken all the risk because they are not expecting any fixed income or any kind of fixed remuneration every year. Correct? You need not pay them. There is no contractual obligation on the part of the company to make any payment to them every year. Correct, guys? So obviously they will be having some expectation, right, from the viewpoint of the company. Now you imagine, of all the sources of finance, you tell me the equity shareholders are the ones who are the most risk takers. Correct? No, because even in case a company winds up, right, there is no guarantee that they will get their money back. Number one. Number two, there is no concept of repayment of equity shares. And number three, even during the life of the equity shares, there is no fixed obligation on the part of the company to actually make any payment to them. Correct? Obviously, their risk is more. When there is more risk, there will be more return. Correct? So the expectation of return from the viewpoint of the equity shareholders will definitely be high. Correct? Of all the sources of finance, the cost of equity will generally be the high. Generally, I'm saying, are you able? And in this chapter, whatever we are talking is not the actual cost. I'm talking about the expectation of the shareholders or the expectation of the investors. Or in other words, that guy's return, the investor's return, is nothing but my cost. His expectation is my cost. Are you able to understand? Yes, guys. Of course, subject to exceptions, which I told you, like flotation costs and all. Clear with this, guys, right? So just like any other source of finance, KE is the expectation of equity shareholders. And KE computation is quite complex since there is no fixed contractual payment for equity shareholders, and moreover, there is no concept of redemption for equity shareholders. Till now, for KD and KP, whatever we have seen, don't think that, oh, similar calculation is only there for your KE. Absolutely not. KE is a different ball game altogether, because this is the true, actually these guys are the true owners of the company, and the nature of the instrument itself is such that there is no contractual obligation of the company. Hence the manner of calculation itself is different when it comes to KE. Okay, so don't carry the same mindset for KE. KE is completely different altogether. Clear with this, guys? Hence, there is not a single method to calculate KE. You have different methods of calculating KE, and understand one thing, each of these methods will give you different results, right? That is the reason why, if you look at this, sir, how, sir, KE, I'm getting different values, is it correct? Yes, of course it is correct. What is the issue here? Now I'll tell you, if everyone is thinking alike, right? If everyone is thinking alike, first of all, there will be no share market itself. Example, I'm saying you, if everyone wants to buy a particular share of a company, then who will be there to sell it? When there's a seller, only a buyer can buy it in the secondary market. No, it's not issued by the company. Correct? So one guy is saying this company, somehow I feel it is not going to perform well, I'm exiting. Another guy is somehow he perceives something else in the company. He says, no, maybe this could be wrong, but my expectation is something else could be better, so I'm ready to buy the share. So he will be buying it from the other person. Always remember, only if there are contradictory stands, this entire world will exist, and that is also the rule of finance. Are you able? So based on the approaches being followed, different methods of calculating KE are also present, and based on the assumptions for each of these approach, their model is correct. Are you able to understand? So don't say, sir, out of these 5 methods, which is the best method? Nothing of that sort. Depending on the assumption of each of the method, their method is the best method. Are you clear with this? Right? Of course, we all coexist. No, because you have a contrary view, can I always say I am the best? You are always the, I'm not giving preference. It's not like that. From your viewpoint, you might be correct. From my viewpoint, I might be correct. Simple. Are you clear with this? Or exactly the same line is how the KE calculates. done. So first understand that there is no one single method, because the nature of the instrument itself is such that there are some different risk perseverance on this particular instrument, and moreover, this instrument is bundled in such a way that there is no contractual obligation on the part of the company. First thing to understand here with this. So remove the mindset of your KDKP calculation here. Look at it afresh. Done, guys. Perfect. Now, sir, which method to follow? I have given a brief note here, but to put it short for your exams, depending on the wordings of the question, you will know which method they are going to ask you. Sir, what are the wordings, sir? As we enter into the particular methods, you will be able to understand how to read the wordings and how to interpret which method we need to follow. Are you able to understand? Right? And once again, guys, this entire area is dependent on your knowledge and time value of money. So I will be expecting the answers from you like anything. Here with this, guys. Perfect. So now on that note, let us get started with the first method. So overall, there are 5 methods. One is called as a dividend price method. Then you have something called as earnings price method. Then you have something called as growth method. This growth method is popularly called as Gordon's model. It's called as Gordon's model, right? And you have something called as realized yield method, and then you have a CAPM method, which is called as capital asset pricing, right? What are these 5 methods? One by one we will be seeing. You need not have to. Shall we get started, guys? Shall we get started? Right, perfect. Now the first method is called as dividend price approach. Now what does this method say? Now the present value of a particular equity share, the value of an equity share, right, is nothing but the present value of all the future benefits you are expected to receive, correct? In case I am an investor who is going to buy the equity share of a company, right, what is the amount I will be receiving from the company? Dividend. Clear with this, right? Or look at it from the viewpoint of the company, they will be paying only dividends, correct? So, and is it redeemable? No, it is not redeemable, correct? So in other words, this is nothing but the same approach we have been following till now. So can I say the current P0 or the current value of this particular equity share is nothing but the sum of equal cash flows up to perpetuity, that is annual cash flow divided by the discount rate. Annual cash flow divided by discount rate, correct? No, guys, correct? In this case, what is the annual cash flow? Dividend. What is the discount rate? Discount rate for equity is called as KE, correct? So can I say P0 or the net proceeds or the value today of this equity share is nothing but D divided by KE, correct, guys? Or in other words, can I say KE is equal to dividend divided by P0. P0 can also be called as net proceeds. Clear with this, guys? Or if you don't want this time value of money logic, simple, what I pay divided by what I receive. From the viewpoint of the company, you imagine what I pay divided by what I receive. So dividend price model, what is the assumption here? The company will be paying constant amount of dividend till its entire life, till its perpetuity. Look at this. This is also known as dividend valuation model, and it makes an assumption that the dividend per share is expected to remain constant forever. Are you understanding this? Only if the dividend is constant, you can use this method. If it is different, then you can't. Don't go for this method. This method will fail. That's all. Clear with this, right? So this is how you need to calculate KD. Are you getting it? What I pay upon what I receive. To this extent, it is similar to your irredeemable debentures or irredeemable preference shares. To this extent, it is similar. Clear with this, guys, right? Are you able to understand any issue here? When will you use this method? Only when you're expecting the dividend amount to be constant for the rest of the life. Clear with this, guys? Done? Shall we move to the next method? Yes, that's about the first method. Second one, earnings price approach. Earnings price approach. Exactly the same as dividend approach. There's only one difference. Here, they are assuming that the earnings per share, EPS, will remain constant forever. Clear with this? Sir, what is this EPS, earnings per share? I will just walk you through. Right now, guys, can you tell me that income statement, that is that EBIT minus interest? You guys know that? No, I just showed it to you. Tell me now the format. EBIT, everyone, minus interest gives you earnings before tax. Very good. Minus tax is equal to earnings after tax. Now this entire amount belongs to equity shareholders, huh? No. You need to reduce preference dividend. Then you get what? Then you get what? You get your, I call it as EFE, earnings for equity shareholders. Classroom discussion, we call it as EFE. Correct? Earnings available for equity shareholders. Right? Now, out of this, maybe some portion the company can pay as dividend to the equity shareholders. And if anything else is left over, that is called as retained earnings. Agreeing with me on this? Agreeing with me on this? Right? Now, let me just take an example. Right? I'm taking rupees in crores. Right? Let us say the company has earned an EBIT of 100 crores. Right? And let us say the interest is 10 crores, EBT is 90 crores. Right? Let us say, example I'm giving, the tax amount is 20. Right? Example only I'm giving. The main focus is on driving home the point as to what is EPS. Right? The earnings after tax is going to be 70 crores. Right? And let us say they are paying a dividend of 30 crores in total. The earnings available for equity shareholders is how much? It is going to be 40 crores. Correct, guys? Yes. Now, out of this, let us say the dividend they are paying 10 crores. The retained earnings is going to be how much? 30 crores. Agreeing with me on this, guys. Right? Generally, we stop here itself because ideally speaking, this entire amount of 40 belongs to equity shareholders only. Out of this, 10 rupees I'm paying today, 30 rupees I'm retaining with me and plowing it back into the business. Don't worry, tomorrow that is your money only. Are you able to understand this? Are you able to understand this? You guys know the basic concept of retained earnings, your reserves and stuff. To whom does it belong? To equity shareholders funds only, no? Guys, clear, in your accounts you would have seen it is classified under equity shareholders funds. Or let us say, for example, this company has issued a total of, let us say, for example, 10 crore shares. Okay, 10 crore shares the company has issued. Now, can anyone tell me what is the earnings per share of this company? The company has earnings available to equity shareholders is how much? 40 crores, right? This belongs to how many shares? 10 crore shares. 40 crores divided by 10 crores. The earning per share is how much? Hello? 4 rupees. Correct? No? The earning per share is how much? 40 crores divided by 10 crores. Number of shares is 10 crores. I'm giving an assumption. Like, I'm just giving you the fact. Clear with this? Earning per share is how much? 4 rupees. And out of this earning per share, how much dividend was paid? Dividend per share, DPS, will be 10 crore divided by 10 crore, which is rupee 1. Correct? And the retained earning per share is going to be rupees 3. Are you clear with this? Are you clear with this? Yes. So the company has earned a total of how much? 4 rupees. Out of this 4 rupee, 1 rupee gets paid in cash. It gets paid in cash, and the 3 rupee gets retained as your retained earnings. Are you clear with this? Right? The dividend price approach, what was considered was D, what I pay divided by what I receive. That is P0. D by P0. KE is equal to D by P0. That is, in the first model, dividend price approach, the cash flow that gets considered in the numerator was what? Only the dividend. The second model, this model, earnings price model, what they are saying, no, dividend alone is not the amount that I am actually paying to the equity shareholders. Ideally speaking, this entire 4 rupees of earning itself is actually their share only. So your earning price model says KE is equal to E divided by, right? Simple, guys. Here in the dividend price model, you discount only the dividend. Whereas in an earning price model, you discount the entire earning. Are you able to make difficulty here? Ideally speaking, the entire amount belongs to them. So discount the entire amount in order to arrive at the KE value. Are you able to understand? Right? Fine. This is what the two methods say. So dividend price approach and earning price. But most popular among these two, mostly they use dividend price approach because we are dealing in a subject, financial management, which deals with cash flow. So actual cash flow is ideally speaking only dividend, because earnings, some portion gets retained, it doesn't get paid. Clear with this? That's why between the two, this is preferred. But there are two models. That is something that I wanted. Clear with this, guys? But now you tell me, will the company throughout its life be earning only the exact? Will it be paying only the exact dividend every year throughout its life? Will it be paying the constant equal dividend up to perpetuity? No, it will can also grow every year. No, so there can also be a model where, of course, equity shares are perpetual only, but there can also be a dividend with a growth approach. Correct or not? Yes. and that is squarely covered under the third model called as growth approach or Gordon's model. Are you clear with this? What are they saying? Growing cash flows up to perpetuity, and as per Gordon's model, the formula is KE is equal to D1 by P0 plus D. Sir, how is KE equal to D1 by P0 plus D? Very, very simple. Now you tell me P0, that is the today's value of a particular equity share is what is the, how do you calculate that? In case of a growing cash flow up to perpetuity, what is the formula for calculating growing cash flow up to perpetuity? Cash flow at the end of first year, that A by 1 minus R formula. Come on, recall that. I told you the GP, sum of GP series and all. Cash flow at the end of first year. That is nothing but, in this case, what is the cash flow? D1. Correct? Divided by discount rate minus growth rate. Discount rate for equity share is called as what? KE, ma? Correct? Minus growth rate, it is going to be G. Correct, guys? This is nothing but, we saw this in time value of money chapter. How this formula came, I proved it to you using sum of infinite GP series. Correct? Now in this particular chapter, what are we calculating? We are not calculating P0. We want this KE figure. Correct? Or can I say, just cross multiply, bring this to the other side and bring this down to the other side. Can I say KE minus G is equal to D1 divided by P0? Correct? No. Right? Cross multiplication. Or can I say KE is equal to D1 divided by P0 plus G? As simple as that. Here with this guy. As simple as that. So KE is equal to D1 by P0 plus. Are you clear with this? Clear with this? This is what Gordon's growth approach or Gordon's model tells you. Clear with this? First we saw dividend price model. Assumption was what? Equal dividend to perpetuity. In Gordon's model, what we are saying, growing dividend to perpetuity. Clear with this? Right? Strictly speaking, Gordon's model can also be applied on earnings, no? Correct? Second model was what? Equal earnings up to perpetuity. Even earnings can grow, no? Correct? See, if your dividend is growing, obviously it is because your earnings are growing. Because dividend is actually one offroot, one baby of earnings. Correct? No. See, just now we saw dividend. How do you get this figure? Because you're earning. Right? If this is growing, it is because this is also growing. So very strictly speaking, Gordon's model can also be applied on your earnings. Are you able to understand this? Gordon's model can also be applied on your earnings. Are you able to understand this? Right? Suppose you are applying Gordon's model on earnings, it will be what? Instead of D1, it will become E1. E1 by P0 plus G. Here with this guy. As simple as that. Here with this. So, in my opinion, I will say Gordon's model, it can be applied both on dividend as well as on earnings. So, dividend growth model can be there. Even earnings growth model can also be there. Are you able to understand? Are you able to understand any problem in understanding? No, right? And always remember, the cash flow that we are using here is D1 means what? The cash flow happening at the end of first year. The derivation we saw there in time value of money chapter. Clear with this? Suppose in the question they have given, the past dividend was so and so amount. That should be taken as D0. The next year's dividend will be what? The past dividend into 1 plus G. Correct? No. Correct? No. You're not understanding. What I'm saying is, the past dividend, the last year's dividend was 10 rupees. And they are expecting that the growth rate is going to be 10%. Okay, the next year's dividend will be what? 10 rupees into 1 plus 10%, right? Or that is nothing but rupees 10 into 1.10, that is nothing but rupees 11. So strictly speaking, this was a past year dividend. They are using the word dividend paid was 10 rupees. Don't directly substitute it as D1. That is not D1, that is D0. Past dividend. So the next year's, the first year's dividend is going to be D0 into 1 plus G. Are you able to understand this? Now you are able to understand this? Yes. So because in all this growth formula, we use the first year's dividend. So be very, very, very careful. Use only the first year's dividend. Past dividend, if it is there, apply the growth rate and arrive at the first year's dividend. Very important. Students make mistake here. Then P0 is nothing but the current market price per share, or technically speaking, this is nothing but your net proceeds, guys. This is basically your net proceeds, which means what? You can take it as issue price minus flotation cost, right? This issue price figure, if it is given, take it as issue price. If it is not given, take it as current market price. If that is also not there, assume it to be equal to your face value. Clear? Everything is same. This denominator is basically your net proceeds only, no changes there. Clear with this? Clear with this, right? And G is a constant growth rate of dividend. Are you clear with this? And in this model, what is the assumption we are taking? The assumption we are taking is the dividend is going to grow at a constant rate, which means, for example, in our example, it is growing, it is going to grow at 10% forever, right? So first 4 years 10%, after that it is going to be 15% and all. Then this model will not work. You have a separate model called as variable growth rate model that is not a part of this chapter, that is a part of your dividends decision chapter. There we will be seeing it. Right now for KE calculation, only growth approach is there. Are you able to figure this? Are you able to understand this? Right? Fine, guys. So now one more thing is there. In case of newly issued equity shares only, the concept of flotation cost is there. Right? The cost of equity share with an estimation of constant dividend growth rate in that case is calculated as follows. This is something that I already told you. D1 divided by P0 minus F plus D, or in other words, guys, always remember, you need not separately note this formula. The P0 is nothing but net proceeds. Clear with this? Right? If it is a fresh issue, obviously, if the flotation cost is given, take that also into consideration. Simple. Don't read it as separate formula. So then why have you given it, sir? Because it is given in the study material, I had to give it separately. But in the classroom, I'm explaining, don't read it as separately. If flotation cost is given, always adjust it. If not, don't adjust it. As simple as that. Clear with this, guys? Clear with this? Fine. So with this, can we just do one numerical problem here? Yes, shall we just go and do one numerical problem? Please take the next question. Please take the next question, guys. So it's going to be question number 5. Huh? Go to your solved question bank. It's going to be question number 5, is it? Cool. Look at this. Read the question carefully. The company has what? Paid means what? This dividend is D0. D0. Be careful here. Right? Has paid a dividend of 1 rupee per share of a face value of 10 rupees each last year, and it is expected to grow the rate of 10% every year. Calculate the cost of equity if the market price of the share is 55. Now first you tell me, guys, K is equal to, what is the formula? Gordon's approach. Gordon's approach, right? This is going to be D1 divided by P0 plus G. Correct, no? How did we arrive at it? So we saw that P0, the present value, is equal to D1 by KE minus D. That is first year's cash flow divided by your discount rate minus growth rate. TVM chapter, cross multiplied, and I proved this formula. In this case, what is given? 1 rupee is given. That is not D1, that is D0. How do you arrive at D1? So you take this 1 rupee, right, and apply growth rate on that. So 10% growth. So 1 into 1.10, that's going to be 1.10. Correct? The numerator is going to be 1.10. So D1 divided by P0. What is P0? So currently they have given the current market price per share. So if I go to the market today and raise the money, how much net proceeds will I get? 55 rupees divided by 55 plus growth rate. You get an answer of 12. Clear with this, guys? As simple as that, right? So now you tell me, in this case, based on the data given in the question, did you have a doubt whether to follow your dividend price model or dividend growth model? No, obviously in this case, the cash flows are growing. Clearly, the first approach, that is a dividend price model, the assumption is dividend is going to be constant. Clearly, you know that model cannot be followed. This is why I said go based on the wordings of the question. Clear with this, guy? Just go update your library of adjustments. Write down KE hyphen dividend growth approach. Dividend growth approach within bracket Gordon's model. Within bracket Gordon's model. Done? Done, guys? Shall we move on to the next one? Perfect. Let's go to the next one. Now, look at this. There is a confusion between D1 and D0, which generally students actually, they face a challenge here. If the words, the expected dividend or dividend expected, if the word is futuristic, then you can directly take it as D1. Correct? Dividend expected to be so much, no? Then you can take it as D1. If the words dividend paid, if it is given in past tense, take it as D0. Suppose if the word is silent, they are saying dividend is 1 rupee. Sir, should I take it as D0 or D1? In that case, it is your choice. You either take it as D0 or you take it as D1. But whatever you do, please for God's sake, write a note. Write a note saying, since in the absence of information, it has been assumed that the dividend given is directly taken as D1. For your note, your answer will be given. Right? Once again, here, there is a huge controversy. Institute randomly they are taking in one question. See, this issue happens only if the question is silent. Not just that, in some cases I've seen the dividend paid was 1 rupee. The word it is given like this, still they have taken it as D1. Right? Sir, what should we do, sir, like this? I don't have a solution for this because it is a clear-cut, it is a clear-cut difference in stand taken by institute. I am telling you, generally, if the words are given in past tense, take it as D0. If the words are given in future tense, take it as D1. If the question is silent, you take anything, write a note. Right? Or every time you write a note, suppose the word dividend expected is given, take it as D1, write a note for safer side, saying since the word expected is given, it has been considered as D1. So dividend area alone, always write a note because left, right and center institute has randomly taken anything. Even if the words are given in futuristic sense, they have actually taken it as D0 and calculated. Right? I don't have an answer for that honestly because I'm not running the institute. All I can tell you is interpret whatever has been done there, and I can tell you play it safe always. Whenever dividend model comes in, anything related to dividend, write a note and leave it there. Here with this guy. Here with this guy. Right? So if it is expected, these words are given in past tense, take it as D0. Expected, the word is given in future sense, take it as D1. Past tense, take it as D0. Neutral, you take anything, but no matter what, you write a note for safer side. Clear with this, guys? I have been getting doubts left, right and center, and I wanted to clarify this in the course itself. Right now when I'm doing this session itself, I want to clarify this. That's the reason why I put it in the doubt busters session, the column here. Clear with this, guys? Done. Fine. That's about this. Estimation of growth rate, I'll be doing it later on. Okay, fine. Then the fourth model is called as realized yield approach. Now, a very important and a very interesting approach. Now, realized yield. Now, the word yield comes. What does it mean? What does it mean? I just told you. No. If the word yield comes in, I told you what is used. Nothing but IRR model. I just told you, no. This last session only I told you, no. The word yield generally comes YTM, yield to maturity approach and all. Here, realized yield means IRR calculation. Now, please understand, this is one more area where students get confused. This method actually, what they are doing is, this method is completely done from the perspective of the investor. Okay, this method is completely done from the perspective of the investor. Sir, why are they doing it from the perspective of investor, sir? You said this chapter is actually done from the perspective of company only, no? This is based on the principle that the investor's return is equal to the cost to the company. Are you able to understand this? This is an underlying assumption for this particular model. This is based on the assumption that the return to the investor is exactly equal to the cost to the company. Right? Now, what they do is, now from the perspective of the investor, an investor can have a finite life, no? Why? He has a ready secondary market. He can buy today, hold it for 5 years, get dividends for 5 years. At the end of 5th year, he can sell it in the secondary market. Guys, clear? From his perspective, there is a finite life. IRR can be calculated. Clear with this? From his perspective, you calculate the return, call it as KE. Why? Because KE at the end of the day is nothing but expectation of investors' return only. From the viewpoint of the company, what is the cost? From the viewpoint of investor, it is called as a return. Sir, how will I know whether to follow this method? If the data is given from the perspective of investor, then you go for this method. Simple. We'll do a sum, you will understand. Clear with this. But remember, this chapter is always done only from the perspective of the company, not from the perspective of investor. But this is based on the principle that I just clear with this. Now you read this, you will understand. According to this approach, the average rate of return realized in the past few years is historically regarded as the expected return in the future. It computes the cost of equity based on the past records of dividends actually realized by the equity shareholders. It is based on the principle that the cost to the company is equal to the investor's return. This is something that I added here in between. Right? There are a lot of things that I've added in between based on the interpretation. Right? This method is computed from the investor's perspective and is normally followed when the shares are sold by equity investors after a few years in the secondary market. Now you understand why I gave that introduction of basics of markets and all. Clear with this? That itself I told you in yield to your realized yield approach, it will actually be helpful. I'm just connecting the dots right now. Here K is calculated by discounting the relevant cash flows using the IRR concept. Sir, how to do sums of this sort? Don't worry, go for the next sum and you will be understanding. Shall we go on to the next sum, guys? Right? Let's do the next sum. Please take the next question. This is a study material question, right? Guys, all the questions in the study material are here in our, in our solved workbook. Entire study material is there, right? From your book back questions, your illustrations and everything. Apart from that, previous year exam papers, RTP, MTP, even those things are actually included. So nothing to worry about. Right, now look at this. Mr. Mehra purchased a share of Alpha Limited for 1000 rupees. He received dividend for a period of 5 years at the rate of 10%, right? And at the end of the 5th year, he sold the share of Alpha Limited for rupees 1128. You are required to compute the cost of equity as per realized yield approach. Obviously, this sum can be done only using realized yield approach because nothing is given from the perspective of company, right? And clearly they have given, right, this, it is sold in the secondary market for, your value and all is given. So clearly this is going to be your realized yield approach. Now, how do you do this sum? IRR calculation. IRR calculation, no? Guys, yes. So can you just frame the cash flow equation? This is nothing but 1000 rupees from the viewpoint of the investor, initial outflow 1000 is equal to every year he is going to receive what? How much dividend? 100 rupees. That is 10% on 1000 is going to be 100. Correct? So every year it's going to be 100. Like that, for how many years he's planning to hold? 5 years. So can I say 1000? Sorry, this is not 1000. I'm sorry, guys. My bad. So I'm removing it. 1000 into present value interest factor of annuity or present value annuity factor of some X percentage, or rather I would say KE percentage. That is what I need to compute. Correct? For how many years? 5 years. Plus at the end of 5th year, what does he receive? This entire sale value. So rupees 1128 into present value interest factor of KE percentage for 5 years. Am I right, guys? Right? And this goes to the other side. Right? So this equation minus 1000 should be equal to 0. Now let KE be equal to one trial you take, you'll get a positive NPV. Let KE be equal to another trial you take it as a negative NPV. Using interpolation, what you do, you arrive at the IRR. Are you clear with this? Right? So now this is exactly as per the solution given in the study material. Now what they have done, ideally speaking, what you should get is, you should put 0 here, year 0. There is an initial outflow of how much? 1000 rupees. Initial outflow of 1000 is there. Correct? No. Ideally, he has paid, okay, not dividend, it will come here. He has paid 1000 rupees to get this particular, this one, right? He has actually paid 1000 rupees to buy the shares. Correct? No. Right? Year 0, 1000. The discount factor is readily 1 only. Correct? So the present value itself is going to be 1000. Guys, correct? Yes. Now what they have done, they have taken one trial they took randomly. Let R be equal to, let K be equal to 12%. They discounted. Right? Year 1, 2, 3, 4, 5. Dividend was 100, 100, 100, 100, 100. And once again, year 5, at the end, they received how much? 1128. Correct? Now, what they have done here, they have arrived at the discount factor. They have arrived at the present value. The total present value of all the cash inflows was coming to around 1000.076. Exactly, the total cash inflow became 1000. Cash outflow was negative 1000. The NPV came out to exactly 0. So, this time, whatever they prayed to God, the prayers were answered, it seems. So exactly the first trial itself hit out to be 12%. That itself is your KE calculation. Clear? But don't worry, in exam, they will not give you like this and all. But this was actually given as an illustration question to explain. That's about it. So strictly speaking, what you need to do, they will give you 2 trials. And you need to interpolate and you need to arrive at the answer. But you're getting the point here, right? Here, they randomly took 12%. So this doubt also I got from students. Sir, how, sir, exactly? The 12 question is a missing figure. Come on, that is a question itself. Yes, that is the missing figure. Randomly, they took 12% and tried that the NPV came out to be 0. You clear with this, right? Suppose if you took 10%, it would have been something else. You should have taken another trial and you should have interpolated it. Clear, sir? Yes, 10 and 15% you can take and you can interpolate. But one more thing I want to tell you in IRR. IRR answer will differ based on the trials you take. So for the same cash flow, if I take 10%, if I take, let us say 15% and interpolate using it, IRR answer will be, you will be getting one answer. The same question right now, the answer is 12%. No? Let us say I took 10% and 13%. Now what will happen? The IRR answer will be slightly different because at the end of the day, you are interpolating, no? Right? This answer will be more accurate than the previous answer. Why, sir? Because if the spread between the lower trial and the higher trial is more, right, then it will be lesser inaccurate. Or in other words, the spread should be as less as possible, only then it will be close to accuracy. Able to understand. So, sir, I took a different trial, sir. For me, the answer is different. It will be different. Don't worry about that. For your trial, your answer is correct. That's why I said all these are only for academic purpose. In real life, I showed it, you know, one punch, one click, you will get the answer. That's about it. Are you able to understand? Right? Right? Fine, guys. Are you all able to understand this? So in case the data is given from the perspective of the investor, then in that case, you can go for this method called as realized yield approach. And it is based on the principle that it's based on the principle that the investor's return is equal to the company. Are you able to understand this? Done? Done? Yes, shall we just proceed forward? Just go and update your library for adjustments. We'll move to the next one. Come on, guys, write down. Write down KE hyphen realized yield approach within bracket IRR. KE hyphen realized yield approach within bracket IRR. Done? Let's go on to the next one. Shall we move to the next one, guys? Yes. Let's get started. Now, the last approach in this segment is called as your capital asset pricing model, CAPM approach. Right? CAPM approach. This is actually a CA final level concept. A CA final level concept. Right? There's something called as beta and all. Beta is a risk measure. It measures your risk. Now, this model alone, to the extent required, it is logical. That alone I will tell you and leave it. There is a calculation of beta. This is beta. Beta calculation itself is one separate concept at the final level. It uses some high level of statistics and all, like correlation, regression. You guys have heard of it. So based on that only, this beta itself is calculated. But don't worry, at the intermediate level, they will give you all the fact. You just need to just enter it into the formula and arrive at the answer. But I will also tell you the logic for the formula. Now, what is this CAPM model? Very, very popular and very, very important model at the final level, even at the intermediate level. It's just a formula substitution. So students generally find it not that difficult because it's just application of formula. Now, it describes the risk return trade-off of securities. And the idea behind the CAPM is that investors need to be compensated in two ways. One is for the time value of money and the other one is for the risk. And this method says that the expected return on a security or a portfolio equals to the rate of return on a risk-free security plus a risk premium. In this case, the KE will be RF plus beta times RM minus RF. Now, what is this meaning, sir? I will explain it to you. KE is equal to RF plus beta times RM minus RF. RF stands for risk-free rate of return. Sir, what is risk-free rate of return? Your FD interest, your Government of India bonds, the secured guaranteed return. Is there any risk for you? No, you will get back the money. You will also get your interest. Everything is fixed. No risk, no. The return that you get without taking any risk is called as risk-free rate of return. Right? In exams, they might not give you RF directly. Sometimes they might give, sometimes they will say the government of India bond rate was so much, which means that should be taken as RF. Clear with this, right? Let us assume, example I'm saying, RF is 10%. That is, if you put it in an FD or a safe investment, you will definitely get 10%. Now, if you are a person who wants to invest in the share market, will you expect exactly 10% or more than 10% or less than 10%? You tell me. If you are a person who wants to invest in the market, what will you expect? More or less or equal? Obviously, you will be expecting more than 10%. Why will you expect more than 10%? You are taking more risk, correct? You are investing in an equity instrument. So, more the risk, more the return, correct? You will expect more return, obviously, right? Generally, on an average, the market gives a return of how much? Example, I'm saying 15%. Example, I'm on an average. So this 15%, how do you get? Generally, there's something called as index. You've heard of Nifty, yes, Sensex. This is an indication of a market, indicators of market, right? Basically an index. These are all called as indices, index, right? An index is an indication of a market, right? So market return on an average, the market is giving a return of 5%. Example, I'm saying, right? So what I am expecting is, if I enter into the market, how much more am I getting? How much more am I getting? That is, risk-free rate of return is 10. If I go to the market, generally, market return is how much? 15%. How much extra am I getting? So 15 minus 10, how much is it? 5% is what I am extra expecting from the market. Correct? Hence, this RM minus RF is called as market risk premium. That is nothing but the extra premium that I am expecting from the market because I am ready to take the risk. Are you able to understand? 3 words, full logics. Clear with this? RM minus RF is nothing but market risk premium. Are you able to understand this? Right? Now, beta, as I told you, what do you mean by beta? It is a measure of risk. It is a measure of risk. Let us say this beta is generally there for every companies. ACC Siemens. Have you heard of ACC Siemens? Right? It's a very popular company. It's an index company basically. Okay. ACC Siemens, or let us say MRF Limited. Right? It will be having a beta. Beta is nothing but the risk perspective the market attaches to the company. Right? There's something called a systematic risk, unsystematic risk and all. It's a measure of systematic risk. Right? Now, this basically, for this company, the risk is 1.5 times. It is generally in decimals. Right? This is company specific. For this particular company, the investor is actually attaching a beta, a risk perseverance of 1.5 times. Basically, what he says is he definitely needs 10%, correct? RF plus anyone who enters the market will definitely be expecting this 5%. But I want 1.5 times of this extra 5% because for this company, my level of risk perseverance is 1.5 times. Are you able? Why? Now you read this, you will understand. They are saying KE is RF plus beta times RM minus RF. RF definitely 10%. Yes, but anyone who enters the market will expect 5%. But my risk perseverance of this company is 1.5 times. I want 1.5 times of that extra market premium. Are you able to understand? This is the meaning of APM. Logical? Very logical, right? How to arrive at this beta and all is not required at the interview. They will give the figure. Don't worry about that, right? In that case, if you do the calculation, so 1.5 times of 5% is what? 7.5. So the KE is going to be how much? 17.5%. You have arrived at it, right? So now you understand the logic of our CFPM, the method. So it's going to be KE is equal to RF plus beta times RM minus RF, where RF stands for your risk-free rate of return. Beta coefficient is basically nothing but it's the risk measure. It's a measure of your risk. And RM is going to be the rate of return on market portfolio. That is nothing but your general market return. And RM minus RF, this net difference amount, is called as market risk premium. That is the extra premium that I expect in the market because I'm taking that extra risk. Are you clear with this, guys? Yes, you're able to understand this. So basically, if you look at this in the core theory area, I've kept something. Look at this. Risk is actually of two types. One is called as unsystematic risk. The other one is called as systematic risk. Unsystematic risk means what? It is a company specific risk. For example, in Tata Motors, there is one strike happening in the factory. So 2 days production is stopped. 2 days production is a huge impact, right? So now, is it happening across the entire industry or only one company? It's one company. It's a company specific risk. Is called as unsystematic. Systematic means what? Entirely systematically, the entire market itself is perceiving this, right? Company specific risk is unsystematic. Systematic risk is what? Market specific risk. Entire market. Example is COVID. Entire market got affected, right? Entire market got affected. COVID. Oil prices. Entire market gets affected. It's not one company. Entire market gets affected. Inflation. These are all some general, unavoidable. These systematic risks cannot be avoided. Whereas unsystematic risk, to some extent, it can be reduced. Company specific risk, you can reduce it to some extent. In case a strike happens, what you can do? Immediately you go for a settlement and say, fine, okay, 2 hours the production is stopped. Okay, fine, at least now let me just, you guys start working. I'm accepting for whatever incremental wages you are asking. Something like that, you can just come up with a settlement. Clear with this, guys? Now, a systematic risk, which is actually diversible in nature. So this systematic risk can actually be eliminated by an investor through diversification of a portfolio. That is more of a final level concept, but basically what I want to tell you here is beta measure. This beta is actually, one second. Look at this. As diversifiable risk can be eliminated. Diversifiable risk means unsystematic risk, right? It can be eliminated by an investor through diversification. The non-diversifiable risk, that is basically a systematic risk, right, is the risk which cannot be eliminated, and therefore a business should be concerned as per the CAPM method, which is solely your non-diversifiable risk. Basically, your beta is a measure that calculates your systematic risk. That is the relationship between a particular stock or a particular company in relation to the market, right? This is the meaning of beta. Are you able to understand? Beyond this, nothing is required. Beta is a measure of systematic risk. This is all you need to know in short. Clear with this, guys? Right? Beyond that, I don't want to waste my time or your time rather in actually explaining the concepts which are not relevant at the intermediate level. In final, we will be seeing in-depth calculation of beta itself. How that beta is arrived. It's a beautiful discussion at the final level. Okay, guys, done. So fine. So KE is equal to, under CAPM method, what is the formula? RF plus beta times RM minus RF. This is what they are saying. We'll quickly do one numerical problem in this area. Right. So let's go to the sum. Where is it? Question number 7. Calculate the cost of equity of H Limited, whose risk-free rate of return equals 10%, and the firm's beta is 1.75 times, and the return on the market portfolio equals to 15%. Simple. K is equal to, come on, tell me, RF. Anyways, I need the risk-free rate of return plus beta times I need RM minus RF. Suppose in this question, okay, fine, let's do this. It's going to be what? 10% plus 1.75 times 15 minus 10%, that is going to be 18.75%. Correct, guys? Suppose in this question they have given market risk premium is 5%. It means what? They have directly computed this RM minus RF and they have said this value itself is 15%. Don't take it as RM. Clear with this? If they have used the word, this is the reason why I gave all these things there, right? Market risk premium means what? The extra premium that I am expecting from the market because I am taking the risk, which means that itself is RM minus RF. Clear with this? Be very careful with the terminologies. Last exam they asked us. Be very, very careful. So what students do is this 5%, they take it as RM and do the calculation. Sir, it is coming in negative. No. Market risk premium means they themselves have reduced the two and they have arrived at the figure. Okay, let's go and update your library of adjustments quickly. Write down KE-CAPM approach within bracket direct. KE-CAPM approach within bracket direct. KE-CAPM approach within bracket direct. Are we done? Right. Now let's move on to the last and the final source of finance, which is called as retained earnings, cost of retained earnings. Now, so first, how do you even consider this as a source of finance? I am not taking this money from anyone, but before that, first you should know what is retained earnings. Quickly, I will tell you. Let's say this is the balance sheet of the company, right? Company starting afresh. Retained earnings, will it be there? No, retained earnings is what? Nothing but accumulated profits. It's not there. So, equity share capital, preference share capital, maybe some debentures money they have raised. Now, having raised the money, what they do? Put it in a bank account and sleep? No. What they will do is invest it into their business. They buy the assets of the company. I told you, fixed assets, current assets, and when you are running the show, you will also have some current liabilities and all. So they run the operation, correct? And once they do that, what do? They generate some profit, correct? Out of this profit, first they pay the outsiders, right? EBIT minus interest, EBT minus tax, EAT minus preference dividend. Now, the balance amount after paying these guys is called as EFP, earnings available to equity shareholders. Just now we saw all these things, right? Now, out of this, a portion is paid as dividend and the balance is retained with the company as retained earnings. This enters into your source of finance, correct? Or in other words, whose money is this? Shareholders, no. Equity shareholders' money. Be more specific. Is equity shareholders' money, correct? Strictly speaking, you should have paid them. You have not paid them. So it is as good as paying them and getting it back. Instead, I am not paying them only and I am retaining it with me, correct? Strictly speaking, this is also one more source of finance, or to put it in a very polished sense, can I say this is nothing but a plowing back of profits. I'm plowing back my profits into my business, but ideally this money is due to whom? It is due or it is owned by these guys called as equity shareholders, correct? Yes, guys. Obviously, on this also, they will be having an expected return. They will be expecting return even on this retained earnings because it is their money, correct? Right? And expectation of return of equity shareholders is called as KE, correct? And this money retained earnings belongs to whom? Equity shareholders. In short, can I say AR is equal? That's all. This entire concept. Here with this. Yes. Now you read this, you will understand. Retained earnings belongs to equity shareholders and hence it is very much a part of equity. Like other sources of finance, retained earning also involves a calls. It is the opportunity cost of the dividends foregone by the shareholders. Or to put it in similar words, we are not dealing with actual figures. This is the reason I keep telling this to you again and again. Actuals are there in your accounts. You record post-mortem work. Here we are not doing that. Even on this money, they are expecting some return. Expectation of return from the viewpoint of the investors is the cost from the viewpoint of the company. We are dealing in futuristic sense. Clear with this? Yes. So in that case, therefore, KR is often interchangeably used with KE, as KR is nothing but the expected return of shareholders from the investment in the shares of the company. So now KR, to put it short, is equal to KE. So how do you compute KE? Any of the 5 methods. So whatever methods that we saw for KE, the same things are even applicable for your KR also. Clear with this? Clear with this? 1 or 2 adjustments alone is there. That alone I will tell you. First, are you able to understand? KR belongs to whom? Your retained earnings belongs to whom? Equity shareholders. Hence, KR is also the expected return of equity shareholders. KR is equal to KE. Clear with this? Right? Now, the formulas used for calculation of retained earnings are same as the formulas used for calculating your cost of equity. Hence, to put it short, I can say KR is equal to KE. Done? In short, it should be noted. Okay, fine. This is what I'm going to tell you. Now, there is only one difference. For example, dividend price model we are using. Example I'm saying, dividend growth model. There we saw KE is equal to P1 by P0 plus G. Correct? No, we saw this where P0 was nothing but net proceeds of a company. Correct? Correct. Now, just now we saw KR is equal to KE. The same formula I can also use it for KR calculation. But remember one thing. For retained earnings, there is no concept of flotation costs. Why? Because I am not physically raising money from the public. I will not be paying any underwriter's commission. though this amount belongs to the equity shareholders, there is not an actual amount being raised. I myself have it. I should have given it to you. I'm not giving it. That's all. When I myself have the money, where is the fundraising activity involved, or where is the fundraising cost involved here? Are you clear with this? To put it short, for all the calculations of KR, wherever net proceeds comes in, there you should not adjust for flotation cost, right? So in this case, if I am calculating for KE, the same formula I will put, but when I am calculating this net proceeds is equal to issue price minus flotation cost. Suppose I want to calculate KR, the same formula you use, everything is same, but whenever I'm calculating the net proceeds, here I will just keep it as issue price minus flotation cost. I will not do. So the answer will change. Are you able to understand this? Are you able to understand? That's about it. You are able to understand? This is just now I told you, no. When it comes to retained earnings, do you have a flotation cost? Do you raise money from them? Do you incur underwriter's commission? Do you issue a prospectus, print it, issue it? No. Then where is flotation cost involved here? So in all other aspects, it is same as your KE calculation, but wherever net proceeds comes in, understand that you are not incurring any flotation cost. So to put it short, for the purpose of calculating KE, P0, that is nothing but net proceeds realizes issue price less flotation cost. The same formula can be used for calculating KR, with the only exception that here generally what we do is, am I actually issuing any shares? No. So generally the thumb rule is, generally P0 will be taken as a current market price, because I don't issue anything. Are you able to understand that? Right? If the current market price is not available, but in the question they have used the word issue price, only then you take issue price. You're able to understand. Strictly speaking, logically think. When will you have something called as issue price? Only when you're issuing something. Correct? Retained earnings, are you issuing anything? No. So for the purpose of net proceeds computation, take the value as current market price. In the market, if I go today, at what price? Suppose current market price is not available. Here the sequence is changing. Then you go to your issue price. Right? And if that issue price is also not available, then you can take the face value. Clear with this, guys? General thumb rule is what? First preference to issue price, then second preference to current market price, and only then you will go to your face value. But here what we are doing, it's actually different. First preference is given to current market price, then the second preference is given to issue price, and the third preference is actually given to face value. Are you clear with this? But however, once again, it's a very controversial area. This is what is given in the study material, right? Study material only they are saying, for the purpose of P0, in KR calculation, consider current market price. This is what they have given in the study material. But while solving, what they have done, when both the current market price as well as issue price are given, strictly speaking, for KR calculation, you should only consider current market price, because there is the concept of issue here. What they have done is, all interchangeably they have used. Randomly in one question they have taken current market price, randomly in one question they have taken issue price when both the figures are available. See, the problem is not there when only when one figure is available, but both are available. What should you choose? See, ICA has used current market price and issue price interchangeably in the solutions for calculating KR. In this case, students are suggested to write a note regarding the approach followed in their answers. My opinion, first preference to current market price, then second preference to issue price, and then third preference to face value. Right? No, sir. Institute has interchangeably used. You take either issue price or you can take current market price. I am leaving it to your choice. To conclude, this is what I'm saying. You either take CMP or you take IP, issue price. But whatever you take, write a note and leave it there. For your note, your answer is correct. Are you able to understand? Guys, yes, done. So, first, KR is equal to K always, right? The first thing alone, first adjustment I told you with respect to what? Flotation cost. When flotation cost is coming, for all the KR calculation purposes, ignore the flotation cost. For all the KE calculation purposes, consider the flotation cost. Any problem here? First, then there is one more exception. What is this exception? Now, this is once again, this calculation is done from the perspective of the investor. Now guys, we all know that the return from the viewpoint of the investor is equal to the cost from the viewpoint of the company, generally, correct? But that's why I said KR is equal to KE, correct? Because this is also an amount that belongs to the equity shareholders. But suppose in the question, they have given personal income tax of the investor. This is not corporate income tax. Personal income tax of the investor. They have given personal brokerage of the investor. This is not flotation cost. Personal brokerage means for opening a demat account, they have some brokerage and all. Right? For operating in the equity market, you need to incur some brokerage and all. If these figures are given, what you do is KR is equal to KE into 1 minus TP. TP stands for personal tax of the investor. And further 1 minus TB. This TB is nothing but your personal brokerage of the investor. Let us say the tax is 20%, right? And let us say the brokerage, example I'm saying, is 5%. Example I'm saying. Now KE, example I'm saying, guys, KE is, let us say, 10%. Now whatever is a return from the viewpoint of the investor, you think the company is paying some, let us say 10% or some dividend they are paying. This entire amount will they be able to enjoy? No, because the government comes and they're asking for the share of 20%. So only the remaining 80% will be left. Guys, correct? So at least entire remaining 80% will be left. No, once again, furthermore, 5% is being eaten away through my brokerage. Even on this only, the balance 95% is only available. So the net amount after adjusting all this will be somewhat much lesser than the actual KE. Are you clear with this? Right? Not a very right approach, but in case these data are given in the question, you should know that this is how it needs. Clear with this? Clear with this? This, I think it is not there in the study material, but this was tested once in a past exam. That is the reason I have inserted and I have kept it under the notes. This is the reason why I didn't keep it on the top, because it is not there in the institute study material, but in a past exam or RTP, I saw this. Clear with this, guys? Clear with this? If personal, simple, this is personal income tax is not company's income tax. Clear? It is the personal income tax of the investor. If that and brokerage and all is given, into 1 minus that and into 1 minus brokerage, you do and you leave the answer. Simple. Clear with this, right? So to summarize KR is equal to KE, which means what? Use all the 5 approaches that we actually saw, any of the 5 approaches that we saw for KE. 2 exceptions are there. Exception number 1. When you have a flotation cost should be considered only when KE calculation, only for KE calculation. It should be ignored for the purpose of KR calculation. Clear with this? And for the purpose of KR, you can use either issue price or current market price, but write a note. Right? I'm just summarizing. Next. In case the personal income tax of the investor and the brokerage is given, what do? KR is equal to KE into 1 minus personal income tax into 1 minus brokerage. Clear with this? Why are we doing 1 minus all these things? Because these are all some outflows here. Able to understand, guys? And that's about the entire discussion with respect to KR. And we are done here. Shall we just go and do a few numerical problems? Yes? Yes. Come on, guys, do it once. Come on, let's do this. Come on, take it up. Question number 7, is it? 8, huh? Okay. The face value of equity shares of a company is rupees 10, right? While the current market price is rupees 200 per share, the company is going to start a new project and is planning to finance it partially by new issue and partially by retained earnings. You are required to calculate the cost of equity shares as well as the cost of retained earnings if the issue price will be 190 per share. Now, clearly understand, guys, in this question, right? So what approach will you follow in this particular question? Oh, sorry, I haven't read the question fully, is it? Sorry. If the issue price is 190 per share and the flotation cost will be 5, I'm repeating this. You are required to calculate the cost of equity shares as well as the cost of retained earnings. If the issue price will be 190 per share, flotation cost will be 5 rupees per share. Dividend at the end of first year is expected to be how much? 10 rupees with a growth rate of 5%. Now, first of all, there are 5 methods in which you can calculate your KE. Which method should we use here? Gordon's model. Gordon's model should be used. Growth model. Correct? Right? How do you know? Earnings, growth rate and all is given. Clear with this? Now, KR is equal to K. So, KE you compute. Same way alone, the same formula you will use for KR, but the figures that you consider alone, there will be some slight changes. What will it be? First thing, KR is equal to D1 by P0 plus G. D1 was what? 10 rupees. Yes. So dividend at the end of first year is expected to be how much? 10 rupees. Correct? Now divided by, now in this question, issue price is given as how much? 190. Look, current market price is given as how much? 200 rupees. So which one will you give top preference to, right? I told you, ideally you should give preference to what? Current market price, correct? Because we are in what calculation? KR calculation, correct? Right? So in this case, you will take the P0 or the net proceeds only as 200 plus the growth rate of 5%. If you apply it, you get your KR is equal to 10%. Are you to understand? Yes, you guys are able to follow this. Same question for KE calculation. What do you do? T1 10 rupees by P0 net proceeds. Net proceeds, what do? I'm issuing fresh equity shares. I get 190 rupees, no doubt, right? However, there will be a flotation cost of 5 rupees minus 5. Net of the amount that I get is only going to be 185. Here with this. Plus your growth rate of 5%. If you apply this, you get a KE calculation of 10. Are you able to understand? Guys, you're all able to understand this? Yes, very simple and straightforward, but understand that flotation cost needs to be ignored for the purpose of calculating your KR, right? Now, in the same sum, what happened, I think in another RTP or somewhere, it just got later on published. Instead of 200, they considered 190. They said, ignore flotation cost. We are not subtracting 5, but instead of current market price, we are taking issue price for the purpose of calculating KR. This is why I said randomly they use anything. Better always write a note and leave it there. Right? In the absence of information, P0 has been considered to be current market price. Leave it there. Clear with this? Your note, your answer is correct. Clear with this, guys? Go and just update your library of adjustments. Write down KR hyphen dividend growth model. Quick. Dividend growth model. Within bracket, use CMP for KR and IP for KE. Use CMP for KR and IP for KE. Done? CMP stands for current market price and IP stands for issue price. Good. Now let's move on to the next question, number 9. Calculate KR when KE is 20%. The rate of flotation cost is 5% and the rate of personal income tax is 30%. Ideally, this flotation cost, whatever given here, is nothing but the brokerage, right? They mean the brokerage, guys. Okay, don't mistake this to be flotation cost from the viewpoint of the company, since these figures are given. So what do? I told you the second formula you need to use. KR is equal to 1 minus TP. KR is equal to KE into 1 minus TP into 1 minus, I told you, TB, or if any abbreviation you can use, not a problem. So basically what you need to do, 20% into 1 minus 0.3 into 1 minus 0.05. Are you clear with this, guys? Hello? Yes, you guys are clear with this direct calculation, and you can do, and that's about this question also. Clear with this? This was somewhere tested, in a past exam or RTP, I don't remember, but yes, it came in. That's the reason why. Very much a part of your syllabus. That's the reason why I've kept it in this book. Clear with this, guys? You just go and update your library for adjustments. Write down KR hyphen with personal income tax and brokerage. With personal income tax and brokerage. With personal income tax and brokerage. Personal income tax and brokerage. Done? Done? Shall we move to the next one? Question number 10. ABC Limited provides the following data. RF stands for risk-free rate of return is 7%. Beta is 1.20. Look at this. RM minus RF is how much? 6%. Had I been the examiner, I would not have given it like RM minus RF. I would have mentioned the words market risk premium, and I would have seen whether the students are able to figure it out. Clear? Right? Calculate the cost of retained earnings as per CAPM method. Now it's nothing, guys. KR is equal to KE here. No flotation cost. Those issues are not there. So what is the formula here? KR is equal to RF plus beta times RM minus RF. So 7% plus 1.2 times directly multiplied 6%. Here with this, right? You get a total of 14.20%. Are you able to understand? Any issue, any problem here? No? Just go and update your library of adjustments. That's about it. Let's move to the next area. Write down KR-CAPM approach. KR-CAPM approach. Yes, done. Now, I'll just give you a minute time. Go through whatever we have seen till now. Just go through whatever we have covered till now. That is your KD, KP, KE, KR. Right? KR, do the smart work. Don't once again go through everything. KR is equal to KE, subject to two exception. One, ignore flotation cost. Number two, in case personal income tax and brokerage are given, that also needs to be adjusted. That's about it, KR. Yeah, this. Quickly go through it. Now, why I'm saying this is because now we are moving to the comprehensive part of weighted average cost of capital, which is a combination of everything. Quickly go through it. Okay, done. Right. Now let's move on to the most what do I say, the comprehensive area of this particular chapter, which is calculation of weighted average cost of capital. Right? As I told you in the previous session, in the introductory part, the weighted average cost of capital is popularly called as, the short form for it is KO. O stands for overall cost of capital. Okay, that is the short form used, and it's very simple. It cannot be calculated separately. It is nothing but the weighted average costs of the respective source of finance. Here with this. Sir, how do we do it? Right? We will learn this calculation through the next numerical problem. Okay? So the next numerical problem, we will learn this particular concept. Clear with this, guys? Shall we get started? Fine. Right? And basically here we all know that the company does not procure entire funds from a single source. Right? It takes from multiple sources of finance. Correct? Your equity share capital, your preference, there are multiple sources of finance. Every source of finance has a cost associated to it, and the weighted average cost of every single source of finance put together is called as your weighted average cost of capital. Here with this, guys. Last class, that is in the previous session, I told you, right, 30 crores from equity, 20 crores from preference, 50 crores from debt and all. Total figure was 100 crores. You give me one figure. What is the weighted net cost for raising this 100 crore rupee of funding? I told you, no, that calculation is called as weighted average cost of capital. Not a problem. Let's quickly open the next question, and using this question we will get introduced to the WACC calculation. Now, calculate the weighted average cost of capital using the following data by using book value weights, market value weights. What is a book value weight? What is a market value weight? I will walk you through. Don't worry about it. Right now, just read the question. Okay. The capital structure of a company is as follows. The company has raised a total capital of how much? 20 lakhs. Out of this, debenture route 5 lakh, preference shares 5 lakh, equity shares 10 lakh. Clear, guys? Right? Done. Now, all these shares, what is the face value given? 100, 110 respectively. Given now. Guys, yes, participate. No. The market prices of these securities are also given. Debentures, 105 rupees per debenture is the current market price. Preference share, 110. Equity share, 24. Clear with this? Additional information. Rupee 100 per debenture redeemable at par with a 10% coupon rate, 4% flotation cost, with a 10-year maturity. Basically, they have given you the ingredients to compute the KD figure. Clear with this? Any problem here? Next, 100 rupees per preference shares redeemable at par, 5% coupon rate, 2% flotation cost with a 10-year maturity. What have they given? Ingredients to compute. Guys, KP. Clear with this? Next, equity shares have a 4 rupee flotation cost in the market price of 24 rupees. Clear with this? Right? Next, the next year expected dividend is rupee 1 with an annual growth rate of 5%. Clearly, out of the 5 methods of calculating KE, which one will you use? Which one will you use? Dividend growth model, Gordon's model you will use. The firm has a practice of paying all the earnings in the form of dividend. That's okay. Corporate tax rate is 30%. Now, if nothing was given, what can we do? For KE, KD and KP calculation, shortcut and leave. But what have they said? Use YTM method to calculate the KD and KP. Here with this IRR. So, one IRR for KD, one IRR for KP, right? So that means two trials you need to take. IRR calculation itself will be one question. Your 2 IRR calculations, independent source of finance, everywhere you need to calculate the cost. Finally, having computed that, I will teach you how to compute the weighted average cost of capital. So this sum is actually a revision of all the concepts that we have studied till now, right? And over and above that, having computed the independent sources of finance, having computed the cost of independent sources of finance, now go ahead and compute the overall cost of capital. Clear with this, guys? Comprehensive question. See how in a graded manner we have moved, right? Fine. Till now, respective cost of capital we calculated, the respective cost, every source we calculated. Now, this is a very comprehensive question. Now, guys, very simple and straightforward. We all know how to do it. First, KE calculation. What do we do, guys? So, you guys only told me it's going to be dividends growth model, popularly known as Gordon's model, right? Now, what is the formula to calculate this? What is the formula to calculate this? D1 divided by P0 plus G, where P0 stands for net proceeds. How much is the D1? Look at this. Next year, expected dividend is 1 rupee. So, this figure is readily available. Any issue here? No. Now, what is going to be your net proceeds? They have given in the question, equity shares have a current market price of 494, which means what? Issue price they have not given. Market price is given, second priority, I can take that, correct? If I go to the market today, I can get 24 rupees. But will I be able to get this entire 24? No. For me to get this, I need to incur a flotation cost of 4 rupees. So, the net amount I get is only 24 minus 4, which is going to be 20 rupees. Clear? Plus growth rate given in the question as 5%. So, KE calculation is over. Simple. Guys, correct? Done. It's going to be 10%. Any problem here? Any problem here? No. The next one. KD calculation using YTM method. If YTM was not given, what will you do? Hello? Will you use what? Formula method? No? Guys, answer please. Yes? What is the formula? No interpolation. If YTM was not asked in the question, you would have used the formula method. What is the formula? I into 1 minus T, come on, plus RV minus NP by N, the whole by RV plus NP by 2. That's all, guys. That's all. Very good. Clear with this, right? That's simple. This is the power of conceptual learning. Clear. If they had not mentioned anything, we could have used this, but can we use it now? Absolutely not. So I'm just erasing it off. Okay, right. Now in this question, so what we need to do once again, present cash flow equation, present value of cash inflow should be equal to present value of cash outflow, and all we need to do. So basically what happens here, guys, so basically in this case, every year, so first, what have they given? How much amount do they get? The market price is going to be 105, correct? So nothing is given. I will assume that market price is the issue price, correct? No, right? We need to calculate net proceeds. Today, what is going to be my inflow, right? Nothing is mentioned. Don't say nothing is mentioned. They have given the market prices. So I can take this as my issue price, correct? No, right? But will I get the entire 5 rupees? No. They have said debentures have a 4% flotation cost. Now, one more issue here. It is given as 4% on issue price or on face value. It's an assumption that you can take. In this question, what assumption have they taken? They have taken this as a issue price. Hence, I have written a note here. right? See, these solutions were actually framed by, I improvised a solution. It is not as such in the study material, I improvised this, right? It is assumed that flotation cost is a percentage on issue price. Clear with this, guys, right? So my initial inflow will be how much? 105 minus 4% on 105. Agreeing with me on this, guys? Yes, this you are able to understand? Yes, guys. Next one, right? Every year, what is going to be the present value of, what is going to be the outflow in this case? We are talking about what? Debentures. It has a 10% coupon. Every year, you are going to pay how much? 10 rupees as the interest amount, correct? But wait, it comes with what? It comes with a tax shield of 30%. So every year, my effective interest cost is only going to be rupees 10 into 1 minus t, correct? Right? And at the end of the period, what am I going to do? I'm going to repay it at par, correct? So the cash flow equation will be 105 minus 4% on 105. There's nothing but issue price minus flotation cost should be equal to my annual post-tax interest payout into present value annuity factor of, I don't know what percent, R% of 10 years, because that R needs to be found out, plus 100 rupees into present value interest factor, last only one cash flow of R% for 10 years. Are you clear with this? And the rate at which my present value of cash inflow is exactly equal to my present value of cash outflow is called as my IRR, and IRR calculation for debenture is called as KD, or in other words, the KD rate that makes my NPV 0 is actually my KD. Are you clear with this? The rate that makes my NPV 0 is equal to is going to be my KD actually, right? So in this case, what they have done, they have taken two trials, 5%, 7%. Right? Do it smart. In exam, follow this approach. What they did, year 0, cash outflow was how much? 100.8. 100.8, how did you get? 105 minus 4% on 105. In other words, 96% on 105. If you do, you get what? 100.8. Are you getting it? Yes? No. This is already in present value. Guys, correct. Today only it happened at present. So into 1, you get this. Now, for a period of 10 years, what happens? There is a cash flow of 7 rupees. How did you get the 7? 10 into 1 minus tax rate. Guys, correct, right? 10 into 1 minus 0.3, or 70 per 0.7 into 1, 0.7 into 10, that's going to be what? 10 into 0.7, that's going to be 7 rupees, correct? Now, here I used the annuity table, right? For 7 years, it's going to be what? 7.722, right? You multiply to get the figure. And at the end of the 10th year, you have an outflow of 100 rupees. So 100, right? With a discounting factor of 0.614, you get how much? 61.4. So now you pray God that you should get 0. Correct, guys? NPV, you pray God that you should get 0, but what happened here? You're getting a positive NPV of 14.65. Here with this guy. Now what you do? You take another trial of 7%, arrive at the NPV, right? It is, you are getting somewhere minus 0.83. Using the interpolation technique, they calculated what? They calculated the KD to be equal to 6.8. Are you clear with this? Are you clear with this? Now. One second. There is one issue here which you didn't ask. I thought someone will ask. You didn't. Now what? Wait. Now we are, in this case, this is going to be the calculation of KD. We are doing this from the perspective of whom? The company. How will the company have? First, there will be an inflow followed by a series of outflow. How they have done this calculation? First, they have put whatever they are receiving in negative. And then whatever they are going to pay, they are putting it in positive. Don't worry, the calculation will not change. This is exactly done as per study material only. Sir, no sir, I want to put this in positive. I want to put these in negatives. Will my answer change? It will not change. You try it. It will not change. You try it. Because what is outflow? There goes as an inflow here. Clear with this? You can take 0 to any side. Are you clear with this? Present value of cash inflow minus present value of cash outflow should be equal to 0 now. The same thing will be what? Present value of cash outflow minus present value of cash inflow. As simple as that. Clear with this? Clear with this? Right? There will not be any problem. Do not worry about it. Done. If you want, you can try it. There will not be any problem. Because that's why I said a complete financial transaction will have both inflows and outflows. Clear with this? So that's why maybe this computation they have done from the perspective of the investor, okay, except for the flotation cost component. That's why I said return from the viewpoint of the investor. is equal to cost from the viewpoint of the company. If that logic is working out, it means the mathematics is working in your favor. Both the sides of calculation should be the same only, no? Here with, right? That is the reason why this is being done. So do not worry, sir. I want to put this in positive. I want to put these in negatives. Yes, you are correct. You can do it like that. No problem at all. This will become negative. This will become positive. You change the trials accordingly. You will get the right answer. Do not worry about it. Are you able to follow this? Are you able to follow this? Right, guys? And that's about this. Fine. Now, in case of preference shares, what happens? A similar calculation they have given here. Preference shares. So market price is going to be 110. I can assume that to be my issue price, right? It's come with a coupon rate of 5%. Coupon is not a very right terminology with respect to preference. You call it as a dividend rate only, because coupon is something that you use only in your debt instruments. Okay, but anyways, it's given in the question. Let's not question it back, right? And then it's 2% flotation cost is given. Once again, nothing is mentioned here. Assume it to be either on issue price or face value, right? So now what do you do with the 10-year maturity? Similar calculation. So initial, what is it going to be? So the net proceeds is going to be 110 minus 2% on 110, right? This should be equal to every year I'm paying a dividend of how much? 5% they have given, no? So 5% on 100 is going to be 5 into annuity factor table for 10 years. Plus at the end I repay back the 100 rupees, 100 into present value interest factor of R percentage and for 10 years. Clear with this, guys? Any problem here? Any problem here? Are you able to frame this cash flow equation? Initial outflow, initial inflow for the company was 110 rupees minus 2% of flotation cost, right? And annually throughout its life, they are paying how much? 5 rupees dividend. At the end of the period, they are repaying back the 100 rupees also. Or if you look at it, initially they are receiving how much? 107.8. How did you get 107.8? It's going to be 110 into 0.98. Correct? No. That is 2% reduced, 98%. Correct. Every year they are paying 5 rupees, and at the end they are actually going to repay back 100 rupees also, right? At a 3% discount rate, they are getting a positive NPV, 5% discount rate, negative NPV, interpolate, arrive at the answer of 4.08%. Guys, are you able to understand this? Any issue, any problem here? Please tell me, right? Same IRR, same IRR. Now are you able to understand why I did IRR at the time value of money level itself? If we didn't do all that at that point of time, then right now in cost of capital chapter, I should be explaining you the calculation of IRR. Clear? That's why then and there we segregated and we dealt with it separately, because this chapter itself has its own rich issues. Clear with this? Clear with this, right? Now overall what happened? We are summarizing. Okay. Now debentures, in the question is given, no? The book values and all, the values are given. 5 lakh, 5 lakh, 10 lakhs. Correct? Guys, please, look at the screen. Look at the screen here. I want you guys to pay full focus here. Now is where we are going to learn how to compute WACC. Now, each source of finance is there. Debenture, preference shares, equity shares. 5 lakh, 5 lakh, 10 lakh. Total is 20 lakhs. Correct? Now look at this component. This column, you look at it. The cost of debentures, we calculated it as what? 6.89%. Guys, correct? No? 6.89%. Cost of preference shares was how much? 4.08%. Cost of equity shares was how much? 10%. Guys, correct? Or can I say, for me to raise this 5 lakh, every rupee of this 5 lakh, I incurred a cost of 6.89%. Guys, correct. Please pay focus here. For every rupee of this 5 lakh, I incurred a cost of 4.08%. For every rupee that I raised in this 10 lakh, I incurred a cost of 10%. Now we want to know, don't give me all this. Overall, how much is the company raised? 20 lakh. For this 20 lakhs overall, what is the total cost of capital that the company has raised? Give it to me as a percentage. Now guys, 1 minute. Can I say this is nothing but, can you just, you guys are having the figures with you, no? You just help me with the figures. I will just put it here. Now, with respect to debt, what is the cost, ma? Percentage alone, you tell me. 6.89% into what is the amount of debentures? Hello.
5 lakhs.
Into 5 lakhs. You please concentrate here. You need not write down anything. I humbly request you. It's a calculation thing that I'm telling you right now. Right? Plus. Now, here for preference, what is the cost? 4.08% on what? 5 lakh. Literally, this is the total cost I'm spending on preference. Yes. Plus on equity is going to be 10% on what? 10 lakhs. Strictly speaking, in terms of total amount, I'm saying 6.89% on 5 lakh I've incurred, 4.08% on 5 lakh I've incurred, 10% on 10 lakh I've incurred. If you add this, you will get on bulk amount. This is the total amount you have actually spent as a cost for raising a total amount of how much? 20 lakhs. Correct? This is basically, can I say this is the formula for calculating my overall cost of capital? Respective cost in amount divided by what? The total overall capital amount. Correct? No. Right? Total cost divided by total capital is cost expressed as a percentage. Is correct. Yes. Or this equation, this is what? 5 lakh. This is what? 5 lakh. This is what? 10 lakh. This figure I'm saying. Can I rewrite this? The same equation, can I rewrite this as 6.89% into 5 lakh by 20 lakh? This is 20 lakh, no? Plus 4.08% into 5 lakh by 20 lakh plus 10% into 10 lakh by 20 lakh. Can I rewrite this? Rohit, please focus here. I don't want you to do the calculation. Right? Are you able to understand this? Are you able to understand this? Yes. Can I rewrite it like this? Yes. Or further, can I say this is nothing but 5 lakh by 20 lakh is what? As a proportion. 5 by 20 is how much? 5 by 20 is 1/4, 0.25. Can I say it's 6.89% into 0.25? Yeah? 5 by 20 is how much? You do and tell me. 0.25, correct? Plus 4.08% into 5 by 20 is once again 0.25 plus 10% into 0.5. Correct? If you do this, you will get the entire overall cost of capital. Or. In other words, can I say this is what? Cost of debt. KD into 0.25 is what? This is nothing but debt was actually 5 lakh out of the total 20 lakh of capital employed. Can I say debt comprises of 0.25, that is 25% of my entire capital structure? Correct? So can I say this is nothing but weight of debt in the entire capital structure? Correct? No. In the entire capital, the weight of debt was 0.25. I call this as WD. Plus this 4.08 was KP into 0.25 was weight of preference, WP. Plus this is KE into what? WE, that is weight of equity. This is the reason why they have done it like this. The respective weights they have arrived. 5 by 20 is 0.25, 5 by 20, 0.25, 10 by 20, it's going to be what? 0.5. Now if you add up, obviously it needs to be equal to 1 because you're adding up everything, right? And finally what they have done, the respective cost they have given here, and what they are doing is KO is nothing but marrying all the figures, right? It's nothing but the respective cost multiplied with the respective weight, you do it, and overall you add it, you get how much? 7.743%, or this is nothing but total cost you take as an absolute amount divided by 20 lakhs. That is the same percentage only, but there is a way in which you calculate. So basically, in short, can I say KO is equal to KEWE plus KDWD plus KPWP. Clear? Are you able to understand? Are you able to understand this? This is the logic for nothing but simple mathematics, numerator by denominator, but it is separately written in a certain way. Are you able to understand this, guys? Any problem here? You guys are able to follow this? Yes, sir. Yes. You guys are able to understand? Now, these weights are there, no? These weights can either be book value weights, or you can also use market value weights. That is, when you are calculating the proportion, you can use the book value as the base to calculate the weight of that particular source in the capital structure, or you can also use the market value weights. Clear? In case you are using market value weights, what happens in the question they have given? Total debentures is how much? 5,000, but every debenture is currently quoting at a market price of how much? 105. So the market value of debenture is going to be 5,25,000. Guys, correct? Yes, sir. Correct. Now, preference shares, every share is being quoted at what? 110 rupees. 110 into 5,000, 5,50,000. Equity share, every equity share is being quoted at 24. Don't say I'm adjusting for flotation cost. Here we are just computing the market value. Here with this. So 24 into 1 lakh, it's going to be 24 lakh. So overall, the market value of my capital employed is going to be 34.75 lakhs. Correct? So based on this, you arrive at the respective proportions. 525 divided by your 34 lakh 75,000. 5 lakh 25,000 divided by 34 lakh 75,000, you get this weight. 5 lakh 50,000 divided by 34 lakh 75,000, you get this weight. And 24 lakh divided by 34 lakh 75,000, you get this weight. Are you clear with this? Add up everything, it has to be 1. It's simple proportion, guys, right? And multiply the respective costs with the respective weight and add up everything, you will get your cost of capital. Clear with this, guys? Are you able to understand this? Are you able to put it short? Cost of capital is nothing but the respective cost multiplied with the respective. Are you able to understand? Now the weights can either be book value weights or it can be market value. Preferably, which is the most correct weight? Market is the king always. Remember, today what is there? The book is irrelevant, right? Book means what? Your books, that is your account, your financial statements, right? Market perceives this value. Based on that, if you compute, you get a realistic value. Sir, the question is silent, sir, and I have both book value weights and market value weights. Which one should I follow? Your choice. You do anything but write a note and put that. Are you able to understand this? Yes, guys, you guys are able to follow this? Yes. That's about this question. Now, just go and read. Now you just go and see this. 1 second. Yes. Look at this. Steps to calculate, I have just given. Calculate the total capital from all the sources of finance. Respective costs you do. Arrive at the proportions. I have just given the step. This is like the book definition. So no need all that. Practically we did one question and that's about it. Okay. Okay, fine. Now, for calculation of WACC, there is a choice of weights between the book value and market value. And while the book value weight is operationally easy, because ready figures are available, right? Market operationally easy and convenient. The market value weight is more correct and represents the true, the true value of the firm's capital structure. But remember one thing: in case a question is silent, you are free to decide whichever you want to choose. Are you able to? You guys are able to follow this, right? And that is about this particular question and this particular topic on your weighted average cost of capital. Now you just go and update your library of adjustment right now. Write down WACC, WACC hyphen BV and MV weights. BV and MV weights. BV stands for book value, MV stands for market value. BV and MV weights, right? Semicolon, KD and KP using IRR, semicolon, KE within bracket Gordon. It's a summary of what we did in this question. One look the day before your exam, you will know whatever we went through in this particular question. KD and KP using IRR, semicolon, KD within bracket Gordon. Done? Okay, fine. Now, second. Now, just go to the next question here. Look, guys, these 11A, 11B and all, you please do it by yourself. Similar sums, similar in many aspects, but I have just kept it here for your practice purpose and all. Right? This is a past exam question. This is all very, very same. So you can easily crack it. No difficulties at all. So you please do it. Okay, solutions are given. You can also have a look at it. But please attempt it by yourself. I ask you to solve all these questions in a separate 400-page long size rule notebook. You do all these things. Okay, fine. Now let's move on to the next question, which is question number 12. Question number 12. Now, guys, mark this sum as important. Mark this sum as important. An excellent sum. If I was an examiner, I will test this sum in this chapter. If I was given the freedom or liberty to fix your paper, this is one question that I will be eyeing on always, because this question will test a lot of concepts across the entire chapter, right? So that's one beauty of a question. This is, mark this as important. I call this question as the masterpiece, right? Masterpiece. Generally, I don't grade all the questions really well. Only if some question is really good, I generally give this naming and all. This question is an excellent question. Must visit the day before your exam. Mark it somewhere. So all the important questions, you please mark it somewhere. It needs to be revisited the day before your exam. In your library of adjustment, when you're updating, you also mark it. Now let me read this question for you. And in this question, there is one incremental learning also, right? I don't repeat anything in the class. Yes. Determine, guys, full focus here. Just pay attention to whatever I'm saying. That's more than enough. Assume this question is coming in your exam, right? Pay full focus here. 8 to 10 marks easily it can be tested if it comes. Determine the cost of capital of BestCAClasses Limited using both the book value and market value weights from the following information given below. Equity, retained earnings, preference, debentures. Book value figures are given. Market value, equity shares they have given, retained earnings nil, preference and debentures they have given. Wait, let me not proceed further. First question to you. Why? Sir, the first question that you should have in your mind. Sir, market value they have not given for retained. Why? Why? Don't tell me. Any guess? Why have they not given this market value figure for retained earnings alone? Attempt. You didn't issue anything, but doesn't it have a market value? It can have, no? It is retained with the company, so which means the market value should be equal to book value. If it is retained, market value should be equal to book value. Why have they put it as 0? I'll tell you. Simple, guys. What is this 2 crores? Market value of equity. This 2 crores includes the value of retained earnings as well as the value of equity share capital, because from the perspective of the market, they don't segregate the two. Market is giving a value for the entire equity shareholders funds. Are you able to understand this? Yes. Are you able to understand this? That is the reason why separately for retained earnings, they don't give you the market value. Are you market value asset? Here with this, right? So now quickly, let me tell you what to do in this case. Sir, then in this question, you will be having KE, KR, KP, KD. You will be having all 4. Correct? No. If I'm using book value as the weights for calculating my WACC, independent cost calculation, not a problem at all. This issue will come only if you are only when you are computing the weighted average cost of capital based on market value weights. Now what happens if I'm using the book value weights? W is there, that is weight of equity is there, weight of retained earnings is also there, weight of preference is also there, weight of my debentures is also there. Respective weights are available, no? Correct? I can do it. Sir, but if I am going to follow market value weights for the other 3 sources of finance, for equity, preference and debenture, I don't have a problem. Why? Because the readily market value is available. Sir, for retained earnings alone, there is no market value given, sir. How can we do this? Doubt is there or not? Doubt is there or not? 2 approaches are there. Approach number 1. Approach number 1. Ignore KR. It's okay. Take only KE, because the market has already valued this particular. It has already, included this value of retained earnings in the equity level itself. And we all know KR is equal to KE. Anyways, yes. Right? So no problem at all. Ignore it. Right? Or approach number 2. It's okay. Retain it. But how do I retain it, sir? 2 crore is the value of this entire component together. Segregate this 2 crore in the ratio of their book value. That is 120:30. You segregate it and only give this share. 1 share you give it to equity. 1 share you give it to retained earnings. Are you clear with this? Are you clear with this? Which approach to follow? You can follow any approach. Number 1. Number 2. So suppose I am ignoring, I am following approach number 1, which means I am ignoring the weight, market value weight itself for retained earnings. And we are coming across a scenario where KR is not equal to KE. Why? There could be flotation costs. Correct? No. If there is flotation cost, then KR figure will be different from KE figure. No. Yes. In that case, what can we do? Still, there is no concrete guidance on that by our institute. They are still saying you can use any method. In my opinion, whenever KR and KE are different, right, in that case, it is better to split. This is what I would say, because KR has a value which is different from KE, then it should also be given some weight and separately calculated, right? Suppose KR is equal to KE, whether you follow approach 1 or approach 2, the answer will be the same. Are you clear with this? Are you clear with this? This is actually something that I want to tell you, and not just that. Fun is not over. This question has one hidden beauty in it. I want to know if you guys are able to, I want to see if you guys are able to figure that out. But first guys, coming back here, when you have retained earnings and when they are asking you to calculate the market value weights, there is one issue here. What is this thing? So retained earnings does not have a separate market value. So what can we do? Two approaches. One, ignore KR, that is the weight of KR. You ignore it. Ignore KR means KR needs to be computed. At the time of computing your WACC, do not give it any weight. Only 3 sources of finance will be considered, right? Or number 2, split the market value of equity into your equity share capital and retained earnings in proportion to the book value weight, and then you arrive at the market value for all the sources of finance, and based on that you can compute your KO. Here with this, let's move on and proceed further. Additional information. Why do we have additional information? To compute the respective cost of finance from each source. Equity shares are quoted at 130 per share, and new issue price is priced at 125 per share, which will be fully subscribed. The flotation cost will be what? 5 rupees per share. Clear with this, guys? Fine. They have given both the current market price as well as the issue price. Clear with this? Strictly speaking, what should we do? This should be considered for the purpose of KE calculation, and 130 should be considered for the purpose of KR calculation. Guys, correct? Formula is same. But when you are considering this, you should take 125 minus 5 for KE calculation. For KR, 5 minus 5 and all will not come. You should only take the current market price. Right? We will see what institute has solved. Whether they have taken 130 or 125, that we don't know. Because I told you that's a lacuna. Some places they have taken issue price, some places they have taken current market price. In my opinion, for KR calculation, you should only take 130, right? Issue price, current market price, KR calculation. Next, dividend. During the previous 5 years, dividends have steadily increased from 10.6 rupees to 14.19 rupees, and dividend at the end of the current year is expected to be 15 rupee per share. First of all, this data, dividend at the end of current year is expected to be 15 rupees. Means what? This is directly D1. Correct? Expected to be at the end of current year. Clearly they have given this is D1. Correct? Why have they given this data? During the previous 5 years, dividends have steadily increased from 10.6 rupees to 14.19. Why have they given this data? This question, they are expecting you to do it under Gordon's model. Hello, madam. Yes, Gordon's model you need to do. But for Gordon's model, you need a growth rate. The growth rate been given in the question? No. But they have given you a hint to calculate the growth rate. They have said in the past some data. From 10.6 rupees, the dividend amount has grown to 14.19 rupees in a span of 5 years. Based on this, you can calculate the growth rate using this hint. Are you understand? Don't take your calculator, you will not be able to do it. You cannot do it because it is not possible just like that. You need some logarithm and all. Right? Computation, set it aside. I will walk you through. First, to focus on the pain points in every sum. Don't take and start doing it. It doesn't work out that way. Right? Fine. So here they have given one hint to calculate. Next. Preference shares, 15% preference shares with the face value of 100 would realize 105 per share, which means the current market price that you can take. Nothing else is given. Okay. Which means what? This is irredeemable model. Life is given, huh? No, life is not given. So it's irredeemable. Here with this. Right? Next. Debentures. The company proposes to issue a 11-year debenture. Finite period is there. So redeemable. 15% debenture. But yield on the debentures of similar maturity and risk class is 16% with a flotation cost of 2%. What is this? No beta. Nothing. No beta. Beta is there only for equity. It's not there for debenture. Now, guys. Now, guys, 1 minute. First, you think debenture KD calculation. Okay. Now, have they asked for any yield method? That is, have they asked for any IRR method or not? No. Fine. Any method you use, not a problem. First thing, you need today's net proceeds. You need, correct? No, guys, correct. How do you calculate the net proceeds? Issue price minus flotation cost. Flotation cost is given, not a problem. In this question, has the issue price been given? Then what will be the issue price? Don't say, sir, no data is given in the question. I will assume issue price to be equal to, some what 100 rupees or what is that, 10 rupees or whatever it is. No, you can't take that assumption here. This was an RTP question. What is that? This is the reason they have given this data. Yield on debentures of similar maturity and risk class is 16%. This is what they have given. This is a hint to calculate. This is a hint to calculate your. How do you do that? I will tell you. If not yet covered, I will tell you. For that only, right? And then tax, corporate tax is 35%. Ignore dividend tax. Flotation cost would be calculated on the face value. Perfect. In this question, they have given the clarity. All the flotation costs are calculated on face. Sum it up. This question has 3 important learnings. Learning number 1, there is no separate market value for retained earnings. Learning number 2, growth rate is not directly given, but they have given a trend for 5 years. Using the trend, you need to observe and find out the growth rate. Number 3, there is something called as yield that is given on debentures, using which you need to arrive at this. Here with this. First, let us hit the nail on the head. Let us calculate this. Let us take up this issue. Guys, very important understanding. Remaining part computation, anyone can do it. That is very easy. Focus on the most important part. Now, read this question and carefully just interpret. You will be able to kind of understand the wordings. What they are saying. Our company proposes to issue a 11-year debenture. Right? 15% is what? Coupon rate. Means what? Interest. 100 rupee debenture value. 15 rupee will be the interest amount I'll pay. Correct? But the yield on debentures of similar maturity and risk class is 16. Flotation cost. Forget flotation cost. We will use first. What is the meaning of this? How do you conclude? Now, basically, issue price means what? The price at which I'm going to raise this particular source of finance. Or in other words, alternatively, can I say this is the amount that the investors are willing to pay to the company? Now, from the perspective of the investor, you think investor in this case is what? A debenture holder, right? He is saying, on my whatever investment that I'm going to make, I want a return of 16%. That is a meaning, no? He wants a yield. The yield on debenture of similar maturity and risk class is 60%. He is wanting an yield of 16% net. On my investment, net effect, I need to get how much? 16% return. Agreeing with me. This is the meaning of that. How do you compute the return? This is nothing but return as a percentage. Return on investment is nothing but what I receive divided by how much I invested. Correct? No. Correct? No, guys. What is he going to receive? Every year he's going to receive a coupon of 15%. 100 into 15%. How much is he going to receive? 15 rupees. On what? That's what I need to. Correct? No. Correct? No. Right? So, or in other words, can I say this is the amount that I'm ready to invest in the company? Correct? No. This is nothing but issue price from the viewpoint of the company is nothing but the amount that the investor is actually investing in the company. Guys, correct? You are able to understand. So in this case, what happens? So I need to calculate what is the issue price, what is the amount the debenture holders are willing to pay. Can I say this goes to the other side? This comes out to rupees 15 divided by 16%. How much is that? 93 0.75 rupees. Max for this debenture, I will be willing to pay only 93.75. Only then, whatever 15 rupees that you are paying now, this will never change. Coupon rate, fix it, right? 15 rupees. You see, you fix your issue price in such a way that you make this 15 rupees equivalent to 16% return on my investment. This is the meaning of yield. Are you able to understand? I'm repeating. I am going to get 15 rupees for sure, correct? But only if I am investing 93.75 rupees and getting this 15 rupees, it gives me a net return of 16%. Are you able to understand? Right? You're all able to understand this. Or in other words, can I say this issue price is nothing but interest amount divided by yield, a percentage. Agreeing with me? Not write it down somewhere, right? Issue price is equal to, an alternative way of calculating is interest amount divided by yield as a percentage. Agreeing with me on this, guys? Yes, you guys are able to follow this. Write it down somewhere. It's not there in the book. It's not there in the institute study material also. Randomly, they have done this, as in random, I wouldn't say, but they have just done it and left it there. The logic cannot be understood without all this explanation. That's why I asked you to pay utmost attention here. Clear with this? Clear with this? Logic you are able to understand, right? It's nothing but a simple return on investment. Clear with this, guy? Yes. So look at this. This is what they say, because for KD calculation, we need to use what? This formula only. For this formula, we need to find out net proceeds. Net proceeds, how will you get? Issue price minus flotation cost. But issue price is not there in the question. We need to compute issue price using this. Issue price is going to be 93.5. One more add-on point I will tell you. Now you are understanding why some debentures are being issued at a discount, why some debentures are being issued at a premium. It is because it is all dependent on how much return or yield the market is expecting. Are you able to understand? Are you able to understand? If that yield is exactly equal to your coupon rate, if this was 15%, then the issue will be at par. Because what you pay is exactly equal to what I expect. I will be ready to pay you the entire face value. Clear with this? Suppose my yield is more than your coupon rate of 15%. In that case, you necessarily need to issue it at a discount. If my yield is less than your discount rate, you will be issuing it at a premium, right? This is the overall concept in this case, but this is okay. Whatever I said just now, that is also fine, not a problem. Did you understand this concept? How they have done it here? Look at this. Since the yield on similar debenture is 16%, the company would be required to offer the debentures as a discount. Directly they said. These are institute's wording, not mine. Logic for this is not explained. Market price of debenture approximately is equal to 15 rupees divided by 0.16, 93.5. Done. That's all. How did you arrive at this? This is the background logic. Here with this, guys. Go over the study material and look at this question. You might not understand. That's why I said it's a very, very important question. Here with this. Now, there is an alternative way of calculating this also. They have given no. The yield required is how much? 16%. Right? So from the perspective of the investor, what you can do, you can use the time value of money technique and also do this. Correct? Every year he is going to receive how much? 15 rupees. Right? Into present value interest factor annuity of 16% for 11 years. Right? Plus at the end he is going to get 100 into what the present value interest factor for 16% is 11 year. If you use like that, what you will get is, you will get the issue price has to be 94.935, but the method which we used was an approximation method. We arrived at 93.75. Are you clear with this? This can also be done using time value of money technique, but this is just for information purpose. Follow this in exam. Clear with this? This is what institute has also followed. Clear with this, guys? Hello? Clear with this? Clear with this? So now what students will do is, having thought so much, they will directly take this 93.75 as what? They will take this as the net proceeds. No, guys, that is not the net proceeds. From this, you need to reduce this 2 rupee flotation cost. 91.7 be taken as what? Net proceeds. And in this calculation, they have taken this 91.75 as net proceeds, right? So the normal calculation, KD calculation, I into 1 minus T, 15 rupees into 1 minus tax rate, plus RV 100 minus NP, just now we got divided by 11, the whole by RV plus NP by 2. They have arrived at 10.95%. Are you clear with this? KD is over in this sum. Done, guys. You are all able to understand. Remember this, in this question, issue price was not given. You had to calculate using that formula called as interest amount divided by yield percentage. Logic was explained just now. Clear with this? Next. Now, the next issue in this question is about calculating the growth rate. Now, what have they mentioned in the question? Dividends have steadily increased from 10.6 rupees to 14.19 rupees in a span of 5 years. Right? Or we know this now, guys. We know this formula basically. Can I say future value is equal to present value into 1 plus r the whole power n? So no, simple compounding formula. Or can I say in this particular area they've said 14.19 rupees is the dividend after 5 years. Correct? Not after means from today, no. Some past data is given. Relative measure, I'm saying, as compared to the base year, 5 years later, they were receiving a dividend of how much? 14.19. Correct? No. So basically, this is the future value. Right, guys? The present value was how much? It was actually 10.6. So 10.6 rupees has become 14.19 rupees in a span of 5 years. Correct? The equation will be 10.6 into 1 plus r to the power 5 is equal to 14.19. Agreeing with me on this? Are you first able to understand this? Right? Don't take this as D1, D0 and all. Some random 5 years they have given. Right? So for that, from the base year, the figure was 10.6. It has grown to 14.19 in a span of 5 years. I can use the formula. So future value is equal to present value into 1 plus r the whole power n. In this case, instead of r, they have used one variable called g because we are calculating the growth rate. Are you clear with this? Done, guys. Now, in this case, what you will do? So this 10.6 will go to the other side. Is multiplication, no? 10.6 into 1 plus d the whole power 5 is equal to 14.19, or 1 plus d the whole power 5 is equal to 14.19 divided by 10.6. Correct? No? This is equal to what? 1.138. Now this you should go and see in your future value table. Clear with this? You should go and see it in your future value table. In your future value table, they are saying 1 rupee compounds to 1.335 in 5 years, right? At a compound rate of 6%. This value will generally be given in the question. That is, this is your compound interest rate. Your compound interest, your future value interest factor will be given in the question. Don't worry about that. Clear with this, guys? So basically what the meaning of this is, 1 rupee grows into 1.338 rupees in a span of 5 years only when the interest rate is 6%. This is the meaning of that. That is exactly what they have given, no? 10.6 rupee has grown to 14.19 rupee in a span of 5 years. Calculate the interest rate. We did all this calculation and we have said 1 plus g the whole power 5 is equal to 1.338 rupees. The table reference we took 1.338. If you go and find it in the table, you can find it under future value interest factor for 50 year. So at which rate is this amount tallying? If you see, you will get it exactly at 6%. Based on the table figure, we have got that growth rate is equal to 6%. Are you able to understand this? So this is what, for how many years? 5 years, 5 years, wait, I will show it right now. Appendix we will go. This is present value table, future value annuity, future value table. Now look at this. Future value table is there. Correct, guys? Right? So percentage, we don't know. We need to find out. But period was given. Yes. Go and see against which value the figure you are getting an answer of 1.338. If you exactly see, only if it is 6%, the value is matching with your answer of 1.338. And hence I can conclude by saying that my growth rate is actually compounding at 6%. In exam, what they will do, 6% value they will give, 7% value they will give, right? And you should rightly pick that it is 6%. That's all you need to do. No interpolation. No. Yeah. 2 figures randomly they will give. One figure will be correct, one figure will be wrong. They will test whether you are picking the right figure, right? How do you need to do this division? You do and arrive at the final answer, match it with the table given. Clear, guys? Right? That the third issue in the sum is also done. Clear with this? Now, having found the growth rate of 6%, so now what do you do? Simple. So here you do d1 by p0 plus d. d1 was how much? 15 rupees. P0, how do you get? So they have mentioned in the question that issue price was 125 minus 5, it's going to be 125 minus 5 is 120. Yes, plus G of 6%. Just now we got the 6%. The answer is going to be 18.5. Guys, clear with this. KE is done. Now, KP calculation, same D1 by P0 plus D. But what you need to do, ignore the flotation cost and all. So what is D1? Guys, come on, answer. 15%, 15 rupees. D1 was 15. No, it's given in the question, guys. What happened? You look very confused. What happened? I said KP, is it? I'm so sorry. So KR calculation. So KR calculation is D1 by P0 plus G, right? DR, the first year dividend is going to be what? 15 rupees. Now P0, what you should take here, ideally speaking, you should be taking the current market price. But what they have taken is, they have taken the issue price, but one thing is for sure, they have not adjusted the flotation cost. That is common. You should not take the flotation cost. Clear with this? You can also take 130 in this question, right? But always write a note when it comes to KR calculation. Clear with this? They have taken 125 and calculated. So D1 by P0 plus D, they have arrived at 18%, right? And preference dividend, I to preference as KP, so it is irredeemable nature. So annual cash flow divided by discount rate, or in other words, preference dividend divided by your P0. So the same cross multiplication here, what I pay divided by what I receive. So here it's going to be 15 divided by 105 is going to be 14.29%, right? So now finally, if you do it for respective sources of finance, you have the respective cost here, copy paste the figures. Now the book values are given at 120, 30, 36 and 9, correct? So what you do is, you can ideally calculate the proportions here. Now with respect to market value, what they have done in this question is, what was the market value here? 200 lakhs or 2 crores. What they have done, they have split it in the ratio of 120 is to 30. So, or this is nothing but 4 is to 1. Nah? Yes, 4 is to 1 they have split it. So basically 200 is being split into the ratio of 4 is to 1. So 200 divided by 5 into 4 is equal to 160 into 1 is equal to 40. So this 200 crores has been, or 2 crores has been split into 1.6 crores and 40 lakhs between your equity share capital component and your retained earnings component. Here with this, and they've done it like this. Or what is the alternative way of doing it? Don't split, just keep this as 200. 200 means 200 lakhs. Correct? 200 lakhs is 2 crores. And ignore this completely. No problem. Sir, will the answer change? Yes, it will change. It will definitely change. Don't worry about that. Here with this. Are you able to understand? They have just multiplied and they have said, if you are following book value weights, your WACC is going to be how much? It's going to be 33.73. If you're following market value weights, your WACC is going to be, sorry, it's not 33.73. Sorry, this is the total figure. Your WACC is going to be 17.29. Book value weights, market value weights, it's going. Are you clear with this? Are you able to understand this? Right? This is one very, very important question. And look at this, the market value of equity has been apportioned to the ratio of book value weights of equity and retained earnings, the ratio of 4 is to 1. Clear with this? Any problem? There's some key issues with there. So first one was about the manner of dealing with your retained earnings, the weight of retained earnings when the market value weight is being used. Number second, calculation of growth rate when a trend is given. And third thing of this question was the important thing, which was calculating the issue price of debenture when the yield was given. Clear with this? Just go and update your library. Mark this sum as very, very important, guys. Write down WACC, WACC. This is 12. Write down WACC hyphen KE semicolon KP semicolon KD semicolon KR. Right? Then put a semicolon. Write down treatment of retained earnings under MV weights, market value weights, under MV weights, market value weights, semicolon, calculation of G when trend is given, semicolon, calculation of issue price of debentures when yield is given. Calculation of issue price of debentures when yield is given. When yield is given. Done? Please mark this sum as important. One of the best sums, excellent sums in this particular chapter. Right? Fine? Okay, guys. So now I am concluding this session for the day. So please revise till whatever we've covered till now, and I will see you all in the next one. Thank you all so much. Bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now let's continue our discussion in this chapter, cost of capital. So till now, we have seen all the components of your different sources of finance, and we've seen all the costs associated with the respective sources of finance, namely your KD, KP, KE, and KR. And once that was done, we have also seen how to compute the overall weighted average cost of capital, right? And I think we did two sums with respect to computing your WACC, right? And especially in the last sum that we did in the previous session. So we also saw this concept of yield when it comes to debentures, and we also saw how to calculate that growth rate when a trend is given. That is, we saw that dividend grew from, right, so and so rupees to so and so rupees in a span of 5 years. So we saw how to use the future value table, and we computed the growth rate as well when it comes to that particular concept, right? So this is what we have seen till now. So now let's continue our journey in this particular chapter. So now, before we move on to the next question, I just want to explain one small concept, and then we will get started. Now, basically, if you see, there are two different types of companies, right? Or two different types of firms. One is called a levered firm. The other one is called as an unlevered firm. One is called as a levered firm. The other one is called as unlevered firm. Now, what do you mean by this word levered? The next chapter that we are going to do is called as leverages. There we will be seeing in depth. Okay. Now, first of all, you need to understand some terminologies. Now, we saw that in the balance sheet, right? In the balance sheet, you have different sources of finance: equity share capital, your retained earnings, your preference share capital, and your debentures and all of that, right? So all these things put together, that is different sources of finance, right? The composition or the mix from different sources of finance, this entire composition is actually called as capital structure. That is the manner in which I have structured my capital, my total funding is called as capital structure. Basically, the word capital structure means what? The different mix from different sources of finance. Let's say we'll say that this company's A's capital structure is from equity they have raised so much, from debenture they have raised so much, and from preference they have raised so much. Example I'm saying. So when they use the word capital structure, it refers to composition of your capital. Clear with this, right? The word capital structure is actually the next chapter is leverages. The chapter after that is called as capital structure decisions. Clear with this, right? It is all interlinked. Now, if a company has a debt component in its capital structure, it is called as a levered company. So suppose they are saying company A is levered. What is the meaning of that? One of the components of their source of finance is debt. Are you clear with this? Are you clear with this? So when I say levered company or a levered entity or a levered firm, if I just use the word levered, it means what? In its capital structure, definitely one component is debt. That is the meaning of that. Clear with this? Why this word alone? Next chapter we will be seeing the entire logic for that. Clear with this, right? Unlevered entity means what? It doesn't have any kind of debt in it, or in other words, unlevered entity is actually an all equity entity, which means what? It has raised its entire funding only from one source, which is equity. Are you clear with this? Are you clear with this? So unlevered entities are generally all equity entities, right? Now this is the reason why I said. So then what about preference? Preference is one hybrid animal I told you. Generally, preference in all practical senses, preference and all will not be used. But in case they are just saying company A is unlevered entity, this is all they have said. It means what? It is an all equity entity. You need to understand that, right? Company B is a levered entity. If they say, it means what? It has some debt in one of its component in its capital structure. This is all you need to know. Are you clear with this? Are you clear with this? Right? Now, one step further. For an unlevered entity, it has raised, let us say there is a company, right? There is a company. I'm not sure. Do you guys know this company called Zerodha? Yes, Zerodha is one of the topmost broking firms in India, right? Stockbrokers. Zerodha, if you see, it's built on a very beautiful model called as a zero discount model, a zero brokerage model, right? Now, discount brokerage model. So what this company is actually, it was founded by two brothers, right? So Nitin Kamath and Nikhil Kamath, two brothers, they found this company. It's based out in Bangalore. Now what they have done is, it's a bootstrapped company. When I say bootstrapped, it means actually family savings, their own personal savings they invested. They didn't even go to external people for any kind of funding, not even through the equity route. They put their own money into the business and they started. That company is a unicorn startup. It's valued at more than $1 billion as on today, right? It's a very, very, very successful company. Now that company, they have made it a policy not to take 1 rupee from any outsiders or any kind of loan or anything. So now their only source of finance is what? Equity share capital, right? Or maybe once they have earned some profits and all, they get plow back into the business. Maybe it could also be retained earnings. Basically put together, it is what? Basically it's equity only, correct? Equity is the only source of finance for them. So let us say totally they have raised money of 100 crores from equity route. What is the total capital employed for the company? It's going to be 100 crore, correct? Or in other words, can I say the overall cost of capital, KO, is exactly equal to KE because it is the only source of finance, correct? No, right? If K is the only source of finance, then my overall cost of capital is exactly equal to my KE only, correct? So for unlevered entities, KO is equal to KE. Are you agreeing with me on this, right? Or if you want to use the weighted average cost of capital formula, that is KO is equal to KEWE plus KDWD plus KPWP. This is what we saw, no? Weights. For these two components, the weight will be 0, 0. Correct? No. And for this, weight of equity will be 1 because it is the only source of finance. So, or in other words, KO is equal to KE only. You clear with this, right? This way also you can prove. Clear with this, guys? So, in a question, if they have given the word unlevered entity, what does it mean? It's an all equity financed company. Suppose they've used the word levered company, it means what? One of the component in their source of finance will be what? Will be debt. This is the meaning of that. Are you able to understand? I'm introducing you to some jargons, terminologies used in finance. Clear with this, guys? Now, on that note, let's go and do one simple problem, which is question number 13. Please go to your solved question bank. Please go to your solved question bank. Okay, so let me quickly read out the question for you. Gamma Limited has in issue 5 lakh rupee 1 ordinary shares whose current ex-dividend market price is 1.5 rupee per share. Ex-dividend market price per share means actually normal market price per share. Okay, there is a concept called ex-dividend cum dividend and all. I will tell more about it later on, right? It's not required right now. Ex-dividend. Normal market price means what? Ex-dividend market price. Clear with this? What is the current market price of the share? 1.50. The company has just paid a dividend of 27 pies per share, and the dividends are expected to continue at this level for some time, right? Which means what? The dividend is going to be the same throughout. Constant dividend model. In this case, what model will you use for calculating KE? Your dividend price model, no? Guys, dividend price model, first method of calculating KE, dividend price model. What is the assumption? Dividend amount will be constant for the rest of the life. Correct? There is no growth here. So you will not use Gordon's model. Clear with this? If the company has no debt capital, means what? It's an unlevered entity. What is the weighted average cost of capital? So how can we compute weighted average cost? Simple, they've given no debt, which means calculate KE and tell them that look, since there is no debt, in this component, it is actually an unlevered entity. For an unlevered entity, KE is equal to KO. Hence, whatever KE that we computed, that itself is equal to KO. Are you clear with this? How do you compute KE? This is why I said first, the market value of equity shares is what? 5 lakh into 1.5, right? It is going to be, so 5 lakh shares into 1.5 is going to be 7,50,000, right? The market value of debt is what? 0, because they have not raised anything. Since there is no debt in the capital structure, it is an unlevered entity, and the WACC KO is equal to KE. Clear with this? This background only, I just gave it to you right now, right? So KE, how will you find out? Simple, D divided by P0. That is what I pay upon what I receive. This is perpetual. Clear with this? Here D or D1 is equal to D2 is equal to D3 is equal to D infinity. Why? Because rest of the life the dividend is going to be the same only. There is no growth here. Clear with this? So they have written D1. You can simply write D divided by P0. That's what we saw. Or D divided by net proceeds. So how much is that? 0.27 divided by 1.5 into 100. So it's going to be 18%. Guys, clear with this? So KE is equal to 18%, which is also going to be my entire weighted average cost of capital. Any problem here? Any problem here? No, right? That's about this particular question. Just go and update your library of edges. That's all. Write down. WACC hyphen unlevered firm. WACC hyphen unlevered firm. Semicolon KE is equal to KO. WACC hyphen unlevered firm. KE semicolon KE is equal to KO. Are we done here? Are we done here? Any issue, guys? Any problem here? No. See, whatever I'm teaching here right now, slowly we will link it later on. So the concept of, sir, levered means what? What do you mean by leverage? Leverage effect, everything that's covered in a separate chapter. Clear with this? Whatever is required at the moment, I will be teaching you. So it's going to be, and completely I have structured it in a certain way so that it doesn't hinder with your logical flow of understanding. You follow the same route. Clear with this, guys? Next. Now, suppose in the question they have given short-term debt. Read the next question. From the following information, determine the appropriate weighted average cost of capital relevant for evaluating long-term investment projects of the company. KE is given as 18%. Guys, yes. Now, after tax cost of long-term debt, KD is given as 8%. After tax cost of short-term debt is given as 9%. KR reserve is given as 15%, and each of these sources of finance, the book value figures, market value figures are given. Calculate the WACC. Very simple. Respective cost multiply with the respective weight. Once you do it using book value weights, once you do it under market value weights, arrive at the weighted average cost of capital. Very simple. Now, I didn't pick this sum for that. The unique thing here is they have given something called a short-term debt. What should we do? Sir, you didn't teach us, sir. What is this cost of short-term debt? What do we do? Whenever in the question they have given the cost of short-term debt, you should ignore it. You should ignore it. Why? Why? Now, first of all, you tell me, guys, what is this chapter dealing with? Come on, what is this chapter dealing with? Cost of capital, right? Right? Cost of capital. Cost of capital goes on to achieve which objective of our subject? Your financing decision. Financing decision means what? Your decisions that you take related to fundraising activity. Correct, guys? Right? Long-term sources of finance only we talk about. That is a component of capital employed. Guys, correct? So, only those sources of finance, right, that are a part of your capital structure will be considered for the purpose of decision making here. Now, short-term debt means what? Example, creditors. Sir, creditor, will it have a cost? Of course, it does have a cost. I will tell you what it is. Creditors, sir, how do you even consider? How are they saying it's a short-term debt? Now, what do you mean by a creditor? He will supply you some material today. He will accept the payment, let's say after 2 months or 3 months, depending on your credit policy. Literally speaking, he is funding you not by giving you cash, but by giving you some material. He is funding you in kind. Correct? No. Correct? No. He is not giving you cash. He is saying, I will give you some material, whatever you want. I will give it to you in material, and I am ready to accept the payment after 2 months or 3 months. Clear with this? Suppose, let's say he's selling you the goods for 100 rupees, right? He says, I'm ready to supply the goods for 100 rupees. You don't pay me today. After 2 months, you pay me. Correct? Suppose instead of availing the credit facility, if you go to him today and if you say cash and carry, means what? I will pay cash fully. Full cash I will pay, and only then I will take the goods. Is he funding you now? No, you are paying the entire cash. He's not funding you anything. Now you tell me, if you are ready to pay the entire cash today, will he supply it for 100 rupees or slightly lesser? He will definitely give you a cash discount. Correct? This, he will say that, okay, then if you are paying the entire cash today, then in this case, I will give you for 98 rupees. This is what they will say. Correct? This 2 rupees difference is not because he likes you, or it is not because of the volume that you have purchased. It is because literally what you are doing is, for the 2 months time value of money, he did not wait to get the money. No, that saving he is actually giving it to you right now because you are not making use of it. Or in other words, whenever you are making credit purchases, it has some cost hidden inside it, and that cost only they have separately mentioned here as after tax cost of short-term debt. And now you tell me, is it a long-term source of finance? Are you raising any funds? No, this comes as a part of your working capital management dealt with in a separate chapter. Here with this, and hence, in case this is given in a question, for the purpose of computing weighted average cost of capital, it should be ignored. Are you clear? Are you clear with this? Right? There could be an exception. In case the question specifically asks you to consider it, then you consider. But strictly speaking, it should not be considered. So I'm just telling you, I'm giving you all the options to you right now. Nothing is mentioned. Of course, this is what it is. Weighted average cost of capital should only consider your long-term sources of finance. Are you able to understand? So then are we going to ignore this? No, it is dealt with separately in a chapter called as working capital management, where you have a separate unit for this particular payables and all of that. Clear with this payables management you have. Clear with this, guys. And that's about the sum. Nothing, guys. Everything else is same. So what you do here, look at this. Using book value weights, what they have done, equity reserve and long-term debt alone they have given, write a note. See, whenever you are ignoring something, the fact that you should correctly ignore is also a test in the exam. Okay, but whenever you are ignoring something, please write a note. Else the examiner will think you have ignored by mistake. See, short-term debt should not be considered for the purpose of WACC computation. And accordingly, what they have done, they have taken the respective book value, arrived at the weights, the respective costs are given, so you arrive at the weighted average cost of capital. They're exactly on the same line. What you need to do, so once again, in this case, look at this, guys. Here, the market value of equity alone is given. Guys, correct? Right? So what you need to do is, you can do two options I told you. Ignore KR, that is reserve, or split the market value of equity between your equity share capital and reserves in proportion of their book value weights, that is 3:2. So now what you do, in this case, you have equity, the market value is available, reserve market value is available, long-term debt, the market value is available. Based on this, arrive at the weights, respective costs given in the question, arrive at the WACC. As simple as that. And write a note, market value of equity has been apportioned between the equity share capital and reserves in the book value weights. Book value proportion is how much? 3:2. Yes, 3:2. So 7,50,000. So it's actually being apportioned in the ratio of 3:2. So 7,50,000 divided by 5 into 3 is equal to 4,50,000, and into 2 is equal to 3 lakh. Clear with this? That's how they have arrived at this figures. Are you clear with this, guys? Nothing great here. The only thing is that your short-term debt needs to be ignored, and the reason why it needs to be ignored, I just told you right now. Clear with this, guys? Right? This is what I have actually mentioned in this area. Look at this. So tomorrow when you're revising, it will be very easy for you to revise. The page is low. Redeemable preference shares. 1 second. Look at this. Other issues in KD I had mentioned, no? Right? And I told you this other issues, wherever we are seeing, I will just come back and tell you. Look at this here. Treatment of short-term debt as a note, I have given it to you. Clear with this? Whatever we are studying, I've given it here. Now, short-term debt is a part of current liability, and hence it's not a part of capital employed. Therefore, it needs to be ignored while calculating your KO. I have just given it. An example for short-term debt is going to be your creditors. Clear with this, guys? Now, just imagine the day before your exam. One look at it, you will remember, okay, this sum we did. All we learned in this sum was to ignore your short-term debt. Clear with this, guys? Just go and update your library of adjustment. Write down, write down. WACC hyphen treatment of short-term debt. WACC hyphen treatment of short-term debt. WACC hyphen treatment of short-term debt. Sorry. Done? Fine. Now, let's go on to the last and the most important concept of this chapter, which is called as marginal cost of capital. Don't worry, there are a few more concepts like convertible debentures and all, right? We will be seeing it. I've sequenced it in a certain way, as I told you. Now, marginal cost of capital. What do you mean by marginal cost of capital? Simple, guys. Now, a company currently has, let us say, raised 100 crore rupees of finance through the current sources: equity share capital, preference share capital, debentures. Example I'm giving you: 30 crores, 20 crores, 50 crores. Example, right? For each of these component, we would have computed cost KE, KP, KD, and for this current finance, current entire funding, we also calculated KO. Correct? Now, this KO calculation is called as what? Weighted average cost of capital. Fine. This is what the company has currently raised and kept. Now, only will the company raise money once. Suddenly tomorrow they are looking for an expansion program, right? They want some 20 crore rupees extra funding. It's a running company. It already has 100 crores. It further wants 20 crores. Correct? This 20 crore can also be raised from multiple sources of finance like equity share capital, preference share capital, debentures and all that. Correct? Right? Now, for this additional source of finance, now it could have a different KE, KD and KP. Guys, correct? Correct? So now, once you calculate all these new KE, KD, KP, right? For this extra funding of 20 crores, once again, you weighted average it and you calculate the overall cost of capital with respect to this new funding of 20 crores. Correct? No? That is only called as marginal cost of capital. Marginal means what? Incremental, extra. So now I am raising this new fund. For this extra amount raised, what is my cost of capital is called as marginal cost of capital. Calculation wise, everything is same. If you do all the calculation of WACC on this incremental extra funding, that calculation is called as marginal cost of capital. Are you clear? Some people even call it as weighted marginal cost of capital because it's actually weighted cost of capital. Extra one word they insert in between: weighted marginal cost of capital. Are you clear? Are you clear with this? All the calculations are same as that of your existing cost of capital. If you do this calculations only on the extra funding, then it is called as what? Marginal cost of capital. Are you clear with this? You guys are able to follow this, right? Now you read it, you will understand. Marginal cost of capital may be defined as the cost of raising an additional rupee of capital, as is referred to as the cost incurred for raising new funds. Correct? This is what I said. Marginal cost of capital is derived when the average cost of capital is calculated using the marginal weights, which represent the proportion of the funds the firm intends to deploy. Now, you tell me one thing. In this case, what happened? The weights of equity, preference and debt was what? 0.3, 0.2 and 0.5. Correct? No. 30 by 100, 20 by 100, 50 by 100. Right? Now, the company, if they want, even this extra 20 crores, they can raise it in the same weights. Correct? No? Or if they want, they can also change the weights. Correct? It is up to the company. It is up to the company. If the company has a policy, no, we find this as the optimum capital structure, best capital structure. We want to continue this proportion even on every rupee extra raised. Then even for this weighted average, the marginal cost of capital, the proportions will remain the same as that of my original cost of capital. Suppose the company feels, no, I want to change it, they can also change it. How do we know, sir? The facts will be given in the question. Are you clear with this? Simple. This is all it is. Are you able to understand? Next. To calculate the marginal cost of capital, the intended financing proportion, that is the mixer, that is your weights for the new sources of funding, should be applied as the weights to the marginal components. And calculation of MCC is very similar to that of WACC, but for the fact that all the calculations here are done only on the new funds raised. Clear with this? Clear with this, guy? As simple as that. Fine. Now, shall we go to the next sum and do this? Right? We will spend some solid time on this question because many students find this sum a little tricky. I think this sum or the next one, I'm not very sure about that, but I want to spend some solid time on this sum. Please pay full attention. Please pay full attention. Just keep listening to whatever I say. Wherever I ask you some question, you just answer. Very, very important. And with that, in the classroom itself, you will be finishing the concept of marginal cost of capital. Clear with this, guys? There is one or two issues where generally students find it a little vague. They find it difficult to understand. That's why I want you guys to pay full attention, especially on the next two sums that we are going to do. Clear with this? Right? Let's get started. Now take the next question in your solved question bank. That's going to be question number 15, isn't it? Yes, sir. Okay. Shall we get started? Guys, yes, sir. Perfect. Now, this was a past RTP question in May 2024 attempt. This is also in your study material, a very similar question. ABC Limited has the following capital structure which is considered to be optimum as on 31st March 2023. Means what? Currently, they are raising 14% debenture. Currently, they have the following capital structure. Means what? Existing funds raised was totally 2 lakhs. This 2 lakhs, to the extent of 30,000 was raised from 14% debenture, 10,000 rupees was raised from 11% preference shares, and 1,60,000 rupees was raised from my equity route. And they are considering that this proportion is optimum. Means what? The best. As far as the company is concerned, they find this mix as the best mix. Capital structure means what? I told you, the mix, correct? And they find this mix to be the best mix, which means what? In the absence of information, suppose if the question is given they are going to raise some new funding, then in the absence of information, this weights you will take from the existing capital structure and apply it for the new incremental funding also. Clear with this? Are you able to understand? Watch out for this. Next. The company has a market price of 23.60 rupees. The next year's dividend per share is 50% of year 2022's EPS. And the following is the growth trend of EPS for the preceding 10 years, which is expected to continue in future. So what have they given? 2013, the EPS is given. 14 EPS, 15, 16, 17, 18, 19, 20, 21, 22. 10 years, year by year, EPS is given. So year 1, it was 1 rupee. Year 2, it was 1.10. Year 3, it was 1.21. Year 4, it was 1.33 and etc. So how do you calculate the growth rate? No, all this time value of money and all is not required. Divide any two adjacent years and see. You will be able to understand. Here, 1.10 divided by 1. Guys, you get how much? Sorry, 1 second. So here, 1 rupee has become what? 1.10. So how much extra you have got? 0.1 divided by the base year. How much is it? So 0.1 divided by 1 is equal to 0.1. That is basically the growth rate is 10%. Guys, correct? Or you take any two random years. These 2 years let us take. So how much is it? 1.95, correct? Minus 1.77. How much is it? 1.95 minus 1.77 is going to be 0.18 divided by 1.77. You get how much? 10.16%. Approximately you get 10%. So basically what has happened is year on year, if you compare any two adjacent years, you see the extra growth divided by the previous year as the base. If you see, you will get the growth rate. Are you clear with this? Are you clear with this? In case it is given, this is all you need to do. Very simple. Clear with this, right? Fine. Next one. So they have given what? The current market price. Guys, they have given the current market price. Next year's dividend is 50% of year's 2022's EPS. Correct? So year 2022's EPS is given. 50% of that is going to be D1. Guys, yes. D1, you have P0 do you have? Yes, the market price is there. G do you have? Just now I told you how to calculate. With this Gordon's model, you can calculate KE itself. Guys, clear with this? One reading of the question, you can find this out. Next. The company issued new debentures carrying a 16% rate of interest, and the current market price of debenture is going to be 96 rupees. Right? The preference shares 9.2 rupees with an annual dividend of 1.1 per share. So preference share has a current market price of 9.20, annual dividend is 1.1, were also issued. The company is in the 50% tax bracket. Now, what they are asking, number one, calculate the cost of new debt, calculate the cost of new preference, calculate the cost of new equity, assuming the new equity from retained earnings. No problem. No problem. Fine. So basically KR is equal to KE. That is not a problem at all. Normal calculations you can do. That is the reason why there is no flotation cost in the question. Clear with this guy. Next. Calculate the marginal cost of capital when no new shares are issued. Now, have they given the proportion in which the new funding is being raised? Have they given the proportions in the question? Specifically, how much amount is getting raised? They have not given. Have they given any proportion in which it is going to be raised? No, it is not given. So what you can do is you can use the existing capital structures weights, right? And you can calculate the respective cost using the data given and apply these weights alone using the existing capital structure. And with this, you can arrive at the marginal cost of capital. Here with this, for you to calculate the marginal cost of capital, you don't need to know how much extra amount is actually raised. All you need to know is only the proportion in which it is raised. Correct? No. At the end of the day, WACC, how do you calculate? Respective costs with the respective weights only you calculate. If you know the weights and if you know the cost from every source of finance, you will be able to calculate WACC. Similar thing is for your marginal cost of capital also. Nothing is given in the question. So what I will do, from the existing capital structure, I will take the weights and assume that the company is going to follow the same weights for the new funding also. Why? Because they have used the word optimum here. Here with this. And for the new funding, can I calculate the respective costs? Yes, I can calculate the respective costs. Now you can just marry the two figures and you will get your marginal cost of capital. Here with this. Here with this. Now, part C, mark this as very, very important. The wordings are very tricky and many students, based on my past experience, find first of all, they are not able to understand what is being asked. What is being asked itself, they are not able to understand because the wordings are such. So even if you are not able to understand, don't worry. It's a very tricky area. Fine. It doesn't mean that you don't know the subject. It's not like that. The tricky area, it is a very tricky area. That's why I mark this separately. And compute the marginal cost of capital when the funds exceeds. Fine. This we will do it later on. Right, guys? Done? Now, what I will do is, I will give you a minute time. Don't jump to the solution. Read the question fully, right? Digest the facts, read the question fully. And when we are solving it, whenever I'm asking you any question, you please answer to it. I'll give you a minute time. It's worth the time. You please look at your book, read the entire question, digest the facts. Don't jump to the solution. I will walk you through the solution myself, right? A minute time, please take it. Three more seconds. Quick. Even the ones who are watching this on a recorded mode, please don't look at the solution. I will explain it to you and learn it in a certain way. You please learn it in a certain way. It stays with you for a lifetime. Done? Done? Perfect. Now, first, guys, let's take part by part. We need to calculate the respective cost of finance, right? Now, first one, cost of debt. Now, look at this. Debt related data, only this much is given. The company issued new debentures carrying a 16% rate of interest, and the current market price of debt is going to be 96. Period is given. Period is given now. Read the question now. Is the period given? Is it a redeemable redeemable debenture or irredeemable? Irredeemable. In that case, what is going to be the formula here? I into 1 minus t divided by your net proceeds. That is what I pay upon what I receive, right? So in this case, it's going to be what? I into 1 minus t upon P0 or net proceeds, right? So how much is your interest payout? 16% they are saying into 100. That's going to be 16 rupees into the tax rate is given as, they've given the tax rate as 50%. They've given the tax rate here, no, the question, 50%. So into 1 minus 0.5 divided by 96. This is also given. So first KD is going to be 8.33%. Any issue here? Any issue here? Guys, yes? Any issue here? First of all, when you're reading the question, read it carefully, classify. That's why I taught you redeemable, irredeemable. First thing that you need to do is classify that particular instrument as whether it is redeemable or irredeemable. That's a very basic step that you need to do. Once you do that, only then you will know which one to apply, which logic to apply. Clear with this, right? There's no point in just directly jumping to the solution. Now, next one, preference shares they have given. Preference shares 9.20 is the current market price with an annual dividend payout was how much? 1.10. Guys, correct? Now, anything about the life of the preference share, is it given? No. It means it is irredeemable. Same formula, what I pay upon what I receive. That's going to be 1.1 divided by 9.2. Correct? 1.1 divided by 9.2. KP is going to be how much? 12%. Any problem here? Now, equity shares, KE. How many methods are there to calculate KE? 5 methods are there. Dividend price model, earning price model, your Gordon's model, your yield to maturity, your YTM model, and realized yield model basically. And finally, you have your CAPM model. 5 models are there. Which model to use depends on the data given in this question. In this question, they have clearly given some hint about the growth trend. So obviously, whenever growth comes, Mr. Gordon will come and pitch it. Correct, guys? Right? So clearly, Gordon's model. KE for Gordon's model, how will you calculate? KE is equal to D1 by P0 plus G. Correct? Now, this is the formula, right? Logically derived everything we've seen. Now, D1 is how much, guys? D1 is how much? They have clearly given next year's dividend per share is 50% of year 22's EPS. How much is year 22's EPS? 2.36. 50% of 2.36 is how much? 1.18. Correct? So directly I can say D1 is equal to 50% of year 2022's EPS, which is 1.18. Correct? The first figure we have got 1.18. So Gordon's formula, D1 by P0 plus D. Topmost, D1 calculated. Getting it? Next, P0. How much is P0? That is nothing but net proceeds. Net proceeds they have given in the question is 23.60. Directly you can just take that and you can put it here, 23.60. Guys, yes? Plus G. Now you need the growth rate. Now how do you calculate the growth rate? 10-year data is actually given. That many years of data is actually not required. 2-year data is alone enough. But anyways, they have given 10 years data. All you need to do is, this is what you need to do. Look at this. Calculation of G when there is a uniform trend on the basis of EPS. Right? So what do you do here? You take any 2 adjacent years EPS. Right? Here they have taken 2014's EPS minus 2013's EPS. 1.10 minus 1. Extra how much you got? 0.1. Right? Divided by the base year's EPS. That is the previous year's EPS, which is 1. So which is giving you a 10% growth rate. Are you clear with this, guys? Are you clear with this? Very logical. Very, very logical. You know how to calculate this percentage increase and all. Simple mathematics, right? So it's going to be 10%. Now we have got this component also. So D1 by P0 plus G. So if you arrive, it's going to give you how much? 15%. Are you able to? Any problem here? That's about it. Next one. Calculation of marginal cost of capital. Now, for each of these three respective sources of finance, just now we computed the respective costs. Correct or not? Right? It's going to be 8.33%, 12%, and 15%. Right? 8.33, 12, and 15%. Right? Now, for the new funding, specifically the proportions are not given. However, existing capital, the company has a total of 2 lakhs, and for that they are saying the following capital structure is considered to be optimum. In that case, what we will do, so we will assume that the company, every time they are going to the market for raising any capital, they will retain the same proportion because they find it to be optimum. Yes. Right? So now what we will do, we will use the mix using the existing capital structure. For this alone, we'll go to the existing capital structure and take the mix. Clear with this, right? So mix is going to be, what is this going to be? Sorry, 0.15, 0.05, and 0.8, right? So it's going to be 0.15, 0.05, and 0.8. How did you get these figures? It is nothing but 30,000 by 2 lakhs. This is nothing but 10,000 by 2 lakh, and this is nothing but 1,60,000 by 2 lakh. Are you getting it? Hello? Yes, you guys are getting it. This proportion, we took it from the existing capital structure because they've said that to be optimum, and that optimum mix will be maintained even for the additional funding. Clear with this? We are not calculating the cost of capital for the original source of finance. We are calculating only for the new one. Clear with this, guys? Right? Now what you need to do, marry the two figures and you will get what? So marry these two figures, that is your proportion with the respective cost. You will arrive at the product, and finally we can say that the marginal cost of capital is 13.85%. Any problem here? Any problem here? Very, very simple, no? Right? Now comes the most interesting part. Now comes the most interesting part. Done with this? Done with this? Clear? Now, read the part number C. Read part number C. We will go slow here. Read part number C. Determine the amount that can be spent for capital investment before new ordinary shares must be sold, assuming that retained earnings for the next year's investment is 50% of 2022. Read the question once again. I will give you some maybe 20-30 seconds to digest the facts. This alone, you read it. Try to interpret. Try to interpret. Generally, in a fast track course, we can't afford to spend more time, but still in this area, if I'm saying, understand such as the importance. Read it. Generally, students get confused here. That's the reason why I'm telling you out of my experience. Read it, please. Done? Now, what have they asked in this particular area? Determine the amount that can be spent for capital investment. How can you spend for capital investment? You can't spend an amount without raising it. Correct? Or in other words, indirectly they are asking you how much additional amount they can raise. This is the indirect meaning of this. See, how can you spend some money? Only if you have a funding for that. Correct? So indirectly, the spending refers to how much amount can the company raise. Right? Further read it. Before new ordinary shares must be sold. Sold means what? Issued. Before the company issues any equity shares, which means what? They don't want the company to issue any shares. Correct? So why are they giving all this data? Wait. Assuming that the retained earnings for the next year's investment is 50% of 2022. 3 sentences are given here, right? Or rather 2 sentences are given here, but they have used capital spent for capital investment. Before new ordinary shares must be sold, they have talked something about retained earnings. Now, If you are reading it for the first time, if you're learning the subject for the first time, definitely you will not be able to connect the dots. What are these three things? Why are they given in a single part of the question? What are they actually asking? Very simple, provided you understand the logic. Your calculation is very simple, right? Not a problem at all, but you should know what they're asking for. Now, what do they want to know basically is, the company wants you to, the question wants you to calculate how much extra amount in total can the company raise, right? How much extra amount can the company raise without issuing equity share capital, without issuing fresh equity shares, but still they want to retain this whatever mix the company is currently following. What is the mix the company is currently following? 0.15, 0.05, 0.8, correct? Or in other words, if a company raises 1 rupee, they will not raise it 1 full rupee from equity or 1 full rupee from preference, 1 full rupee from your debentures. If every rupee they are raising, they will maintain the mix. 15 paise will come from debenture, 5 paise will come from preference, 80 paise will come from equity component. Correct? No. Or if the company is raising 100 rupees, 15 rupees will come from debenture, 5 rupees will come from preference, and 80 rupees will come from equity. They will always want to maintain this. Here with this. Now, what they are saying is, so what are the three sources here? Debenture, preference, equity. The company wants to maintain this mix of 0.15, 0.05 and 0.80, right? This weight they always want to maintain. They want us to calculate what is the total amount the company can raise, but they don't want to deviate from this mix. The proportion should be maintained. Now you tell me, if any one figure we have, we can reverse work and calculate. Suppose we have the debt component. Debt amount is equal to so much. Then you can say if that is equal to 15%, how much is total? We can calculate now. If any one component we have, we can reverse work and calculate how much should be the total amount. But the question here is, do we have any one component? No. But they have given hint to calculate that component. What is that? Read this. Read this given. What have they given here is, one condition, no fresh equity shares should be issued. Sir, what is this? How is this a hint? You think and you tell me, when I say equity, inside equity, it can ideally come from two sources. One is equity share capital, the other one is retained earnings. They are being very clear, I don't want to raise even 1 rupee by way of fresh issue. Which means the entire equity component should come only from your retained earnings, right? And can you calculate the retained earnings available? They have given you that. Assume that the retained earnings for the next year's investment is 50% of 2022. So now 2.36 rupees is the EPS of 2022. 2.36 into 50% is going to be 1.18 is the retained earnings available per share. Totally, how many shares are there? Totally, how many shares are there? They have given in the question 10,000 shares. This is the reason they have given for shares. Equity component alone, how many shares are there? 10,000 shares are available. So, can I say the retained earnings figure is actually 50% into 2.36? 2.36. This is the retained earning available per share. Like that, I have a total of 10,000 shares. Calculate and tell me how much. 1.18. This is going to be rupees 11,800. This is 11,800, correct? So now I got this component of 11,800. So max, the equity component can only be 11,800. Why? Because they have given us a condition, entire equity component should come only from your retained earnings. I don't want to issue even one share. Now you got this component. If this is equal to 0.8, how much is equal to the entire 1? So 11,800 divided by 0.8 into 1. How much is it? Come on, use your calculator. Tell me how much is it? So 14,750 rupees is the maximum amount you can raise from if you want to maintain the same capital structure mix and if you don't want to raise even 1 rupee from your equity share capital by issuing fresh equity shares. This is the meaning. Now you go and read the question, you will understand everything. I'm erasing this off so that it's easy for us to discuss. Determine the amount that can be spent for capital investment. Means what? That can be raised basically for some purpose. Before new ordinary shares must be sold, which means what? Entirely should come from my retained earnings. I should not issue fresh shares. Assume that this is the retained earnings available. Now you are able to understand this, right? Are you able to understand? And now if you go look at the solution, this is all it says. The company can spend the following amount without increasing the marginal cost of capital. Marginal cost of capital means what? In other words, the proportion mix they are referring to, and without selling the new shares. Retained earnings available is 0.5 into 2.36 into 10,000 shares. So this is going to be 11,800. Now, if this is equal to 80% of my total capital employed or the new capital, how much can be the total capital? That's nothing but 11,800 divided by 0.8. Or you can say if 11,800 is equal to 80, how much is going to be 100? Anyways, you want, you can calculate, guys. That's not a problem. So it's going to be how much? 14,750 here with this. Are you understanding this? Calculation is simple, but interpretation is the most difficult and the most challenging part. In the institute study material, this is all they have given. If you look at it, you will not understand a word. Clear with this? Now you are understanding. Yes, guys, this is the reason why I said I'll spend some time here. Done? Done. Now we have crossed the most difficult part. The remaining part is easy. Now, next. They are not stopping here. One more part of the question. Compute the marginal cost of capital when the funds exceed the amount calculated in C. Now in this case, what you need to do, if you are C, maximum amount that can be actually raised without issuing fresh equity shares is how much? 14,750 rupees. Suppose the company says, no, I want to raise more. What you need to do, every additional rupee that they are raising, they will still have to maintain the same mix. Let's say they want to raise 14,751 rupee. That extra 1 rupee cannot come fully from debt or preference. In that case, what you need to do? Out of that 15 pi should come from debt, 5 pi should come from preference, 80 pi should come from equity. Right? In that case, at least 80 pi should come from equity, no? How will you use equity? Entire retained earnings you have used. So this extra rupee can only come from what? Extra 80 pi can only come from your equity share capital, no? Or in other words, suppose if the company wants to raise over and above this money, then they will necessarily have to issue some fresh equity shares. Clear with this? This is what they are saying. Compute the marginal cost of capital when the funds exceed the amount calculated in part C, assuming that now they are issuing equity shares and every equity shares is issued at what? Rupees 20. Now it's very easy to calculate. So how do you calculate? Now, in this case, calculate fresh KE. You should calculate fresh KE, because your P0 has changed. The existing KE, what we calculated KE by taking the current market price as 23.60. Now they are saying in case you want to do that, now it is going to be different. So what will you do? D1 by P0 plus G, correct? D1 figure will be the same, whatever we used earlier. G figure will be the same, what we used earlier. P0 alone. Sorry, we will use this 20 rupees as the issue price. So now what you do here, now look at this. In this case, D1 is going to be 1.18. G will be the same, 0.10, but P0 alone, they have just given. The company spends X. If the company spends in excess of this figure, it will have to issue the fresh equity shares at the rate of rupees 20 per share. So now what happens to my KE? My revised KE is going to be 15.9%. Are you clear with this? Are you clear with this? And now what do you do, guys? Now what do you do? So using the new specific cost, KD will not change, KP will not change, but KE alone, the new KE will now come in. Are you clear with this? Right? With this, you apply the existing mix. Mix will never change. That's the whole point. That's the whole condition here. Are you clear with this? Right? And in this case, this is the current market price. This has changed, no? Current market price. We didn't adjust for any flotation cost. So the entire equity component, right, will be having the same KE only. Both retained earnings, KE is equal to KR, no? So everything will be the same only. So this 15.9% will be given a weightage of 15.9% of KE will be given a weightage of 0.8. So you mix everything and you will arrive at the new marginal cost of capital to the extent of 14.57%. Are you clear with this? Right? And that's about this question. A beautiful sum. Please mark this as important. It's a must visit the day before your exam. Done? Let's go and update your library for adjustments. Quick. Come on. Let's do this. Write down. Marginal cost of capital, or MCC. Just put it as MCC. Give all the page number referencing. MCC. semicolon, semicolon, calculation of new funds to be raised, new funds to be raised, new funds to be raised within bracket, reverse working, within bracket, reverse working. Done. Shall we move on to the next question, guys? Hello? Yes. Let's move on to the next one. So this is question number 16. Masco Limited wishes to raise an additional finance of 10 lakh for meeting its investment plans. It has 2,10,000 in the form of retained earnings available for investment purposes. Further details are given as follows. The debt equity mix is 3:7. Wait, what are they saying? Every time they are raising any additional funding, they will make sure that they are going to retain this mix of 3:7. Means what? If they raise 1 rupee, 30 pice will come from debt, 70 pice will come from equity. If they are raising 1 crore, 30 lakh will come from debt, 70 lakh will come from equity. They will always maintain it. That is the meaning of this. Clear with this? Next. Cost of debt. Interesting. They are saying debt is going to change. For the first 1,80,000, if you're raising debt from debt channel, if you're raising money up to 1,80,000, the cost will be 10% before tax. Suppose if you want to raise from the debt channel alone beyond 1,80,000, the cost will become 15%. Right? Why like this, sir? Now, first 1,80,000, then it means you are having less amount of loan. The person who is giving you the loan, he will say, okay, this guy has only one loan. Okay, for me, the risk is lesser because he will be able to repay. Suppose you are going on and you are just keeping on adding your loan. From my perspective, the risk is more. I'm a person who is giving you, you already have a loan of 1,80,000, plus you are asking for fresh some more loan. Then for me, I am more riskier. No? Yes, what I will say, I will not give you loan at the same 10%. I will give you somewhat more. I will be wanting more because my risk my perspective of risk is actually more right now. Yeah, with this similar case, you go to a bank and you see, obviously, if I go to a bank and ask for a personal loan, as compared to you going to a bank and asking a personal loan, both of us will be charged a different rate of interest. You know that it's not one rate for everyone. It is based on the risk perseverance. There's something called a CIBIL score and all. They will look at your history, and then based on that only, they will be able to give you loans at a different rate of interest. So no two person will be getting the same interest, right? So that's very important to understand. That's the reason why there is actually different rates of interest based on the amount. They've given that the EPS is 4 rupees and the dividend payout is actually 50% of the earnings, which means what? Earnings per share is 4, out of which 50% is being paid, which means what? The dividend per share is going to be 2 rupees. Guys, clear with this, right? It is popularly called as dividend payout ratio. Fine. Then the expected growth rate is going to be 10%, and the current market price of the share is going to be 44, and the new tax rate is going to be 50%. This is given. You are required to, number 1, determine the pattern of raising the additional finance. Number 2, determine the post-tax average cost of additional debt. Number 3, determine the cost of retained earnings and the cost of equity. Number 4, compute the overall weighted average after-tax cost of additional finance. Basically, what they are asking is marginal cost of capital. I'll give you some 30 seconds time. Quickly go through the facts of the question and then we will get started. Quick. Let's not waste time. Make it fast. Done? Right. Now tell me, guys. Now, you guys tell me. Totally, the company is going for an extra funding of how much? 10 lakhs. Guys, answer no, please. Just gave you some time to read the question also, right? Out of this, they are very clearly saying they need to maintain a debt equity ratio of how much? How much? 3:7. Debt equity, which means totally from debt they will raise 3 lakhs. Equity 7 lakhs. Further, in this debt also, they are clearly mentioning that for the first 1.8 lakhs, it has a different cost. Correct? The first 1.8 lakhs has a cost of 10% before tax. We will calculate what is the actual cost and all post tax. Then for the balancing 3 lakh minus 1.8 lakh, how much is it? The next 1.2 lakh will be attaching a cost of 16%. Agreeing with me on this, right? Next, 7 lakh equity component. Here also there is a further bifurcation. What is the bifurcation? First, they are saying that from the retained earnings, they will be using how much? 2.1 lakh. It's given in the question. 2.1 lakh is available by form of retained earnings, which means, so this is a balancing figure here also. So which means they necessarily need to issue some equity shares to the tune of how much? The balance, how much is it? 4.9 lakhs. Are you clear with this? This is called as pattern of raising the additional finance. This is the first part of the question. Now you look at this. This is what they have given. Equity share capital 4.9 lakhs. Just now I showed you 4.9 lakhs. Reserves retained earnings 2.1 lakhs. 2.1 lakhs. Debt with a 10% interest is 1.8, right? And debt with a 16% interest is 1.2. Look at this. It's 1.2. That adds up to the total of 10 lakhs. Clear with this? If you don't want to do it in this dabba, or if you want to do it like however I have done, you can happily do it in the exam, not a problem. Right? Whichever way you want, you do it. Absolutely no problem. Here alone, just write this is as balancing figure. This is also a balancing figure. How you have arrived at it. Here also you should write the calculation. This is going to be 10 lakh into 3 by 10. This is going to be 10 lakh into 7 by 10 because debt equity ratio mix. All the calculations you write and you put it, they will not reduce any marks. You can also put it like this. Clear with this, guys. The first thing, are you able to understand? Next. What is the second part of the question? Determine the post-tax average cost of additional debt. Nothing great here. Now, here. Now, what is the formula to calculate KD, guys? The shortcut formula. I into 1 minus T plus RV minus NP divided by N, the whole by RV plus NP by 2. Correct? Now, in this question, okay, it is irredeemable. Is it irredeemable? I'm not sure about that. Okay, then it's an irredeemable case. This is for redeemable, whatever we saw. Fine, not a problem. If it's an irredeemable case, so what is going to be the formula here? Actually, what I pay upon what I receive, correct? It's nothing but I into 1 minus T divided by your NP. Now, NP, nothing is given. So what I can do, I can directly take it as 100. Correct? No? So interest by 100 is nothing but your coupon rate itself. Right? Or directly, can I say in this case, I is the interest rate into 1 minus T. Correct? No? Or if you want, you can also put it like this and calculate. Everything is the same only. Clear with this, guys? Interest amount into 1 minus T divided by net proceeds you can do. If net proceeds is at face value, so interest amount by your face value itself is actually called as interest as a percentage. So interest rate into 1 minus T itself is KD. We saw this in a previous session also. Clear with this, guys? Right? In this case, on the first 1,80,000, what is going to be my post-tax cost? 10% is my interest, right? However, there's a tax saving of 50%. So effectively speaking, my cost is only 5%. Correct? No. Guys, yes. Similarly, on the remaining 1,20,000, 16% is the interest. So the KD is going to be how much? Hello? 8% into 1 minus T. Guys, clear with this? It's going to be 8%. Clear with this, guys? Right? So overall, what is the total cost of my debt financing? I have raised a total of how much? Hello? 3 lakh. Correct? On the first 1,80,000, I'm incurring a post-tax cost of how much? 5 lakh. So 1,80,000 into 5% plus 1,20,000 into 8%. Correct? This is the total interest I am actually paying for a total funding from the debt channel of 3 lakh. So the average debt cost of capital is going to be 6.2%. So as a single figure for the entire 3 lakh of debt component, what is your KD? If I ask, it is going to be 6.2%. This 6.2% is what I am averaging both the debt sources alone. I am averaging. Are you clear with this? Are you logical, guys? So this is the reason why they call it as post-tax average cost of additional debt. Clear with this? Logical. Or if you want, you can also take the proportions here. So 1.8 by 3 lakh, this weight you can take. 1.2 by 3 lakh, this weight you can take. Respect inside the debt itself, you can calculate this weighted average cost of capital. Similar kind of calculations you can do. Clear with this? Or simple total interest amount divided by total debt financing. If you do, you will get your post-tax average cost of additional debt. Clear with this? This is a new learning in this particular question. Clear with this, guys? Done. Next one. Determination of your KR and KE. How do you do it? By applying your dividend growth model. Now in this question, what have they given? EPS is how much? 4 rupees, right? And 50% is the dividend payout, which means my dividend is going to be how much? 2 rupees. Guys, correct? Please answer something. Yes, 2 rupees, right? Then what is going to be my growth rate? It's going to be 10%. And P0 is also given as how much? 44 rupees. So KE calculation, can I say, is nothing but D1 by P0 plus G. Guys, correct? Now, this is where one confusion arises. Sir, here this 2 rupees, how you have arrived? EPS into whatever is the payout ratio, you multiplied and you arrived at this. Sir, is this D1 or D0? Have they used any word like it is going to be paid? Expected dividend, they have not used the word. Have they used the word dividend paid in the past was so much? No. There is actually an ambiguity here. The question is silent, no? Right? I can either assume this as D1 or I can assume this as D0. If I assume this as D1, entire 2 rupees directly I can substitute the formula. If I assume this as D0, what I should do? D0 into 1 plus G. I need to apply the growth rate to arrive at D1. Correct, guys? What you need to do, you can do anything but write a note. But in this case, institute has taken an assumption that they are going to take this as D0 only. So here I think the note is, it is assumed that the dividend given in the question is D0. If you want D1, take it as D1. You take it, answer will be different. Clear with this, guys? Clear with this, guys? So in this case, what will be your final answer here? So it's going to be 2 rupees into 1.10. Correct? That's going to be your D1. So D1 is going to be how much? 2.2 rupees divided by P0, 44. P0 is given in the question. Guys, yes. And then plus G of 10%. So you get a total of how much? 15%. That's going to be your KE, and that is also going to be your KR. Are you clear with this, guys? Are you clear with this, guys? Simple. Done. Right? And finally, what have they asked? Calculate the overall weighted WACC, weighted average cost of capital. Of course, it's all after tax only. Very simple, not a problem at all. So what we got was the entire debt funding, entire debts. Inside debt, there are 2 components, right? But still, entire debt component itself, we calculate that for this entire 3 lakh rupees, the cost is what? 6.2%. We calculated, no? Right? So directly what they have done here, for this 0.3, for this 3 lakh, the cost is how much? 6.2, right? 6.2%. For this entire 7 lakhs, which might have a portion of retained earnings and equity share capital, KR is equal to KE only, no? So here directly we just computed it's 15%. So you apply the respective weights and arrive at the weighted average cost of capital. Clear with this? Hello? Yes, guys are clear with this? Any problem, any issues here? You guys are clear with this? Right? And that's about this. Sir, no sir, I want to maintain this as that 1.8 lakhs and here also I want to maintain 1.2 lakhs. You take, no problem. The answer will not change. Debt to know the funding 1.8 lakhs, 1.2 lakhs. The breakup was there. For this 1.8 lakhs, the figure was 5%. Here it was 8% or something like that. Correct? If you want, you maintain that mix and also calculate, then you will have 3 sources of finance. Equity, debt 1, debt 2. You do the same calculation, you will only get 12.36%. What we did was, this figure we averaged out and we computed it as 6.2. This is what we did in step 2, no? This we averaged out and we arrived at 6.2%. Really, Appa? You're able to understand biology? Yes, you're here? Okay. Physically you're here, but mentally also. Okay, fine. It's going to be 6.2%. Guys, clear with this, right? And that's the reason we are able to do it. If you want, you retain every source of finance and also compute the WACC. It will be the same only. There will not be any change here. Are you clear with this? Yes. Yes, guys. Fine. Just go and update your library of adjustment. That's about the sum. Write down. Write down. Write down. marginal cost of capital, MCC, semicolon, semicolon, calculation of post-tax average cost of additional debt, MCC, semicolon, calculation of post-tax average cost of additional debt. Post-tax average cost of additional debt. Are we done here? Done? Okay. Now let's move on to the next question. Question number 17. Gitarth Limited has a current debt equity ratio of 3:7. The company is presently considering several alternative investment proposals costing less than 25 lakhs. The company will always raise the funds required without disturbing its current capital structure ratio. And the cost of raising the debt and equity are as follows. Now look at this. Look at this. If you are raising a total amount of 5 lakhs, up to 5 lakhs, the following is the KD, 10%. Following is the KE, 12%. If you are raising funding beyond 5 lakh, but up to 10 lakh, KD and KE will change. Right? More than 10 lakh, up to 20 lakh, different KD, KE. Above 20 lakh, different KD, KE. Or in other words, as you keep raising more money, this KD and KE is actually increasing. Why? Because the risk perseverance from these providers of finance will also increase. More the risk, more the expectation of return, and whatever is their return is my cost. Are you clear with this? Simple logic. And more details and analysis about this we'll be seeing in a chapter called as capital structure decisions. It's all about this. We have something called as capital structure theories where we'll be seeing a lot of things. Clear with this, guys? Now, the corporate tax rate is 30%. Calculate the cutoff rate for two projects 1 and 2 whose fund requirements are 15 lakhs and 26 lakhs respectively. And 2, if a project is expected to give an after-tax return of 13%, determine under what conditions it would be acceptable. Now, I'll give you 30 seconds time. Please read the question first. Please read the question. Don't look at the solution. Read the question. Spend more time in reading the question. Automatically, lesser will be the time you spend in the solution. Fine? Read it. Read it. The wordings might be a little tricky. Please read it. That's the reason why I'm doing all this. Right? Done? Okay. Now, what have they mentioned in the question? Now, every rupee the company is going to raise, they will be maintaining this debt equity ratio. They will not change. The capital structure will not change. This is what they have given. Now, the company is looking for several investment proposals costing less than 25 lakhs. All those things are fine. But what they are saying is, now for the first 5 lakhs they raise, for the first 5 lakhs the company raise, This will be the respective cost of KD, KE. Next 5 lakh, that is 5 to 10, this will be the cost. Then for the next 10 lakhs, that is above 10 up to 20, the difference between this 10 and 20 is 10 lakhs. For the next 10 lakh, respective cost of KD and KE is given, and above 20 lakhs, so this is going to be the cost. This is what they have given. Clear with this? Now, what they want us to calculate is cutoff rate. Cutoff rate means what? Basically, it is nothing but weighted average cost of capital. I told you at the very beginning of the chapter, weighted average cost of capital can also be called as cutoff rate or the minimum required rate of return. These are the interchangeably usable words. Why and all, I will just share it with you in a few minutes from now. But first, how do you calculate the weighted average cost of capital here? First, there is a slab wise calculation of WACC here. So how do you compute this? Up to the first 5 lakh rupees. Guys, carefully listen. The first 5 lakh rupees, every rupee the company raises, there is not a problem at all. 0.3 will come from debt, 0.7 will come from equity. Any issue here? Any issue here? No. Correct? Or in other words, for the first 5 lakh rupees the company raises, right? 1.5 lakh will come from my debt, 3.5 lakh will come from my equity. Correct? And for the first for the first 5 lakh, right? In this case, what will be the respective KD and KE? It is given in the question 10 and 12%. Correct? No? 10 and 12%. Assume that this KD itself is computed and given. It's post-tax. Nothing needs to be done here. Clear with this? So, if I average it out, or in other words, can I say, in this 5 lakh rupees, guys, in this 5 lakh, first 5 lakh I'm raising. In this, 1.5 lakh has a cost of 10%. Correct? 3.5 lakh has a cost of 12%. Correct? Or in other words, this entire 5 lakh as a whole has a weighted average cost of 11.4%. Agreeing with me on this. So every rupee in this first 5 lakh bears a cost of 11.4% after mixing for this debt and equity, averaging out for debt and equity. Agreeing with me? Yes. Independent breakup inside this is only that, debt and equity, but average cost of this first 5 lakh is going to be 11.4. Agreeing with me on this? Agreeing with me on this? Will it be the same? Will it be the same throughout? Suppose I want to raise 10 lakhs, then still the weighted average cost of capital for the entire 10 lakh will be 11.4. No, for the first 5 lakh, inside it every rupee raised, right? For the first 5 lakh alone overall, the cost is 11.4. If you go beyond 5 up to 10, there is another slab applicable for you. What is that? For the next 5 lakh, if you see, once again, I'm not going to change the mix. But for the next 5 lakh, what happens? KD becomes 12, KE becomes 13.5. If you average out, inside the next 5 lakh, the cost is going to be how much? 13.05%. Or in other words, if I'm raising 10 lakh rupees as a whole, for the first 5 lakhs are 11.4%. For the next 5 lakhs, sir, the overall cost is 13.05%. Are you agreeing with me on this? Now, if you go beyond 10 lakhs, but up to 20 lakhs, what will happen? Which means for the next 10 lakhs over and above 10 lakhs, 10 lakhs you have raised till now. Further, beyond 10 up to 20, this difference of 10 lakhs, what will be the cost? Once again, I will retain the same mix of 0.3 to 0.7, but then here the cost becomes how much? KE is 13, KD is 13, KE is going to be 15%. Average it out, and I'm saying the next 10 lakh, every rupee will cost me how much? 15.4%. Now, over and above 20 lakh, what happens? So the KD is 14, KE is 16. If you average it out, it's going to be how much? 15.4%. Are you clear with this? Or representatively, if you want me to put it in one single line, I will say for the first 5 lakh, what is going to be my KO? KO is going to be, come on, calculate. I mean, it's there, no? It's going to be how much? 11.4, 11.4%, right? 5 lakh up to 10 lakh, which means for the additional 5 lakh, how much is going to be my KO? It's going to be 13.05%. Now, more than 10 lakhs, but up to 20 lakhs, how much is it going to be? I will change this. Yes. Up more than 10 lakh, up to 20 lakh, KO is equal to how much? 14.40%, and beyond 20 lakhs, how much is that going to be? KO is equal to 15.4%. So which means here there is no one cost of capital. I have different costs depending on the range in which I am lying. Clear with this, guys? Clear with this, guys? So for the first 5 lakh, the cost is 11.4. For the next 5 lakh, the cost is 13.05. For the next 10 lakh, the cost is 14.4. And beyond that, every rupee that I raise is going to cost me for 15.4%. Agreeing with me on this? Guys, agreeing with me on this? It's a very important understanding. Now, first project. The company is having 2 projects, they are saying. Project means what? On the investment side, right? So on the balance sheet, on the asset side, they are saying, look, calculate the cutoff rate. Means what? What will be the cost if I am planning to fund for my project 1? Or what will be the cost if I am planning to fund for my project 2? And the funding requirements are given as 15 and 26, right? The funding will impact, the amount of funding will impact my cost of capital because we are operating on a slab basis. Here with this. Now what will happen? The first project, what is the total funding required? 15 lakh rupees, correct? So can I say, guys, for the first project, total of how much I need? 15 lakh. Entire 15 lakh will have one cost. No. For the first 5 lakh, I have a cost of 11.4%. Just now we saw. For the next 5 lakh, I have a cost of how much? 13.05%. And for the next 5 lakh, how do you get this? The project value itself is 15 lakh only. The next 5 lakh, I get a cost of how much? 14.4%. Are you clear with this? Or in other words, so basically what I say, on the first 5 lakh, I incurred a cost of 11.40, multiply the 2. So what is the total cost you incurred in amount? 57,000. For the next 5 lakh, you had to incur a cost of 13.05, multiply it, you incurred a total of 65,250 rupees. This is the cost pertaining to the second 5 lakh. The third 5 lakh, you incurred a cost of 14.4%. The cost incurred in amount was 72,000. So overall, to raise 15 lakh rupee, you had to pay an amount or incur a cost in amount of 1,94,250, or to put it as a percentage, 1,94,250 is the cost pertaining to 15 lakhs. What is going to be my effective overall cost of capital if I'm going for a funding requirement of 15 lakh rupees? It is going to be 12.95%. Or you can also take the weights here, guys. This is what 0.3333, 0.3333, 0.3333, multiply with the respective cost, you will arrive at the weighted average cost. Both are same. Mathematics, simple mathematics. Here with this, right? So what is the cost of capital with respect to project 1? It's going to be 12.95%. Here with this. Now, why do we call this as a cutoff rate? Because this cost, how did we calculate? This is the cost of funding this project. Correct? Guys, carefully listen. I'm going to interlink this with another chapter or another decision in this entire subject. What is this 12.95%? Every rupee that I had to raise to fund this project 1 is effectively, on an average, costing me 12.95%. What does it mean? Means that if you are investing 15 lakh rupees in this project, now somehow beg, borrow, steal from different sources of finance, I am funding it with 15 lakh rupees. Overall, effectively, my cost is how much? 12.95. Means now using this money, what will I do? I will put it in my bank account and sleep. No, I will invest in assets, right? That assets, having invested, should at least generate a return of 12.95%. Only if it generates a return of more than that, actually I can see some profit. Agreeing with me on this? Or in other words, I should plan my investment decisions in such a way that the return that I get from my investments should definitely be more than 12.95%, because the cost of funding these investments was 12.95%. So the return that I get out of this investment should at least be more than your 12.95%. Agreeing with me on this? Agreeing with me on this? So, sir, how do you compute the return from this investment? So on the investment side, that is, the balance sheet is here, correct? Right now what we did, for the funding side, we calculated the IRR computation and weighted average. We call that as KO. Correct? Now, having deployed the funds here on my assets, The assets, what will happen? Now I'm putting my assets. Now it has, let us say, a life of 10 years and all that. From these assets, I will be generating cash flows every year. I'll be making sales, generating profit and all that. Now, using this cash flow, if I calculate the same IRR, that is called as my effective return. So basically what we are doing, the IRR computed on the funding side is my cost. The same IRR calculations using different cash flows, if I calculate the same IRR on my asset side, basically that is actually going to be called as my return. And I am saying that this return that you are getting out of your investment should definitely be greater than your cost. Only then the company can see some profit. Are you able to understand this? Right? But sir, how will you calculate the return? That we will be seeing in a separate chapter called as investment decisions. Because for you to know that, you should know how much cash flows the project is generating. Here, do you have the project cash flows? No, you only have the funding requirement. So 15 lakh was the initial investment. So look at this from the asset side. I invested 15 lakhs. Now I am buying one machinery worth 15 lakh rupees, right? Initial outflow followed by a series of inflow. So what will be the inflow? That we will be seeing in a different chapter called as investment decisions. Here what we are doing, for me to raise this 15 lakh rupees, what was the total cost? We calculated it as 12.95%. Are you clear with this? This 12.95% should be the minimum required rate of return that should have been generated, or that my investments should generate. Are you able to understand this? Are you able to understand this? Clear with this? This is a very, very important understanding, which we'll be seeing in a later chapter called as capital budgeting, also known as investment decision. Clear with this? Right? There also we'll be computing IRR, but using the different cash flows on the asset side. If you calculate the IRR on the cash flows that is happening on the sourcing, financing side, that is called as KO. IRR calculated, that is actually called as a return. Are you clear with this? And your return should at least be equal to your KO, if not more. Only then the company will earn a profit. Are you able to understand? Overall, this is the big picture of the entire subject itself. Here with this, guys, very important understanding. Now coming back to the discussion. Similarly, for project 2, what is the total amount required, guys? What is the total amount required? 26 lakh. So 26 lakh, entire 26 lakh, will it be having the same cost? No. First 5 lakh had a cost of 11.4%. Next 5 lakh had a cost of 13.05. Next 10 lakh had a cost of 14.4. Here 14.4, and the balance 6 lakhs, that is 26 minus 20, had a cost of 15.4%. Correct? So now what do you do? So arrive at, so the total cost in terms of amount is going to be 3,58,650 you spend, divided by a total funding of 26 lakh. The effective cost that you're getting from this project is going to be how much? So it's going to be 13.76. The effective cost of raising 26 lakhs is going to be how much? 13.79%. Are you clear with this? Are you able to understand? This is what they have asked for in this particular first part of the question. Now read the second part. Now they are saying, if a project is expected to give an after tax rate of return of 13%, what they are saying, sir, you gave me some money, right? So for project 1 it was 15 lakh, project 2 it was 26 lakh, correct? This money was invested in a machinery, and I invested in that machinery. Every year I'm generating a cash flow. I calculated the IRR on the asset side, and they are saying that IRR is equal to 13%. Or in other words, the net return I am getting out of my investments is 13%. They are saying under what conditions it will be acceptable. First, I'm telling you guys, project number 1, as per whatever fact given in the question, project 1, they are saying, gives you a return of 13%. Guys, yes, they have given in the question. Sir, how do you know? They have given in the question. They are saying project 1 is giving you a return of 13%. For this project 1 to raise this 15 lakh, what was the cost you incurred? 12.95%. Correct? So you incurred a cost of 12.95, but it is giving a return of 13. Is it acceptable? Is it acceptable? Think no. What happened? You look very confused. Return that comes out of the project. Cost is 12.5. Return is more than cost. You can happily go for the project. Simple. Clear? Now, what happened in case of project 2? For project 2, the cost of funding this 26 lakh was how much? 13.79. But having invested this 26 lakh, I was able to generate only how much? 13%. Will you go for project 2? Not. This is what they are saying. If any project is expected to give an after tax return of 13%, right? right? So then in that case, it can be accepted only if the maximum overall cost of capital is equal to 13 or it is less than 13%. They are saying if the return is 13, my cost should at least be equal to 13 or less than 13. If my cost is more than return, why will I go for it? It is a loss. It is a suicide mission. I am saying I will borrow some money at some higher rate of interest and invest and get only lesser amount. Why will I do that? Why will I do that? My return should always be greater than cost. Are you able to understand? If my return is capped at 13%, my cost should be less than that for me to earn a profit. If my cost is more than that, then I will definitely not go for that project. Are you able to understand? This is what they are saying here, right? So now what they are saying is, under the scenario, project 1 can be taken. Why? Because its cost is 12.95%, return is 13, return more than cost. Correct? Whereas project 2 cannot be accepted. Why? It is having a cost of 13.79% with the same return of only 13. Cost exceeds my what? Cost exceeds my return. Clear with this? Now the further question they are saying, the maximum value of project that can be taken at 13% approx. Now what is this? I will tell you. Simple, guys. What they are saying is, look at this. Now here at 15 lakhs, right? What is the KO? Project 1 we just saw. For 15 lakh rupees, if you are raising, your KO is going to be how much? 12.95%. Project 1 ma 15 lakh. What is the cost? 12.95. Agreeing? For the second project, project number 2, 26 lakh. What was actually the overall cost? 13.79%. They are asking you kind of a point where exactly my cost will be equal to 13%. So how will you calculate? The same interpolation you can do. So how will you do that? Very simple. Now look at this. From 15 lakh, incrementally it is 26 lakh. What is the difference? 15 to 26 is 11 lakhs. Correct? So can I say, if I want to increase my value by 11 lakhs, right, my percentage, that is my KO, should increase by how much? 13.79 minus 12.95. How much is it? 13.79 minus 12.95. How much is that? 0.84. But I want my KO to max increase only up to 13%. That is 13 minus 12.95. How much is it? If I wanted to increase only by 0.05%, by how much should the value be increased? So if you do this interpolation, what will you get? The base 15 lakh plus what is this? 11 lakh for a 0.84% increase. How much will it be for 0.05? It's very simple. So it's going to be, so 11 lakh divided by 0.84 multiplied by 0.05. Normal interpolation, no? So 11 by, if 11 is for 0.84, how much should it be for 0.05? Are you clear with this? Normal interpolation that we did. We are not calculating IRR here. We are just calculating the point up to which we can accept the project. So if you do this calculation, it is going to be what? It is going to be 15.6548 lakhs. Or in other words, to put it short, guys, what are we calculating? Here? They are saying you can accept a project provided its maximum investment requirement is 15.6548 lakhs. Why? Because only up to a funding requirement of 15.6548 lakhs, your average cost of capital will work out to be 13%. Suppose if you are raising more than that, what will happen? Your cost will exceed 10%, but your return will still continue to be 13%. So in that case, your cost will exceed your return. So don't go for it. So the question here is, up to maximum of how much investment requirement can I actually go for a funding? The max amount that you can go for a funding requirement is 15.6548 lakhs, because only up to that your overall cost of capital will work out to 13%. If you start raising more than that, your cost of capital will increase, but your return that you're getting out of the investment will continue to be only at 13%. Cost will be greater than return. It's a loss scenario for you. Are you able to understand this? Right? This is what they have asked for in this question. Once again, this is one area which many students are not able to understand just by reading the question, because it's again a tricky area. That's why I took this much amount of time in explaining it. And with that, we have completed this question. Look how they've worded. If the project is expected to give a return of 13%, determine under what conditions it would be acceptable. You need to write all these things. Here with this, right? Just go and update your library of adjustments. Write down. Write down. MCC. Sorry, this was not marginal cost of capital. Sorry guys, it's not MCC. WACC using slab rates. WACC using slab rates of two projects, semicolon, accept stroke reject criteria with calculations. Accept stroke reject criteria with calculations, and mark this sum as very important. Mark this sum as very important. This was in a past MTP question. I found this as very interesting, so I just took this up. Right? So very, very good question. An excellent question. Many students might not even understand what this question says. That's why we spend this much amount of time in learning it. Guys, clear with this? Done? That's about this particular question as well. Now let's move on to the next one, the next concept. Now, please go to your concept decoder notes. There is one concept called as convertible debentures, right? I want to do that. Yes. Convertible debentures. Now guys, what do you mean by convertible debentures? Exactly. So you might have read theoretically as to what do you mean by a convertible debenture. It means what? The debentures are issued now, and on the date of redemption, you are given a choice to convert these debentures into equity shares. It is only a choice, right? When will you exercise that choice? They are saying these debentures are redeemable at par, which means what? 100 rupee debenture. Right? It will be redeemed at par. 100 rupees if you want, you take. Or I'm giving you one more option. Instead of the company paying you 100 rupees back, they will say, instead, I will give you 3 equity shares. I will not pay you anything. Instead, I will give you 3 equity shares of the company. Right? So instead of a debenture holder, now you become the equity shareholder of the company. Yeah, with this. You tell me, when will you exercise the option? You are left with option. The company can't force you. It is convertible, right? You are given the option. When will you exercise the option of going for this equity share, or whether going for the cash value of 100? Simple logic. On the day of redemption, let us say per equity share in the market, it is quoting at 40 rupees. And they are telling you they are willing to give you 3 equity shares. 3 into 40. What is the equity shares value? 120 rupees. Option number 1 was they will pay you 100 rupees, or option number 2, they will give you 120 rupees worth of equity shares. Which one will you go for? Obviously, now you will say, I will go for equity shares only. Clear with this? Sir, no sir, I am not a person. I don't want to hold this equity shares. Who is asking you to hold? Take the equity share, go to the secondary market, sell it, encash it. Today itself you will get 120 rupees. Clear with this guy? Clear with this? Provided it's between Monday to Friday, right? Because only then the markets are open. Clear with this, guys? Yes, are you able to understand? As simple as that. So, or in other words, convertible debentures, everything is the same. You only have one extra calculation of redemption value. Redemption value is higher of the cash value or your equity shares value on the day of redemption. Clear with this? Once you do this, you use the same formula, I into 1 minus t plus rv minus np by n the whole by rv plus np by 2. Here, wherever rv comes, that alone requires a calculation. With this guy. Suppose you are using yield to maturity method, everything is same. At the end, redemption value alone, you need to separately calculate, take the higher of the two value and do it. As simple as that. With this, the entire concept is over, right? So convertible cost of convertible debentures, the holders of convertible debentures have an option to either get the debentures redeemed into cash or to get a specified number of equity shares of the company in lieu of cash. Lieu means what? Instead of. Right? The calculation of cost of convertible debentures are very much similar to that of redeemable debentures. While the determination of redemption value of debenture, it is assumed that all the debenture holders will choose the option which has a higher value, and accordingly, it will be considered to calculate the cost of debentures. And the redemption value is taken as higher of cash value of or the value of equity. Over this. Any issue here? Any issue here? No. With this, quickly let's go on to the next question, guys. Let's go on to the next question, which is question number. What's the next question? 18, no? Right? Question number 18. Now, quickly, shall we get started, guys? Yes, let's do this question. A company issued 10,000 15% convertible debentures of rupees 100 each with a maturity of 5 years. 1 second. This convertible debenture can only be redeemable in nature. Can there be irredeemable in nature? If there is no redemption, where is the question of conversion? When will you convert it? Here with this, right? So obviously it has a finite life. So now they are issuing 10,000 15% convertible debentures of 100 each with a maturity period of 5 years. At maturity, the debenture holders will be given an option to convert the debentures into equity shares of the company in the ratio of 1:10. Means what? 10 shares for every debenture held. The current market price of equity shares is 12 rupee each, and historically the growth rate of shares is 5%. Compute the cost of debentures assuming a 35%. Now you tell me, if you are a debenture holder, will you, at the time of redemption, will you take cash or will you take equity shares? They are going to give you 10 shares, right? And every share has a market value of how much? 12 rupees. So what is the value? 120. So 120 versus 100. Which one will you prefer? Huh? You will prefer equity shares, right? But can you take 12 rupees? Can you take 12 rupees as the price to calculate the redemption value? Absolutely not. Read the question carefully. They are saying current market price. Today it is 12. When you are calculating the redemption value, you should calculate the value of equity share at the end of 5th year, my friend. Right? So you need to arrive the future value of this 12 rupees. That will be the equity share, the market price of equity share at the time of redemption. That value you multiply with 10 shares, arrive at the redemption value. Here with this. Right? So always understand, we need to take the current market price of equity share at the time of redemption and not today. Clear with this. Don't jump to the answer. Wait and you watch it. Clear with this, guys? Are you able to understand this? That's about it, right? Now look at this. How do you arrive? Now they have given historically it is said that the growth rate of the shares is 5%. Now 1 second. Immediately when you see growth rate, don't think it is Gordon's model. Gordon's model says dividend grows as a certain rate. Here we don't need any KE calculation. Nothing is required here. Basically they are saying today the market value is 12. Every year incrementally it will grow by 5%. That's all they are saying. Clear with this? The moment you read the word growth, don't say it's Gordon. Simple. They are saying this has nothing to do with Gordon's model, because Gordon model says the dividends grow at the rate of, here they are saying the share price will grow at 5%. Normal calculation, right? So how will you calculate? How will you calculate the market value of the equity share, every equity share at the end of 5th year? 12 into 1.05 to the power 5. Correct? Correct? No. Yes. Compound rate. Future value is equal to present value into 1 plus r the whole power n. Guys, yes. Right? That is how you need to calculate. Look at this. Determination of redemption value. So, which sum are we in? We need to calculate KD. Correct? No. For you to calculate KD, one of the ingredients is going to be your redemption value. Redemption value is what's a par premium discount. That's all, no? But in this case, there is a sweetener attached to this debenture that is called as convertible option. So whenever you have a convertible debenture, you need to manually calculate the cash value and the equity value, and higher of the two will only be preferred. So the first step is calculating the redemption value. Once you get this, substitute it in the formula, or if you are going for IRR, go use this. But you need this component called as redemption value, that only we are calculating. So what is the cash value of debenture? Absence of information, assumed to be redeemed at par, 100. Clear, guys? Right? Now, what is the value of equity share? Just now we saw it is 12 rupees, but the 12 rupees is today. And they have given the question, every year the share value will grow by 5%. So into 1.05 to the power 5. So this is nothing but future value is equal to present value into 1 plus r the whole power n. That formula is only being used here. Guys, yes. Are you able to understand this? Why are we using future value? Because we're calculating the redemption price. When will the redemption happen? At the end of 5th year. So we need to calculate the tomorrow's value of today's money. Correct? No. Time value of money. Right? Getting it? Fine. So if you do that calculation, so you get that the redemption value is going to be 153.12. Now, between 153.12 and 100, whichever is higher, 153.12, obviously that is going to be taken as a redemption value since it is higher than the cash option and it is more attractive to the investor. So now what will you do? Apply it in your KD formula. What is the formula of KD? Come on, tell me, guys. I into 1 minus T plus RV minus NP by N the whole by RV plus NP by 2. As simple as that. And now what you need to do here is 15 into 1 minus 0.35 plus redemption value just now we calculated minus net proceeds, absence of information, face value by the life, the whole by 153.12 plus 100 by 2. If you do it, the calculation finally you'll get 16.09%. Guys, clear with this? Or alternatively, if you are going for the present value method, popularly known as YTM, also known as IRR method, right? So what you need to do here is you take the relevant cash flows. Year 0, what will be the cash flow, guys? Negative 100. Correct? No, sorry. Year 0 is going to be, ideally speaking, year 0, you are going to get the cash flow from the investors, positive 100, right? During the life, what is going to be your post-tax interest? Post-tax interest is going to be 15 into 0.65, no? Guys, 15 into 0.65, no? 15 into 0.65, it's going to be 9.75. That's how they have calculated this. Post-tax interest. Here, you're not able to understand. No, I'm saying I into 1 minus T, T is what? 35% tax. 1 minus 0.35 is 0.65. 15 into 0.65 is what? 9.75. You calculate and you see. Right? Every year annual cash flow will be what? 9.5. Getting it? Okay, that's all. Right? And at the end of 5th year, the company will be having an outflow of how much, guys? 153.12. That's what we calculated based on this. Ideally speaking, this should be in positive. These two should be in negative. Right? Even if you do it the other way around, it will be correct only, not a problem. Right? So they have taken two trials, 15%, 20%, one positive NPV, one negative NPV, and interpolation technique, they have arrived at KD. Clear with this? Now look at this. As per IRR method, how much is KD? 15.43. As per approximation, 16.7%, close to 1.4% is the difference. That's why this method is actually not correct. Right? In exam, you do this only, saves time. But I'm telling you, are you able to understand? That's why it's called the approximation method. Same figures only. Right? So IRR is always correct. One more thing I'll tell you. Here, lower rate is what? 15. Higher rate is what? 20. Final answer, you're getting what? 17.43. Strictly speaking, if you take the first trial as 17, second trial as 18, and if you do it, the answer will be more accurate. It will not be 17.43. It will differ. That's where I said in the last class or somewhere I said, based on the trials, the answer will differ. More the spread, more the inaccuracy. As far as possible, the spread should be lesser. Only then it will be more accurate. Clear with this? These are all some computation issues. So that's the thing. That's the reason. That's one practical difficulty when it comes to this particular concept of IRR. There's no other option, right? And the discount rates and all will be given in the question generally. So that's the reason why you need not worry in figuring out. Clear with this, guys? And that's about this concept of convertible debentures. So just go and update your library of adjustments right now. Right on. Right on. So, KD hyphen cost of convertible debenture. KD hyphen cost of convertible debenture. Done? Right. Okay, fine. So with this, I'm concluding this session. So please revise till whatever we have covered till now, and I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So now let's continue our discussion in this chapter, cost of capital. Now please go to the next question, question number 19. Right, so in the previous session we saw the concept of convertible debenture and we did one numerical problem, which was question number 18. So now let's go to question number 19 and please mark this sum as important. Right, it's a good question, a must visit the day before your exam. And in fact, this is also a very popular exam question. So now let me quickly read the question out for you. Guys, full focus. Deal? Yes. A company issues 15% convertible debenture of rupees 100 each at par with a maturity period of 6 years. Right? So the period life is going to be 6 years. The par value, the face value is 100 and it's going to be a 15% debenture carrying a coupon of 15%. On maturity, each debenture will be converted into 2 equity shares of the company. The risk-free rate of return is 10%, and the market risk premium is 18%, and the beta of the company is 1.25 times. The company has paid a dividend of 12.76 rupees per share, and 5 years ago it paid a dividend of 10 rupees per share with a flotation cost is 5% of the issue amount. Now, 5% preference shares of rupees 100 each at a premium of 10% was issued. These shares are redeemable after 10 years at par with a flotation cost of 6%. Assuming a corporate tax of 40%, calculate the cost of convertible debenture using approximation method. Use YTM method to calculate cost of preference. Now, preference shares calculation KP, nothing great. It's the same. Okay, so no value addition here. This entire question revolves around calculating your KD predominantly. First part of the question is the main deal. Done. Now, what should you calculate? Come on, guys. What have they asked? First part of the question. KD calculation. KD, how will you calculate? You know that formula. They have asked you to use the formula I into 1 minus T plus RV minus NP by N the whole by RV plus NP by 2. Here, everything I is 15%. So 15 into 100, 15 rupees I into 1 minus T, tax rate is given. As RV, that redemption value is where the entire calculation lies in, right? Now, because this is a convertible debenture, redemption value will be higher of the cash value and the value of equity share at the end of the period. The period is going to be 6 years. Here with this. Now, in this question, you need to calculate KD. For you to calculate KD, you need to have one ingredient called as redemption value. For you to calculate this redemption value, you need to find out what will be the market price per share of every MPS of equity share at the end of 6th year. Correct? No? To put it short, this is the sequence of events that need to be done. The first step of this question is what? Basically, you need to find out the market price for every equity share at the end of 6th year. Correct? Done. What have they given in the question? Read this. Now, with respect to equity, this data is only given. RF is how much? 10%. Guys, yes. Now, market risk premium is 18%. What is 18%? Very good. It is not RM, it is RM minus RF. Use the word premium. Very good. Now, beta is given as 1.25. With this, what you can calculate? What you can calculate? Very good. KE can be calculated. K is equal to RF plus beta times RM minus RF. Directly you can calculate KE. Correct? KE, but is KE asked in the question? No, but wait. KE can be calculated using CAPM method. Correct? Flotation cost is given as 5% of issue amount. This was also given. Apart from that, one more thing is given. 5 years ago, the company paid a dividend of ₹10, right? And recently, just now, the company has paid a dividend of how much? 12.76, right? 5 years ago, it paid how much? 10. In a span of 5 years, it has turned into how much? 12.76. Using this data, what can you calculate? What can you calculate? Exactly, growth rate can be calculated. Here with this. Here with this. So now, why are we doing all these things? Well, guys, very, very beautiful question. What you need to do. What you need. Now, in this question, first we need to calculate the value of equity share. Correct? The value of equity share at the end of 6th year, you need to calculate. Correct? No? Right? Now, This is actually an equity share where the dividends are growing every year. Correct? No, because they have given there's a trend. Dividends are growing. So clearly in this question, this equity share valuation needs to be done using Gordon's model. Correct? What does Gordon's model tell you? The present value of anything in case of a growing cash flow is what? The next year's cash flow divided by discount rate minus growth rate. We saw, no? Right? Correct? So we need to arrive at the value of equity share at the end of 6th year. Is correct? So the value of equity share at the end of 6th year will be what? D7, the next year's cash flow divided by discount rate KE minus growth rate G. Agreeing with me on this? Agreeing with me on this? Yes. Next year's cash flow divided by KE minus G. Correct? Right? Now, for this Gordon's model, right? That's how you need to value your equity share at the end of 6th year. For this, KE value is required. Guys, denominator KE is there. KE value is required. Arrive at KE value using CAPM. Here with this. G value is required. Arrive at the G value using the trend given in the question. Here with this. And once you calculate G, now they have given recently, they have paid a dividend of how much? 12.76. So 12.76 into 1 plus growth rate to the power 7 you will do. You will arrive at the dividend payable at the end of 7th year. Are you able to understand this? This is the thing to crack in this question. Are you able to understand? Right? So many students find this very, very difficult to understand. Technically speaking, for the purpose of this entire calculation which we did, this 10 rupee of dividend is irrelevant because it was paid 5 years ago. But then why have they given that 10 rupee of dividend value is required only for the purpose of finding out the trend and arriving at the growth rate. 10 rupees becomes 12.76 rupees in a span of 5 years. So D minus 5 is actually 10. 5 years ago, D0 is actually 12.76. Using this data, you calculate G. Once you arrive at G, this 10 rupees is not at all relevant. So now what will be the dividend at the end of 7th year? It is going to be 12.76 into 1 plus growth rate to the power 7. Are you able to understand this? This understanding is very important. Now, if this is the case, then you are actually sorted for this. Here with this guy. Right? Now, shall we proceed? So now, this sum, the value of equity share at the end of 6th year needs to be done as per Gordon's model. Correct? No? Because it's going to be the dividend is growing. They have not said the price of the share is growing. Dividend is growing. Right? Hence, we are using Gordon's model. Clear with this? Right? So for this, we need to calculate these two ingredients called as KE and G. So first what they have done, so it is given that RF is 10%. RM minus RF is 18%. Market risk premium they have given. Beta is 1.25 times. So in this case, what is going to be your, using CAPM, KE is equal to what? RF plus beta times RM minus RF, or 10% plus 1.25 into 18%. You get a KE of 32.50%. Here with this guy, right? And one very important thing that I want to tell you all, if I have to put this in a chart format, right? T0 is what? Please read the question and tell me properly. The company has just paid. We are in today, right? So what is the company has just paid a dividend of how much? 12.76. So rupees 12.76 is what? D0. 5 years ago, it paid a dividend of how much? 10 rupees. So can I say D minus 5 was how much? 10 rupees. Correct? No, 5 years back. This is present. This is back. Correct? And we need to calculate D7 for the purpose of Gordon's model. Correct? No. Guys, are you clear with this? Have the clarity. So strictly speaking, in this case, this is not D5 ma. Please rewrite this as D minus 5. Strictly speaking, this is D minus 5. 5 years ago. Clear with this, right? Are you able to understand this? Are you able to understand this? Guys, are you all able to understand this? Don't mix this up. Yes. Now, first for Gordon's model, denominator, one denominator figure you have got, one of the ingredients in the denominator, KE you have got. Correct? No? Right? It is nothing but D7 divided by KE minus G, where now KE figure we have got. The next target is what? Arrive at the G figure. Correct? How do you arrive at G figure? We know that future value is equal to present value into 1 plus R the whole power n, compound interest formula. Now they have given 10 rupees, guys, 10 rupees has become 12.76 rupees in a span of 5 years, which means at what rate has it grown? Clear? So strictly speaking, forget this d minus 5 or d0 and all, you forget all this. 10 rupees has grown to how much? 12.76. What is going to be the actually the discount rate, or what is going to be the rate? That's what we need to calculate. Or can I say 12.76 is equal to 10 into 1 plus r the whole power 5? Guys, correct? Or this is nothing but I'm just putting it here. So 12.76 divided by 10 is equal to 1 plus r the whole power 5. Guys, correct? Or can I say 12.76 divided by 10 the whole to the power 1 divided by 5. To the power 5 here, if it goes to the other side, becomes 1 by 5 is equal to 1 plus r. Correct? No? Or can I say r is equal to 12.76 divided by 10 the whole power 1 by 5 minus 1. Can I say this? Ideally, this is nothing but the growth rate. All these things are not required. Why am I saying this is, look, there is one formula that I have given you in the book, right? That is nothing but one of the ways in which you can calculate the growth rate. I have just given one formula there. That's the reason why I just gave you this. 1 second. Where is it? I think it's below. Oh. Taking some time to load. Yes, look at this. G is equal to, right, d0 by dn minus 1, the cube root and all. You need not mug this up. This is nothing but a derivation of all these things. Clear with this, guys? Clear with this? Or simple. Why so much amount of struggle here? Directly, they would have given you all these figures. So now what we did, this equation you understood, 12.76 is equal to 10 into 1 plus d the whole power 5. Right? So this 10 went to the other side. So it's basically 1.276 is equal to 1 plus d the whole power 5. Correct? Right? Or in other words, what is the meaning of this? 1 rupee has grown to become 1.276 rupee in a span of 5 years. Calculate at what rate it is compounding. This is the meaning, no? How do you do it? Now, you just go in the question, they have given some compound table, no? Right? 5 years future value, right? Which value matches with this figure? You see, 1.276 is the answer you should get. Correct? So 1 rupee becomes 1.276 rupee in a span of 5 years. At what rate of interest? If you see, exactly it matches at 5%. This is all you need to do. You need not do all this cube root calculation and all. This is all you see. You need to do. You write this from the table. It can be arrived as follows. To understand this, right? So from the future value table, so G is equal to 5%. Guys, clear with this? So now what happened, guys? You got the KE figure. Hello, look at this. Yes, you got the G figure, right? Now D7 can you calculate? Yes, I have D0 with me. What is D0? D0 is 12.76, correct? So what is going to be D7? So 12.76 into 1.05. The growth rate is 5%, no? To the power 7. Are you able to understand? I get this D7. So now directly I can go ahead and substitute. So D7 by KE minus D is 12.76 into 1.05 to the power 7 divided by, this is KE and this is G. Are you? If I do this, I will get the value of every equity share at the end of 6 years. It arrives to 65.28. Are you able to understand this? Yes, right? And once this is done, what are they saying? Now go to the question. Every other thing is vanilla, plain, very simple, right? What have they given here? So every debenture will be converted into 2 equity shares, right, guys? 2 equity shares. So that's going to be what? It's going to be what? What is the value? Per equity share is going to be 65.28. So 65.28 into 2. So the redemption value of debenture, the equity value of debenture is going to be 130.56. Compare this with 100 of cash value. Obviously, which one will they prefer? They will only prefer the equity component. So now what they will do, they've also mentioned, so now we need to calculate KD. Now only the sum is actually starting. Basically, as in now it's a final step, you can just substitute. So KD formula, what is it? I into 1 minus T plus RV minus NP by N the whole by RV plus NP by 2 plus, okay, by 2, correct? the whole into 100. So now they have given that flotation cost is 5%. So issue price is 100 minus 5 is going to be 95. The number life is going to be 6 years. Interest, I think, what was it, 15%? Yes, 15% tax rate is going to be 4. So 15 into 1 minus 0.4. Yes, 40%. Yes. Plus RV, just now we calculated. Minus NP, just now we saw in the top, right? By N the whole by RV plus NP by 2. If you do it, you will arrive at 13 points. Clear with this. Look at the beauty of this question. You used Gordon model to arrive at the value of equity share, but under Gordon model, KE calculation alone was done using CAPM method. See, look at the beauty in which they have interlinked this question. Are you clear with this? This was a past exam question, if I'm not wrong, right? And it's also there in your study material. Watch out for these kind of beautiful questions. Two model in a single question, which never talked about equity. This question was about KD calculation. But since it was a convertible debenture, it required some concepts of equity. See, look at the beauty of this question. And that too, two models it required. Are you able to understand? Right? Right? This is why CA Institute stands apart. Right? Give credit where it's due. This is the reason. So now if you learn this thing logically, see how beautifully you're able to interconnect the subject. It's all it takes, guys. It's not difficult. Right? Conceptual learning is the most and the best smart way of learning the subject. Right? And then the next one is going to be what? Your preference share capital. Guys, this is simple, guys. Normal calculation, YTM method. What you need to do is to take two trials. Sir, which two trials to take and all they have given now? Right? One should be 3%, one should be 5%. That's why they have given. Correct? All the values. So you guys ask me, sir, how do we know which trial to take? Generally, they give this table. You use this table for the trials. Simple. Guys, clear? So look at this. Look at this. At 3%, NPV is negative. At 5%, NPV is positive. You do an interpolation, arrive at the KP figure. Guys, done. I am not going to repeat this and waste your time. Clear with this? That's about it. Go and update your library file. Just write down. Write down. Write down. Cost of convertible debenture, semicolon. Cost of convertible debenture, semicolon. Calculation of G using trend. Calculation of G using trend. Semicolon. Semicolon. Gordon's model plus CAPM model. Gordon's model plus CAPM model to calculate the value of equity share. The value of equity share at T6. T6 means time zone 6, the 6th year. T6 at T6. Beautiful sum. Beautiful sum. Mark this also as important. I think till now I've said 4 sums as good sums. Please mark these sums as important the day before your exam. It is a must visit. Must visit. Right? Are we done here? Perfect. Now 19 A's and all very similar. You can just go through it. Okay. Then okay. The sum. Let's quickly do this. Oh, it's again a very easy sum. Nothing great, guys. Look, quickly. Let me do this. ANOVA Limited is considering raising of funds of about 250 lakhs by any of the two alternative methods, which is a 14% institutional term loan or a 13% non-convertible debenture option. Okay, both are debt only, right? Either go for a 14% term loan or go for a 13% non-convertible debenture. Non-convertible debenture means normal debenture. It is not convertible. At the end of the life, you will only pay cash. That is the meaning. Okay. The term loan option would attract no major incidental cost and can be ignored. As in, not the option. Cost can be ignored. That is your no flotation cost. In case of term loan, what flotation cost? You're going to a bank and taking a loan. Yeah, with this, there is no incidental cost. Whereas the debenture option would have to be issued at a discount of 2.5% and would involve a cost of issue the extent of 2% on face value. Advise the company as to the better option based on the effective cost of capital in each case, assuming a tax rate of 50%. Great, guys. First, one thing. When you are going for a term loan, can I say KD in case of term loan is nothing but directly interest rate into 1 minus T? Correct? No. Or if you want, you use that formula, RV minus NP by everything is 100 only. It is base is same only. There is no concept of redemption value. You don't have a concept of a different issue price and all. The only cost associated with a term loan is interest. So can I directly say, whenever you're talking about a term loan, the effective KD for a term loan is interest rate into 1 minus T itself. Correct? Guys, yes. Post-tax cost of interest. So directly can I say, what is this? 14%. So into 1 minus T, 7% is the cost of term loan. Are you clear with this? Agreeing with me on this? Right. So when we're talking about the other one, 13% non-convertible debenture, what do you do? It's an irredeemable. Life is given. No. So what do you pay upon? What do you receive? So it's going to be what? It's going to be what? Very simple. So they have said it's going to be 13%. So let's assume that, okay, so let's assume that the face value is going to be 100, right? Nothing is given. You can assume the face value to be 100. So interest is going to be 13 rupees into 1 minus 0.5 divided by net proceeds. How much will be my net proceeds? So 100 rupees is the face value, but they are saying it's going to be issued at a discount of how much? 2.5. So minus 2.5 rupees. Further, they have said issue cost of issue, flotation cost is 2% on face value. One more 2 rupees you reduce. Effectively, what is going to be my net proceeds? 100 minus 4.5, 95.5. Right? It's going to be 95.5. So effectively, you calculate how much is this going to be? 13 into 0.5, 6.5 divided by 95.5. How much does it come out to? 6.806%. Clear with this? So here, okay, this is not percentage. Here, what they have done is they have calculated in total. Okay, so basically, guys, what you can do is you can also calculate in total, no? Totally, the company raised how much? 250 lakhs. 250 lakhs into 0.13. How much is it? 32.5. Correct? Guys, into 0.5. How much is it? Post tax. How much is it? 16.25. That is what is mentioned here. This is nothing but 13% into 250 lakhs into 1 minus 0.5. Are you able to understand? Totally they have applied. I think there is some issue mistake here. You can please rectify this and write it down. This should not be like this. It should be like 13% into 250 lakhs into 1 minus 0.5. Clear with this? This is interest in absolute amount they have given for the entire value. Hello? Able to understand this? Right? Divided by. So what have they said? So 250 lakhs they are going to raise at a discount of 2.5%. Correct? Yes. Which means 97.5% of 250 lakhs. How much is it? 250 into 0.975. How much is it? 250 lakhs. Guys, 250 lakhs at a discount of 2.5%. It's 0.975 into 250 lakhs. How much does it come out to? 243.75. That is what they have mentioned here. Minus, what have they said? A further, what is it? 2% is the flotation cost on the face value on what? 250 lakhs. 250 lakhs is the par value. So 250 into 0.02 you do. How much you get? How much you get? 5. That is what they have got here. Clear with this? All these things are not required. On a per debenture level, you can do it, no? Why do you want to break your head with all this? 13 rupees per debenture. What is the interest cost? 13 into 1 minus T. Divided by every debenture is actually issued at a discount. So 100 minus 2.5. How much is it? 97.5 is the issue price minus flotation cost of 2 rupees. 95.5 rupees is going to be my net proceeds. Clear with this, guys? So basically, you don't need this calculation. You follow this calculation, you will get the same answer of 6.806. Are you able to understand, guys? Yes, right? No need. Do it on a per debenture level. Generally, when we do it on a total level, when the flotation cost is given in a bulk figure, here the flotation cost is given on a per debenture level. No, why do you want to break your head with all this? Fine, done. So the post-tax cost, in case you're going for a term loan, is how much? 7%. Whereas the post-tax cost, if you're going for this non-convertible debenture option, is how much? Only 6.806%. So between the two, which one will you prefer? I'm asking you, it's a no-brainer, no? This is between a 7% source of finance and a 6.8% source of finance. Which one will you prefer? The one which has a lower cost, no? What happened? Good morning. Is it awake? Yes. Since the period of debt is missing, we are assuming to be perpetual. It is better to raise the funds of 250 lakhs by issuing a non-convertible debenture since its effective cost is lesser than the term loan option. Guys, nothing great here. When they are giving between two different sources of finance of the same category, both are debt instruments only, go for the one which has a lesser cost. That's all, no? Go update your library of adjustment. Write down. Write down. Term loan versus debenture. NCD or debenture. Term loan versus debenture. Done? Done? So see, here I have given one. Cost of long-term bank loan. Directly I said there is no concept of premium or discount. There is no concept of flotation cost. So directly you can say in case of term loan, the KD is going to be interest rate into 1 minus T. This is one concept I have clearly mentioned under other issues in KD. Look at this. Other issues in KD. I told you, no, I will not be going in the same sequence. Then and there I will refer. This is what we did. So this amortization of debenture we already saw in our time value of money chapter, right? Convertible debenture just now we saw, right? And short-term debt also we saw in an earlier class. It should be ignored, guys. Yes. And here also long-term bank loan, right? Just now I have told you. Follow this. Yes, guys are clear with this, right? Now let's go on to the next concept called as zero coupon bonds. It's also known as deep discount bonds. Shall we? Yes, Balaji, yes. Right? Perfect. Let's get started with this. Now, what do you mean by a zero coupon bond? A zero coupon bond means a bond or a debenture. Bond and debenture is interchangeably usable word. It means a bond that is issued without any interest. Sir, who will buy these kind of bonds? If there is no interest, why will I have the interest in buying it? Correct? No. Simple. The interest is factored differently. What they will say is, right, these kind of bonds are generally issued at a very deep discount. They are redeemed at par. That is, 100 rupee bond will be issued at 25 rupees. 75 rupees the discount. They will say, today you pay me 25 rupees. After 20 years, I will pay you 100 rupees. Clear with this, right? So at the end of the life of this particular bond, you will get 100 rupees, but today you would have invested only 25. Or in other words, instead of annually paying something, they are factoring it out and they are saying we are pushing it towards the end. You invest 25, you will get 100 at the end of the period. This is similar to this cumulative deposits. Here, no, right? Bundled in a debenture format. Are you able to understand? Yes, this is called as a zero coupon bond. Zero coupon bond has only one cash inflow, one cash outflow. That's all. During the life, there will be no cash flows at all. Nothing will be repaid, no interest payments, nothing. During the life, zero cash flows. One shot, one inflow, one outflow. Clear with this? From a viewpoint of investor, first outflow 25 rupees, followed by an inflow 100 rupees at the end of the life. From the viewpoint of the company, first the inflow 25 rupees, and at the end of the life, they're going to pay back 100 rupees. Clear with this, right? So this can have an effective cost. Clear with this? The calculations are very simple here because one cash inflow and one cash outflow, the cash flow equation can. Now you read this. These bonds are generally issued at deep discounts and are redeemed at par. And there will not be any coupon payments during the life. And KD for zero coupon bonds is calculated using YTM approach. Very simple. Present value is equal to, can I say, future value divided by 1 plus R the whole power n? Guys, correct? Correct, no? Present value is the value of the bond as on date. This is nothing but future value, this 100 rupees divided by 1 plus R the whole power n. Are you clear with this? This R for this bond is called as KD. Right? Based on this formula, you can find out the KD. Clear with this? KD is the only missing figure. Are you able to understand this? Are you able to understand? As simple as that. So now let's go and do a couple of numerical problems in this area also. I'll come back to 21. Now look at this. IDB, Institutional Development Bank, issued a zero interest deep discount bond. Meaning what? Deep discount bond is also known as zero coupon bond. Right? Of face value 1 lakh each, issued at how much? Look at this. Look at this. It was issued at 2,500. Which means what? 97,500 is a discount amount. It was issued at 97.5% discount. Clear? That's the reason. You invest 2,500 rupees today. After 25 years, I will pay you 1 lakh rupees. To understanding this, because they are compounding and using this time value of money technique. That's all. Compute the cost of debt if there is no corporate tax. So guys, why will companies do that? Of course, they are getting the money today. Sir, the company is paying me 1 lakh rupees. That's a layman way of looking at it. 2,500 rupees I invested, it is actually going to give me 1 lakh rupees at the end of the period. Come on, they are using this for 25 years. It is a compensation for time value of money, as simple as that. Here with this. From the viewpoint of company, today they are taking 2,500 rupees. Annually, nothing needs to be repaid. After 25 years, they just need to repay back the capital amount along with the accumulated interest, which works out to 1 lakh rupees. As simple as that. Are you getting it? How would you do it? Look at this. Redemption value is how much? 1 lakh. And the net proceeds today is how much? 2,500. No flotation cost is given. And interest, zero. The very concept of this particular zero coupon bond is zero coupon bond, zero coupon, zero interest. Life of the bond is 25 years. Now, what you can do is, there's a huge difference between the RV and NP, the period they are saying. Therefore, in place of approximation method, we should use trial and error method. Logical formula. Future value is equal to present value into 1 plus R the whole power n. Correct? Future value is what? 1 lakh is equal to present value 2,500 into 1 plus R. R is basically the KD rate. The whole power 25. Correct? So this 2,500 goes to the other side. So 1 lakh divided by 2,500 will be equal to 1 plus R to the whole power 25. Correct? Right? Or 1 lakh by 2,500 is 40. Guys, correct? No. 40. So 1 plus R to the power 25 is equal to 40. Here, generally tables will be given. So what they have taken, first trial, assume R is equal to 15%. Are you clear with this? So if you substitute R as 15%, it becomes what? 1.15 to the power 25. You take the value, you get a final answer of 32.919, but you should have got how much? 40. So clearly you know that R is not 15%. Correct? Had R been equal to 15%, the final answer you would have got here would have matched with 40. Correct? It's a trial and error. So what you do, you increase the discount rate. This is a compounding. Right? So what you do is, the next trial you take is 16%. If I take R as 16%, the value that I get is what? 40.874. Here with this. Right? So in this case, what you don't worry, they will give you the figures in the question. Right? The multiple, that is the future value interest factor, will be given in the question. You just need to multiply. That's all. Or if you want, you can also do 1.15 into is equal to like that. You click for 24 times, you will get this. Simple as that. You will be able to get it. Fine. You try it later on, not now. Okay. Fine. Gamer madri. Joystick lo you're doing it. Okay. Fine, guys. So now what you need to do? You need to do an interpolation. Guys. So at 15%, I'm getting what? 32.919. At 16%, I'm getting what? 40.874. But my R, I know, lies somewhere in between. How do you know that? Because I need an answer of 40. Clear? One value gives me slightly less than 40. One value gives me slightly more than 40. So by interpolation technique, what you need to do, you will arrive at this figure of 15 point. Are you able to? Everywhere it's the same, guys. Logic is everywhere the same. Are you able to understand this? Are you able to understand this? Clear with this? Right? As simple as that. And with this, this particular question is also over. Are you all able to follow this? Right? Please go and update your library of adjustments. Write down. Write down. This is question number 22. I give all the page number referencing and write down. Zero coupon bond, ZCB. Write down ZCB hyphen KD calculation. ZCB hyphen KD calculation. Are we done here? We move on to the next one. Okay. Fine, guys. Let's move on to the next one. Okay, fine. Go to question number 21. Suppose we are considering investing in a zero coupon bond that matures in 5 years and has a face value of 1,000. If these bonds are priced to yield 10%, which means KD is given in this question, right? What will be the present value? Very simple. Very simple. Present value is equal to future value divided by 1 plus r the whole power n. Guys, correct? No? Here, future value is given because it will be redeemed at par but issued at a discount. Correct? No? Right? So can I say the value of bond today, B0, or nothing but present value, is equal to 1000 divided by 1 plus r, 1 plus 10% or 0.10 to the power, what is the number of years? 5 years. Correct? Guys, yes, as simple as that. As simple as that. So arrive at this figure, you get how much? You get 620.92. So basically, a 1000 rupee bond should be issued at 620.92 today. So if you are issuing at 620.92 today and redeeming it at 1000 rupees at the end of 5th year, effectively the company's cost is going to be 10%. Or if you switch at it and look at it from the perspective of investor, effectively you will be earning a return of 10% because the company's cost is nothing but an investor's return. This is the basic thing that we saw in the time value of money itself. Are you able to understand, guys? And that's about this concept of zero coupon bond. Update your library of adjustment. Write down ZCB hyphen calculation of B0. B0 stands for what? Within bracket, write down PV, present value. Calculation of B0 is present value. Done? Done. Okay. Now, I will teach you one very unique area in this entire chapter. That's why I kept it towards the end. It's only one sum in the study material about this. This particular concept is a very unique concept, and it deals with calculation of KE using a different method, right? This method involves some geometric mean and all, right? This is ideally a concept that we call in finance as holding period return. What it is and all, I will tell you. You patiently listen. That's all is required. Fine. Now, let us say I invested, I'm just giving you an example. I invested rupees 100 today in a particular share. I went and I bought one share worth rupees 100. Now, at the end of 1 year, at T1, I sold this share for, let us say, 110 rupees. 110 rupees I sold it for, right? And I held it for how many, what period of time? 1 year I held it. And during this period, I earned a dividend of rupees 20. Correct? From my perspective, you see, I'm an investor. Okay. From my perspective, what is the total return as a percentage I generated out of this particular investment? Can I say my return had two components in it? Whatever I earned, my earnings had two components. One was through my dividend earnings. The other one was through my capital appreciation, capital gains we call it, capital appreciation. 100 rupees became 110. That extra 10 rupees I benefited. That is one component of my return. But was that the only return I earned? No. During the period of holding, I also earned a dividend of 20 rupees. Guys, correct? Correct? Or can I say, in this case, how much was my investment? 100 rupees. 100 rupees. Can I say, overall, if you see how much I earned 110 minus 100. This is one component of my earning. Not just that, plus I also earned this 20 rupees of dividend. Correct? Yes. For an entire capital of how much? 100 rupees. That's what I invested. Correct? So technically speaking, I earned 10 plus 20 upon 100. I earned how much? 50%. Agreeing with me? Or in other words, can I say HPR stands for holding period return. That is the return that I was able to generate for this entire holding period was, can I use this formula, P1 minus P0 plus D divided by P0. That is, P1 is what? The end value. P0 is what? The opening value. P1 minus B0 gives me my capital appreciation. That is one component of my return. Plus dividend, this is another component of my return directly. upon the opening balance, opening capital, which was actually my investment. Agreeing with me on this? Yes, agreeing with me on this, right? Can I use this formula P1 minus P0 plus D upon P0 just to call that as my holding period return? Agreeing with me on this? Agreeing with me on this, right? Now, in this case, what you need to do is, now what I will tell you is, in this context, let's go and do one numerical problem just to understand the facts of this particular question. Now guys, this is called as calculation of KE under realized yield approach. Okay. Now, you didn't have a doubt. First, let me create the doubt for you. The realized yield approach we already saw. KE, one of the KE methods of calculation. You said, no sir, that is done from the perspective of investor, assuming that he sells in the secondary market, it has a finite life and all, and from his perspective you calculate the IRR, and it is based on the principle that the return from the perspective of the investor is the cost from the viewpoint of the company. Yes, everything is correct. So then in the exam, suppose they are asking us to calculate realized yield under KE under realized yield approach, whether should we follow that approach or should we follow this approach? Very clearly, depending on the wordings or depending on the facts given in the question itself, you will know which method they are asking. That clearly will be from the perspective of the investor. You will know that. But this method is a very unique and a one-off and a very rarely used method. One question in the study material they have given, I didn't want to skip that also. That's I'm doing it here. Fine. What do we do? How do we do? I'm going to explain this concept using this numerical problem. Clear with this? Read this question. Calculate the cost of equity from the following data under realized yield approach. Suppose it was that sum. What they would have said? Mr. A had bought the share for 100 rupees. After 5 years, he's expecting to sell this for 120 rupees during the period he earned it. Like that, only the wordings will be there. Here, what have they given? Year-wise dividend per share is given, and price per share at the beginning of every year they have given. Clear with this? Right? Nothing is given from the perspective of investor and all. Clearly, this sum needs to be done using this particular concept of holding period return. Clear with this? Because holding period return at the end of the day, what is the formula? P1 minus P0. That is that every year capital appreciation plus dividend divided by the opening value P0. Correct? No? That's how you calculate. Now, what they have done? Year 1, year 2, year 3, year 4, year 5. They have given what? They have given the price per share, that is the opening value, opening price per share, and they have given the dividend per share for each of the 5 years. Clear with this? Now, what you need to do is you need to calculate the holding period return for 4 years. Sir, why 4 years, sir? I will tell you. You cannot calculate for 5 years because you need the opening value and the closing value. Correct? Let's say in this case, year 5, they have given clearly whatever price we have given is only at the opening price. Year 5, if you take this as the opening price, what is the closing price? It should have been given in the question, no? Correct? Strictly speaking, only for 4 years you can calculate, because for the 4th year, I will take this as my opening price. Correct? And the opening price of 5th year is nothing but the closing price of the 4th year. I will repeat once again. I'm telling you, what you need to do is, for the purpose of calculating holding period return, every year you need to calculate this P1 minus P0 plus D divided by P0. Every year, what is the capital appreciation? Every year, what is the dividend divided by the opening market value as the beginning of that year? This is what you need to calculate. Clear? Let us say I need to do this calculation for the 5th year. Okay. This 10.6 rupees is what? Opening value at the beginning of 5th year. So P0. For the purpose of 5th year, it is P0. Opening value. Closing value of the 5th year, is it given in the question? So for the 5th year, can you calculate HPR using the data given in the question? No. Which means you should stop the calculation only for the first 4 years. Can I do this calculation for the 4th year? Yes. How? Opening value is 11. Closing market value of 4th year is 10.6, which is the opening of the 5th year. This is what I said. Frida, you are able to understand this, right? So in this question, the first step is to calculate the holding period return for each of the 4 years. Clear with this? So now, how do you calculate? This is what is given. Directly, they gave all these things without the background explanation. The study material, this is what is given. So now, for year 1, how will you calculate? For the first year, the closing value is what? See, this is the beginning. This is the ending value. Correct? No? Closing value 9.75. Opening value is 9 rupees. Correct? So from the perspective of the first year, there was a capital appreciation to the extent of 75 paise. Correct? No? So they are saying 9.75 minus 9. Okay. Plus the first year's dividend was how much? 1 rupee. Guys, correct? No? Right? So it was 1 divided by what? Divided by the value at the beginning, which was 9 rupees. Correct? They got how much? 19.44. So the first year's holding period return was how much? 19.44%. Clear? Second year's return, how do you get? So 11.5 minus 9.75. Correct? From the perspective of year 2, this is the opening balance, this is the closing balance. Guys, yes, what happened? Yes, so can I say this is 11.5 minus 9.75 plus that year's dividend is given there, 1 rupee, right? Divided by the opening value of 9.75. So can I say this is going to be 28.2%? Is clear? Similarly, for year 3, what is it going to be? So 11 minus 11.5. Here, what has happened? There is an erosion. Market price can also fall, no? Market can go up and down, right? All you need to do is just calculate and leave it there. That's all. So can I say 11 minus 11.5 plus that year's dividend is given as 1.2 plus the base P0, which is 11.5. That year's holding period return also we computed. It is going to be 6.08%. Guys, getting it? Getting it? Huh? See, look at this. Capital appreciation in this case was 0.5%. But dividend was how much? So it was a 0.5%, 0.5 rupees. So 11 rupees became how much? 11.5, which means what? 11.5 became 11. See here, 11.5 rupees became 11, which means capital appreciation was minus 0.5. But the company also paid a dividend of how much? 1.2. Net of there was a 0.7 rupees that I earned, So both are returns. Dividend to come here. If the dividend is also less, yes, then the holding period return will be negative. Over this. Yes. Are you able to understand this? It can be as follows, right? And for the fourth year also, P1 minus P0 plus D by P1 P0. You do all the calculation. Year wise, you get what? Year wise, you get your here also 7.72%. Clear with this? Now, basically, guys, listen here. The investor's return is going to be the cost from the viewpoint of the company. Sir, for 4 years you have computed. I have 4 figures. Are these 4 KE? KE is only one figure. You have given me 4 figures. What you need to do? Take an average of this 4. But wait, mean means average. But that mean is not a normal mean. It has to be a geometric mean. Are you understanding? Geometric mean, how will you calculate? Now, this is ideally a part of your, again, your 8th standard mathematics only. So don't think I'm humiliating you. If you don't know also, it's okay, not a problem. So basically, when you have the formula for calculating KE in this case is 1 plus HPR1, that is the first year return, plus 1 plus HPR2 plus 1 plus HPR3 plus into, everything is into 1 plus HPR1 into 1 plus HPR2 into 1 plus HPR3 into 1 plus HPR4, the whole power 1 by 4 minus 1. Wait, I will tell you what it is. Guys, please listen here. If you have a geometric progression series, let us say there are 3 numbers A, B, C. Calculate the geometric mean of this particular series. Geometric mean calculation is basically A into B into C to the power 1 by 3. Or in other words, it is multiply all the numbers in this particular series and the whole to the power 1 by n. How many number of entries are there in that series? You need to do that. Suppose there are 4 numbers here, that's why we have done 1 by 4. Suppose for 5 years we computed, you should have done to the power 1 by 5. Are you able to understand this? Number 1. Number 2, you always, every year it compounds, no? Every year it compounds, no? That's why we do 1 plus that return. 1 plus that return, we do it, and finally once we compound it, we reduce that 1 on the outside. This is how your geometric mean is computed. This is the formula for computing a geometric mean. Clear with this, guys? Right? Suppose in this case we had 5 figures. What will it be? So 1 plus every year's return, like that you need to do multiply 5 years to the power 1 by 5 minus 1 on the outside. Clear with this? If 3 figures are given to the power 1 by 3, finally minus 1. So now what we did here, the first year was 0.194. So 1 plus 0.194 is 1.194 into 1.2821 into 1.0609. I mean, they have just completely written into 1.0772. There are 4 numbers here, hence the power 1 by 4 minus 1. If you do, overall you get. Yeah, sir, to the power 1 by 4, how can we do it? If it is even, it is not a problem. Click on square root twice, you will get it. If not, generally, guys, this figure will be given in the question. This figure will be given in the question. To the power and all exponentials will be given in the question, right? You just need to, you multiply these figures, right? You get an answer that you multiply with. If 1 to the power something, what is the value? So they will give you this figure. The entire value will be given in the question. You need not have to worry about that. Are you able to understand? Right? Exponential in fractions will be given in the exam. You need not worry about it, but you should know that this is the. Are you able to? Yes, yes. And using this method, that is the realized yield method. In this case, the answer comes out to KE value is 15%. Put it short, there is one unique method of calculating KE that is called as a realized yield method. The name of this is very exactly the same as that realized yield we saw, but this is completely different. This is based on the concept of geometric mean approach. So what you need to do here is, sir, how do we differentiate between the two sums based on the given data? Year-wise dividend and year-wise price is given. Clearly, they are expecting you to follow the geometric mean approach. In this case, how do we do? Year-wise calculate the holding period return. Right? Generally, it will be what? Number of years minus 1, because for the last year you can't calculate HPR because the closing value is not available. Clear with this? So what do? Year wise you calculate the data, right? HPR, and then what you need to do is 1 plus HPR, like that you need to do for all the 4 years. Multiply this to the power 1 by n. N is the number of years. Finally, you do minus 1. Whatever answer you get, that is simple. Or in other words, year wise return, calculate, find out the geometric mean of this. Whatever answer finally you get is called as KE under this realized yield. Are you able to? Yes, yes, and that's about this particular concept as well. Just go and update your library of adjustments, and most importantly, please mark this sum as unique. I will not call it as important, but it is unique, very unique. Definitely, you will miss it in case you don't mark this as unique. It's a very unique sum. That's why I didn't do this along with the KE calculation, if you notice. Because if I teach you there, then you will think for all the sums you need to do it like this. No, this is a different animal altogether. Treat it separately. Write down holding period return. Wait. KE using holding period return. Holding period return within bracket geometric mean. Within bracket geometric mean. Done? Done, guys? Fine. Now, the next question is a direct question. Please do it by yourself. Calculation of KE and KD. It's a very simple question, nothing great. Now, let me go to question number 25. Right? Have we, guys? 2 more sums and we are done with this chapter. Literally, see, we are covering all the questions. Right? It's a comprehensive coverage. Despite the fact that this is a fast track batch, we're covering literally all the questions. Right? Only I'm avoiding repetitive nature or things which you can manage. Literally, we're solving all the questions. Now, a good question. This question is not there in your study material, but I took this up from some older past exam question. I personally feel these kind of questions can come in your exam. Now, today being 1st Jan 2019, Ram is considering to purchase an outstanding corporate bond having a face value of 1000 that was issued on the 1st of Jan 2007. Which has a 9.5% annual coupon and a 20 years of original maturity. That is, it is maturing on the 31st of December 2027. Okay. Since the bond was issued, the interest rates have been on the downside and it is now selling at a premium of 125.75 per bond. Right? Interest rate here is not your coupon rate. They refer to the market yield and all. I told you, based on the yield and all, the market price of this debenture can increase or decrease. One sum we saw, no? Yield. Based on the yield, we calculate the issue price. Correct? No? One sum I saw. We saw that. When I taught you. Now, based on that, they are saying currently it's quoting at a premium of 125.7. Determine the prevailing rate of interest on similar bonds if it is held till maturity, which shall be at par, and the PV factor are given in the question. First, I forget the answer. I want you guys to read the question and tell me the approach to this most important thing. First, I'll give you about 20 seconds time. Read the facts of the question. Then you can answer. Come on. Quick, quick, quick. Make it fast. Done? Okay. Now look at this. In this question, they are asking you to calculate basically prevailing interest is nothing but KD calculation. They are asking you to calculate KD. Okay. Or from the perspective of investor. KD from the perspective of company. Cost from the perspective of company is return from the perspective of the investor. What they are saying. Can anyone tell me what is the life of or the period of this particular debenture for all our calculation? 20 years. Now, this debenture was issued on 2007 January, 1st January. It is, when is it redeeming? 2027, 31st December. Today is, not today exact day, in the question, present, today is 2009. And we are talking about Mr. Ram, who is entering the market, debt market. Debentures will be listed in debt market, I told you. He is entering the market today on the 1st of Jan 20. He is entering today. From today, what is the remaining life? 8 years. 8 years. 1st Jan 2019 means entire 2019 is there. 20, 21, 22, 23, 24, 25, 26, 7. First of all, for the purpose of financial management, we are taking decision, which means past is past. Move on. Okay, right? Message for you. Okay, so past is past, move on. Basically, here what we are saying is Mr. Ram is also moving on in life, and basically today the remaining life with respect to the debenture is going to be 9 years. Guys, getting it? Come back, getting it, right? So for all calculations purposes, you need to consider only 9 years. Here, very simple. Today, if he is going to the market and buying this debenture, per debenture, what will be the amount he has to pay and get it? Hello? Per debenture, what is the amount that he needs to pay to buy the debenture? What is the current market price of the debenture? 125.75 is perfectly the wrong answer. Because read the question carefully, it is selling at a premium of 125.75. The face value is 1000. So 1000 plus 125.75. Today he needs to pay 1125.75. So first thing, life 20 years. There we made a mistake. Number two, having decided that we should be remaining life, then also we said only 8, not 9. Having calculated that, at least now the first cash flow, whether we are getting it. See, this is how the question is framed. They know the psychology, not you. Many students made this mistake. This is how the questions are being framed now. Something like that. Okay, right? So basically now what happened is, if he is entering into the market today on the 1st of Jan 2019, his initial outflow will be what? 1125.75. And if he's going to hold it on till the maturity, at the end of the life, he will get how much? 1000 rupees redeemed at par. And during the life, he will get how much interest? 9.5% on 1095 rupees every year you will get. These are the cash flows. You discount it and you arrive at the IRR. Discount as in the rate that makes my NPV equal to 0. You arrive at IRR. Now, for you to take that IRR, how will you calculate? 2 trials are given here. This is all about the question, guys. Easy, no? Provided you read it properly. Getting it? Now, don't blame that the course is difficult. A little observation skill can save your life with 4 months. Right? It's no joke, guys. I'm not saying this as, to make fun and all. On a serious note, I'm saying we have to be serious when it comes to looking at the questions. 4 months is no joke. Right? 4 months delayed now is not just whatever it's not the incremental cost. If you see, if you're talking about in terms of finance, so you would have qualified 4 months earlier. So which means per month, let us say the moment you qualified, at least some minimum, I'm saying 70,000 rupees salary you will get. So 7 into 4, how much is it? 2.1 lakh is the opportunity cost of this observation error you made in the class today. That's how you need to look at it, right? Why am I saying it is basically be more observant when it comes to your solving your questions, right? Not a joke, guys. I'm just seriously telling you, be very, very observant, not just for our paper, all the papers, right? So now coming back here, but don't worry, there's nothing to feel bad about this, because many students make this mistake. Institute knows that. That's why they coin these kind of questions. Look at the psychology that goes behind this. They know where you make a mistake. First, a mistake on the life. Second, even if you figure out past is past and moving on, that move on life is also calculated wrongly, right? And having calculated that, now today if I go to the market, what is the price? That premium amount is only mentioned here. That you need to take care of it properly. Here with this, right? Have that in your mind. Now look at this. The year 0 outflow is going to be 1125.75. I just told you, every year you're going to get an interest payment of 95, and at the end of the life you're going to get 1000 rupees. That is going to be a redemption value. So at 6% discount rate, you get a positive NPV, 8% discount rate, negative NPV. What you need to do is interpolation, and you arrive at your net KD value. Are you able to understand? Or KD, basically from the viewpoint of company, from our viewpoint, is going to be the net return. Are you able to understand this, guys? Yes, beautiful sum, right? So please go and update your library of adjustments right now. We're using the same wordings of the question. Calculation of prevailing rate of interest. Calculation of prevailing rate of interest. Prevailing. Prevalent. Prevailing. Done. Done. Shall we move on? The next one. Guys, shall we proceed the next one? Right. Okay, so this 25 is also something similar. It's easy, you just see. Now, the last question, question number 26. And with that, we'll be winding up this chapter. Question number 26. This question is about missing figures. Missing figures, right? What is this question about? Look at this. An interesting sum. It's like a puzzle. Mr. Ram Limited, evaluates all the capital projects using a discount rate of 16%. In short, they are currently saying their WACC is given in the question. WACC is 16%. Its capital structure consists of equity share capital, retained earnings, bank term loan, and debentures redeemable at par. How many sources of finance are there? 4. Equity share capital, retained earnings, you have a term loan, and then you have a debenture. Correct? The rate of interest and overall cost of capital is given in the question as 16%. Right? Now look at this. The interest rate on the term loan, it carries an interest rate that is 1.4 times that of debentures interest. Here with this. If the rate of interest on debentures, let us say X, what will be the interest rate on term loan? It is 1.4x. The meaning? Hello? The remaining tenure of debenture and the bank loan is 4 years and 6 years respectively. So debenture has a remaining life of 4 years. Term loan has a remaining life of 6 years. This is what they've given. The book value of equity share capital, retained earnings, and the bank loan is 20 lakh, 30 lakh, 20 lakh respectively. So equity is going to be 20 lakh, retained earnings 30 lakh, and bank loan they have given is 20 lakh. This is the book value. Whatever is given here, I'm just putting it in a structured format. Debenture which is currently having a value of 30 lakh. This is also given 30 lakh. Is currently trading at a market price of how much? 98 rupees per debenture. The ongoing PE multiple for shares of the company stands at 4. What it is PE multiple, I'll tell you right now. You are required to calculate. You need to find the missing figures. Calculate the rate of interest on bank loan. Calculate the rate of interest on debenture. Very simple. If you calculate X, that is rate of interest on debenture, your term loan interest is going to be 1.4%. 1.4 on X. Here with this. Forget, it's very simple. Basically, you need to calculate the rate of interest on your debenture. If you calculate that, you can calculate your term loan interest also. Applicable tax rate is 30%. Now, first and foremost, before we enter, PE multiple is given in this. What do you mean by PE multiple? More details about this we'll be seeing in our upcoming chapters. Don't worry about it. PE means what? Yes, I'll tell you. PE stands for, P stands for price, E stands for earnings, right? And PE stands for, PE ratio is nothing but MPS upon EPS. That is market price per share upon earnings per share. Clear with this? Or this is nothing but, sir, why are we actually learning all this? I mean, what does PE's ratio stand for? Suppose the company is earning per share, it is earning, let us say 10 rupees, right? And currently the company's share market value, currently the company's market price is trading at 60 rupees. Example, I'm saying P ratio means what? 60 upon 10, which is 6 times. Or in other words, it says your price is quoting 6 times your earnings. This is the meaning of that. Clear with this? Clear with this? P ratio generally means what? It expresses the number of times, it expresses your earnings, it expresses your market price in terms of number of times your earnings. Clear with this? If someone says P ratio is 6 times, it means what? Means what? If the company is earning 1 rupee, the price will be 6 rupees. Or in other words, to put it short, the price is 6 times the EPS of the share. Clear with this? Sir, with this, what we can calculate? Wait. This is where it requires some presence of mind. Please focus here. It requires some presence of mind. Now, what requires is one of the formulas for calculating KE. KE has totally how many methods of calculation? 5. First method, dividend price approach. Second method, earnings price approach. Earnings price approach is what? Basically, what I pay upon what I receive. Instead of dividend, it is going to be earnings per share. We saw that, no? So KE, one of the formula is what? EPS divided by net proceeds, or P0, or that is nothing but current market price. MPS. Correct? No? Correct? No? Yes. No. Now, if I take this MPS to the other side and EPS to this side and cross multiply, can I say MPS upon EPS is equal to 1 by KE? Agreeing with me? Simple cross multiplication. And this MPS upon EPS is nothing but PE ratio. Just now we saw the PE ratio formula, no? Market price upon earning. Correct? Or 1 by KE is equal to PE ratio. Or in other words, can I say KE is equal to 1 divided by PE ratio. Agreeing with me on this? Agreeing with me on this? 1 by KE is equal to PE ratio. Cross multiply. So KE is equal to 1 upon PE ratio. Agreeing with me on this? Write it down somewhere. This requires some presence of mind. Please write this down. I will give you a minute time. Please scribble it in whichever language you understand. So you please do it. Whichever way you understood, you please scribble it off. Right? A very, very important understanding. This presence of mind, right, is required in your exams. So that's the reason why I just solved this sum in the class for you. Right? Beyond this, no incremental learning. It's all concepts are done in this chapter. Right? It's just one puzzle that we had to solve here. Clear with this, guys? So now, can I conclude that this earnings price model, correct? This earnings price model led me to one more formula, which is K is equal to 1 upon PE ratio. Agreeing with me on this? Guys, are you able to understand this? Any problem here? In this question, what have they given? PE ratio is 4 times. So what is going to be my KE? KE is 1 by 4, which is 0.25. So 25% is my cost of equity. Clear with this, guys? Yes. As simple as that. Are you able to understand this? Right? So now, guys, listen. In this question, you have the KE figure, 0.25 or 25%. Yes? KE is equal to KR. K is equal to KR. So even for this 30 lakhs, there's the same cost of 25%. For the remaining two, the weights are there. The cost is, everything is expressed in terms of X. Correct? No? The cost with respect to debenture, interest rate is X. Right? So what we can do is let the rate of interest be X. Right? shortcut formula for KD, what we will do, I into 1 minus T plus RV plus NP, RV minus NP by N, the whole by RV plus NP by 2. There, this entire formula, what we will do is, wherever interest amount comes, there alone we will take it as, the face value into X, we will keep it, right? So in other words, we will establish KD in terms of X, correct? And they have given the question, term loan is 1.4 times the interest, the interest on term loan is 1.4 times the interest on your debentures, correct? So that can also be expressed as X. All other data is available. Total cost of capital is also available. With this, you have only one variable to calculate, which is X figure. If you arrive at the X figure, the answer is done. Are you able to understand how to exactly to do it? I will quickly walk you through. First, guys, you just have to follow here. Nothing needs to be done. Let the rate of interest on debenture be X, right? So the rate of interest on loan will be what? 1.4x. I just told you. Hello? So now let's calculate KD on debenture. KD formula is what? I into 1 minus T plus RV minus NP by N, the whole by RV plus NP by 2. Correct? I is what? See, this is not multiply, this is X, right? This is 100x. Interest amount, how will you calculate? Coupon rate, hello? Coupon rate into your face value, correct? Face value is 100. The coupon rate, X, is expressed as a percentage, no? The interest rate, the rate of interest on debenture is what? X. So can I say the interest amount is 100x? Example, suppose if my interest is 6%. So 6% into 100 is 6 rupees, no? So we have kept that X. We don't know what that figure is, 6% or 7%. We don't know that. So we kept it as X. So 100x is nothing but your interest amount, correct? Yes. Into 1 minus T plus RV, redemption value is how much? 100. Correct? Nothing is mentioned. At par. NP, today how much do I get? Look at the question they have given. Currently, my debentures are trading at 98 rupees. So today if I go and raise this money, I'm going to get only 98, guys, correct? So look at this. It's going to be 98 by life is 4. The whole by RV plus NP by 2. Clear with this? But what will happen here in this case, if you solve this, so what will happen here? 100x into 0.7, 1 minus 0.3 is 0.7. So 100 into 0.7 is 70. So this can be rewritten as 70x plus, so 100 minus 90 is almost 2. 2 by 4 is nothing but 1 by 2. 1 by 2 is nothing but 0.5. So my numerator is 70x by 0.5. The whole divided by 100 plus 98 by 2, which is 198 by 2, which is 99. Correct? So can I say this is nothing but 70x plus 0.5 divided by 99. This is my KD figure. Correct, guys? Correct, guys? Are you getting it? Are you getting it? Now, KE can we calculate? Just now I told you it's nothing but 1 by PE ratio. That's nothing but 0.25. Just now we saw that. Hello? Yes, you guys are getting it? Now, each of the source of finance, these figures are all given. The total value is 1 crore. With this, I can calculate the weights. Any problem here? No. KE, 0.25. Just now we calculated. Hello? K is equal to KR. That's also 0.25. Correct? KD, just now we saw this is nothing but 70x plus 0.5 divided by 0.99. Guys, correct? Yes. And here, what is going to be your this one? Your interest rate on loan. I mean your KT. Basically your KD on your term loan. KD on your term loan. They have said it is going to be the rate of interest on my term loan is going to be how much? 1.4x. Correct? So they have given the question. The rate of interest on my term loan is going to be what? 1.4 times my rate of interest on debenture. Correct? No? Yes. And in case of a term loan, how do you calculate the post-tax cost of debt? It's going to be into 1 minus tax rate. What is the tax rate here? Into 1 minus 30. Guys, correct? Interest rate into 1 minus t. Interest rate for your term loan is 1.4x. It is 1.4 times your interest rate on your debentures, guys. Correct? Right? Or this is nothing but 1 minus 0.3 is 0.7. Correct? So 1.4 into 0.7, how much you get? 0.98. That's what they have mentioned here. Hello? Are you able to understand this? Yes, you guys are able to understand this? Yes? Done? This independent ingredients, you got it? Guys, this is simple mathematics you need to do. Correct? So now what happened? multiply the respective weights with the respective costs. So 0.2 to 0.25, you get this figure. 0.3 to 0.25, you get this figure. Now here what we need to do, it is 70x plus 0.5, the whole divided by 99, multiplied with 0.3. Correct? So what happens? 0.3 into 70, how much is it? 21. So 21x plus 0.3 into 0.5, how much it becomes? 0.15x, the whole divided by 99. Getting it? I'm literally walking you through every single step here. Right? And here 0.2 into 0.98 gives you how much? 0.196x. Right? You add up all these things. Basically, 1 second. These two numbers you add, how much you get? Take your calculator. Take your calculator. 0.05 plus 0.075. How much you get? 080. 0.05 plus 0.075 gives you 0.125. That is this number. Plus this 0.196x is kept separately. 0.196x plus this figure is also kept separately. 21x plus 0.15, the whole by 99. Clear with this? This is the total. Correct? Yes. And in this question, they have clearly given that the overall weighted average cost of capital is 16%. Guys, correct? Because that's a discount rate I use. Discount rate is nothing but your weighted average cost of capital. Or can I equate and say 16% is equal to 0.125x plus 0.196x plus 21x plus 0.15, the whole by 99. Guys, correct? Now what should you do? You take an LCM? No. Hello? You know to take an LCM? Yes, we have. No, no. Yes, we have. Congratulations, figured it out. Was okay, fine. So here it has to be what? 99 into 0.125. So you need to multiply this. 99 into 0.125. How much is coming out to? 12.375. 99 into 0.196x. How much is it? 19.404x plus 21x plus 0.15 remains here. So now you have a whole common of 99, right? You take it to the other side. So what happens? 0.16 into 99. Guys, every step I have mentioned, all these steps they skipped in your MTP or wherever I took this question from, right? I have made sure to add everything because I know some students will ask, sir, how to do the calculations, right? And I'm literally walking you through every single calculation which is not even related to FM. Okay. Now what do? You add all the numbers. So here you get what? Okay, so these two are in x, no? So the x variable figures are what? So 19.404x plus 21x, how much you get? 40.404x. Can I say this is equal to, so 0.16 into 99, how much you get? 15.84. So it's equal to 15.84 minus this goes to the other side. These two goes to the other side. So 12.375 plus 0.15, how much is it? 12.375 plus 0.15, it's 12.525. 12.525 goes to the other side. Guys, any problem here? Normal calculation. Normal calculation. So finally you solve this, guys. Basically you get x value as 8.2. Okay, clear, as simple as that. And now once you get x is equal to 8.8, x is what? The coupon rate on my debentures, right? So what will be the coupon rate on my term loan? It's going to be 1.4 times my x value. It's going to be 11. That's about it. Go and update your library of adjustment. Right now. We have covered this so much comprehensively in a fast track batch itself. Nothing more you need beyond this. Write down. Missing figures to calculate KD and KT. I call KT. KT means cost of term loan. It's actually not a terminology used in a study material, but we are just updating our library of adjustment. It's okay. Missing figures to calculate KD and KT. KD and KT. T stands for term loan. Semicolon. One more learning point in this question. What was that? What did we learn? One more thing. Yes. Write down. KE is equal to 1 by PE. KE is equal to 1 by PE. Right? And with this, we have comprehensively covered this entire chapter of cost of capital. If we total all the sums that we have done till now, actually in this chapter, it's coming out to 26 sums we have done. In total, we have done a total of 26 sums. Sir, totally only 26 sums are there? No, totally 34 sums are there. There are some 11A, 11B, 11C and all. So totally we have done 26 sums in the classroom itself, right? Even in the fast track batch, literally every single question we have done. Similar questions alone, I am not doing it. Fine, that's about it. Those sums also you can do it by yourself based on whatever we have studied. In-depth coverage was done here. Clear? Beyond this, nothing else is required in this particular chapter. Please practice this entire chapter once again, right from the beginning. Every single sum, you please take out your notebook and solve it. That's a very, very important thing to do. Number one. Number two, if you notice, I would have kept some MCQs also, right? In this book, MCQs and one case study based MCQ, which is there in the study material. I have just given it here. Now, in my opinion, MCQs are something that needs to be solved by you because there is no conceptual learning in an MCQ. I have literally taught you all the concepts in this chapter. We have learned many kind of adjustments using the numerical problems. Right now, you apply all this knowledge and you can easily do these kind of MCQs. 100% it is something that you need to do. Even if I do max, what will I do? I will just say, see this we saw, now this concept we saw it, that's the maximum I can do. Please take that effort from your side, right? That is something that you need to do for sure, because case study based MCQs can be, literally time consuming. So unless and until you put your pen on a piece of paper and start solving it, you will not get it. So get that speed. For you to get that speed, you need to do the practice. Number one. Number two, any which ways, for every time an RTP or an MTP or any kind of exam question comes in, I anyways solve this entire RTP, MTP and exam papers, respective attempts. We've already solved it and it is there on our YouTube channel. You can actually, if at all you want to take reference from there, you can watch that also. I'll be solving as separate videos. I am not putting it as a part of course content because the course will become then very big, right? So it is anyways there available for everyone, right? Free of cost. You can go to our channel, right? Just search for my name and you will get it. As simple as that, right? Beyond that, nothing else is required with respect to your case study based MCQs. And most importantly, I request you to please do this. Go to your Board of Studies portal. There you have this feature where you can log in using your student registration number, and you just need to enter your date of birth. Automatically, institute has a database at which level you are in foundation, inter, final. So if you are obviously a foundation student, so for foundation, subject wise, chapter wise, institute is actually having a very good initiative where you can take case study based MCQs from there, right? And it is actually like, a gaming level. They have easy, medium, hard and all, right? You please take that case study based MCQs. You make use of all these things. These are the perquisites that you get by paying all your registration fees you guys paid for the intermediate course, not your exam fee. Registration fee you paid for registering for this course, right? That registration fee, actually for whatever you've paid, institute has come up with some beautiful initiatives. Make use of that. You need not pay any extra money in getting some MCQ test series. It's not required with respect to MCQs. You take it there. After, it comes with a timer also. It's like a game. It comes with a timer. So it will tell you at the end, it will generate a report and it will tell you which question you took, how much time and all that. And you can generate a PDF summary as to what is the correct answer, what was the answer that you gave, right? All these things, it is there. Make use of these things, right? And how do you approach MCQs? Based on the knowledge that we just got, right? I've taught you literally every single concept under this particular chapter. Beyond this, nothing is required, right? Based on this, it's your duty right now to sit and solve all this case study based MCQs, not just in our study material. You go to Institute Board of Studies portal, you log in and you also take up all those things. It's very, very beautiful initiative which the institute has come up with, right? So please make use of that. So on that note, I'm signing off in this particular session. We have successfully completed 2 chapters. One is time value of money, and then we've completed your cost of capital chapter as well. A comprehensive coverage, every single question and every single concept is done. One more thing I just want to show you. Now some students might have this doubt, so I wanted to open up and show this also. Now there's one thing that I have deliberately left because it's not a part of this chapter ideally. Calculation. Under KE, you have something called as estimation of growth rate. When G is not given in the question, there are 2 ways in which growth rate can be calculated. One, based on the trend we saw now. Yes, 5 years ago. Currently, based on the trend, you get it. The other one is actually using a formula called G is equal to B into R, where B stands for retention ratio and R stands for rate of return on your funds invested. So what is all these things? Ideally, it's not a part of this chapter. It's a part of a chapter called as dividend decisions, which we'll be seeing later. Sir, then why did you keep it here? Because by I don't know for what reason, Institute has mentioned this formula alone in this chapter as well as in dividend decision chapter, but no sum is covered in this chapter with respect to G is equal to BR. All the questions are covered there only. That's the reason why, since you should be having the doubt, I have actually foreseen that also, and I've kept it here. But do not worry, this entire formula is also logical. The logic behind this I will teach you in that respective chapter. It's not a part of this chapter. Clear? So on that, I think we have literally covered this entire chapter, right? Full and full, all in all, right? And with including all numerical problems and everything. So now it's your duty to actually apply these concepts, solve these sums once again, and solve all the case study based MCQs. And that's about it. You are already exam ready. As simple as that. Right, guys? And remember, at the very first class itself, I told you I can provide you the direction, but right now it's up to you to bring that determination, and you need to solve it. So the power of consistency will actually take you heights, right? The only thing is, you need that little push. Do it. You will be able to do it, right? You guys are really telling, you guys are very sincere. CA students are very sincere, because the moment you're signing up for a course, it's no joke. Not everyone has the guts to do that. You guys are still hanging on to it. It means that deep inside you have that hunger, you have that fire. Bring it on. That's about it, right? There's a saying, beautiful saying in English: work while you work, play while you play, right? So you need not sacrifice all other things. When you are studying, give your 100%. That's about it. And whenever you're in your free time, you don't think about studies. You just enjoy whatever you want to do. Have a mix of everything in life, and I'm sure you will reach heights. Clear with this, guys? Fine. With that, I am signing off in this particular session. I will see you all in the next one with a brand new chapter. Thank you all so much. Bye-bye.